Hello and welcome to Cryptocurrency Trading Masterclass by Wealthy Education. In this course, you'll learn profitable setups and advanced technical analysis, strategies for trading the cryptocurrency market. You'll learn how to trade breakouts, consolidation, and price action using chart patterns and candlesticks. You'll have a step-by-step guide on how to trade Bitcoin, Ethereum, Litecoin, Ripple, and a dozen of other altcoins. And as with every course from Wealthy Education, you'll learn with real-world examples. So sign up, come on in, let's get started. Hello and welcome to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, we kick off Module 1, Profitable Crypto Trading Setups. This particular video is must-know trading terminology. Now, before we can get into trading, we have to make sure that we are speaking the same language. So, let's go through some very basic terminology. Therefore, we're able to have the conversation and talk about various strategies and ways to trade the crypto market. So the terms that I'm going to show and talk about here are not only crypto specific, but they're going to be used in any financial market. So if you decide to trade stocks or Forex later, commodities, whatever, these will all be relevant there as well. There are some very basic terms which are pretty straightforward. So, for example, one would be the 52-week high and the 52-week low. So, it's exactly what it sounds like. So, during the year 2020, which was here to here, the 52-week low was the lowest price during that year. The 52-week high was the highest price, so it was just a little under 42,000. And the 52-week low was down here at about roughly 3,500. So that's pretty straightforward, and that, of course, is not necessarily, it doesn't necessarily have to be over the last year. It could be just over the last 52 candlesticks. In this case, though, it would still be the same. We're only a few candlesticks into 2021 as I record this. The low, the high, they're at the same spot. So basically, over the last year, the highest and lowest prices found. Pretty straightforward. There's also the bid, ask, close, and high. So the bid is what people are willing to pay for an asset. So you are bidding to buy it. And in this case, if you are bidding, you come in with a price, and I'm going to use very simple numbers. Let's just say you're bidding 5 for an asset. There's an ask, which is what they are willing to sell this asset for, and that asset might be 5.5. Well, in order for a transaction to be made, two people have to agree on a price. Sometimes they'll come back and forth to each other, so they may sell at 5.25. But more often than not, you'll hear a phrase something like hitting the bid or paying the ask. So if you are the buyer and you really want this asset, you're going to come up here and pay $5.50 for it, or 5.5 for it, and you're paying the ask. If you are the seller and you're aggressively wanting to sell, you might do what they call hit the bid. So you would sell it at 5. So the bid is just simply what you can buy it for. Ask is what you can sell it for. And here on TradingView, you can click on the watch list, and you can see there is pricing here. And notice how the prices aren't quite the same. And that's because there's a bid and an ask. And it's true with all markets. It's not just Bitcoin. It just happens to be the one that I have highlighted here. You could come to the DAX or the Nikkei or whatever. So that is always going to be the case. Sometimes you see zero spread. That's pretty rare, though. The reality is that's what makes a market. People either have to step up to buy it or step down to sell it. There is an uptrend, or what is known as a bull market, and that is clearly an uptrend. We are rising, we are going higher. That's an uptrend. There is a downtrend. So in 2018, when Bitcoin got to be so overbought and then sold off, that's a downtrend. It's also known as a bear trend. So bull is up, bear is down. There's, of course, sideways, which is really what it sounds like. It's just the market going sideways. A lot of times people refer to that as consolidation. So let me go ahead and go to a lower time frame. Let's go to a daily chart. So we've had a bull run or an uptrend, and then we just kind of go sideways. Well, sideways, consolidation, it's kind of the same thing, really. It's just essentially that the market had been rallying, had been bullish, had been an uptrend, and then you spend a little bit of time consolidating your gains. Now you can go up or down, but when you go up, that's a continuation. Pretty basic stuff here, but these are things that people need to know. So rally, consolidation, continuation. There is a couple of phrases, swing high and swing low. So let me go to the hourly chart. So a swing high means that the market swung high and then turned away from it. So that's your swing high. Just as this was a swing high back then, this is a swing low. High, low, swing low, start to rally. These are useful to identify trends. There's a high, there's a low, there's a higher high, there's a lower low. So that is an uptrend. Granted, it's not always going higher, but when you extrapolate this out to, say, like a daily chart, a weekly chart, it begins to look more like this. There is also a phrase known as a bounce. So a bounce typically happens after a significant sell-off. So right here, you can see that it sold off and then it bounced up a little bit. That would be the exact opposite of something called a pullback. A pullback is what it sounds like. We pull back from the trend and continue. These are healthy and they're very common. It's just the way markets move. You can't go directly from point A to point B without having some people stepping out or selling or whatever. There's a million reasons why somebody gets in and out of a market. There is the phrase go long. That means buying. Go short means you're selling. So up here at the swing high, you might want to short Bitcoin as we break down from there. Just as when you are consolidating, so we rallied and we're consolidating here. Now you're continuing on this breakout, and that's what it is called when you break out of consolidation. You might want to go long. There are two phrases known as averaging up and averaging down. These are pretty popular in the stock market. So really, as a general word of advice, you really don't want to average down. So averaging up is if you say buy it here and it continues to go, you make a short-term swing high, swing low, you break above the swing high, you decide to buy more. That's averaging up. You go higher, you buy more here for whatever reason. That's averaging up. That is adding to a position that's working. Now, unfortunately, and this probably comes more from retirement account and longer-term stock market advice, there is something known as averaging down. So let's say that you are involved in Bitcoin here and everything is going fine, and then suddenly it pulls back. You buy a little bit more here. It falls again. you think, okay, well, I'll buy a little bit more here, a little bit more here. Now, what this does, in theory at least, it's the same thing as dollar cost averaging. You'll hear financial advisors talk about that. Well, if you buy at 10 and you buy again at 5 and you buy again at 1, well, every time you buy at a lower level, it brings down the average price of all three entries from 10, in this case 750, and then in this case it would be somewhere near like 3-ish, maybe 4, somewhere between 3 and 4. That's because maybe you have one, for example, one Bitcoin, and of course these aren't real numbers, but if you buy one Bitcoin at $20, for example, and you buy another Bitcoin at $10, well, that's the same thing as having two Bitcoins at a base price of 15. As the markets move, for example, at $15, this would be $5 positive, this would be $5 negative, and it becomes a wash. It's your cost basis. The idea is that if you average down, then you can bring that cost basis down. Now, the problem with this is sooner or later you're going to average down and the market's going to keep going lower. So if you average there and there and there and maybe there, you think, okay, it's going to recover, and then there again and then there again, the market may not go to zero, but your account may be blown. In other words, wiped out before it recovers. So averaging down, never a good strategy. Unfortunately, a lot of people do it. It's part of human psychology. You're trying to make your position more profitable at a lower level. It can be like a retirement investment strategy. If you're going to buy like stock that you're going to hang on to for 30 years, that's a different scenario. But in crypto, that's not what you're doing. So those are some very basic terminology that you'll need to know. I encourage you to watch this video again, go through all of this, and then we will move forward in our journey together. In the next video, we're going to take a look at the best chart time frames for crypto trading. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, we're talking about the best chart time frames for crypto trading. So, unfortunately, there is no specific answer to this. I can't tell you, hey, the 15-minute chart is where it's at, and that's the only way you're ever going to make any money. It's not how trading works. However, there are time frames that are better for some people than others. So, for example, if you have a full-time job, a 5-minute chart isn't going to do much for you unless you plan on somehow trading while you're working. In that scenario, you might look at a daily time frame or a weekly time frame where you get a new bit of information at the end of the day or the end of the week. If you have all the time in the world to sit and trade, then you may look at a 5-minute chart. So really it's going to come down to what kind of time you can, or quite frankly, are willing to put into it. Now, there's basically two types of trading. Well, there's three, actually. There's day trading. So day trading is when you're in and out in the same day. You buy something, you sell it, or you sell something and you buy it, and by the time the day is over with, you're done. You're out of the market. There is swing trading. In swing trading, there's no clearly defined limit, as it were, but let's just say maybe 2 weeks. Most of your trades are less than 2 weeks. Again, could be shorter, could be longer. A lot of times a swing trade is like 3 or 4 days. So it really comes down to how you want to look at it. But the idea is, you can place your trade, you can get up, you can walk away. You have a stop loss and possibly a take profit order. So a stop loss is if price hits a certain price in the market, you get out to protect yourself from losing too much. And then you just get up and you go on about your day. And then the third type is more or less investing. You just buy and hold. And there's a lot of hodlers out there for Bitcoin who just buy and hang on to it. And really all they care about is that it goes higher over the longer term. Okay, so now that we have determined that, let's talk about something called multiple time frame analysis. And it is exactly what you think it would be. It is multiple time frames. So this is the weekly Bitcoin tether chart. And the first thing you should notice is it's in an uptrend. It's been going higher. So unfortunately, a lot of retail traders will step into this and they'll say, hey, look, it's gone too far, too quickly. I'm going to sell it. And that is a great way to lose money. It's not saying that it can't be correct. It's just that, you're better off going with the flow of the river. So in this scenario, you might say, hey, it's gone too far too quickly, but it's obviously very bullish. There's a lot of people buying it. So I want to buy it. I want to buy it when it goes on sale, when it drops down in price. So this line chart, that's what this is. It's just a basic chart like you've probably seen a million times in your life. Shows that we go up, we go down, we go up, we go down. We recently had a pullback, and then it seems like the bargain hunters came in and started buying. So I'm going to go back to the candlesticks. So this is the weekly, so it tells us up. So let's go to the daily. Really not telling us anything different. You wouldn't expect it to. But notice how on the weekly time frame, on that weekly time where we shot up and then we pulled back and buyers came back in. So if you saw that it had gotten a little expensive, but you wanted in on it, then you drill down to the daily and you look for, and we will most certainly go into this throughout the course. You look for candlestick patterns, indicators, support and resistance, something like that. An area where you want to buy it on value. And that's what people did down in this area. But maybe you want to really drill down for some granularity, and you go to the 4-hour chart. Well, while you don't know exactly why at this point in the course, but this was, and so was this, these were both really good places to start looking to buy Bitcoin. You could go down to the hour and get even more granular. Now notice that even though we're in an uptrend on the weekly chart, we were in a downtrend right here. This is where traders get into trouble. They try to get too cute and short this, meaning sell it. They're trying to profit on it falling. And there's nothing to say that you can't do that. But look at all this pain you had to endure just to get back down to here. And then we haven't been below there since. So although it was in a downtrend there, again, you just zoom way out or you go to a higher time frame like the weekly, very clearly in an uptrend. That has not changed. And then, of course, if you are a day trader, this is a 5-minute chart. Now, notice how many times it has pulled back. And of course, I'm zoomed way out. But remember, in the context of everything, we're still in an uptrend. So you are looking for opportunities to buy. I cannot stress that enough. If there's only one thing you take away from any trading education you get, don't fight the market. So let's take a look at, let's do Ethereum. And let's go back out to the weekly chart. Clearly in an uptrend. Just been going straight up in the air. The daily chart, very bullish. Looks like it's ready to extend. It's going higher. 4-hour chart, you can see that we kind of zigzagged on the way back. And every time it pulled back in the uptrend it was in, there were people willing to pick it up because it was a bargain. So let's go to, say, the 15-minute chart. Well, again, you can see that if you just buy, the idea is you buy a bit, you take your profit, you let it come back, you buy more, you take your profit, etc., etc. You can keep your stop losses smaller, so your losses are smaller. In day trading, that's the advantage. You're not just buying it and hanging on to it. So let's take a look at Zcash as well. And again, go back to the weekly chart, and you can see that this thing plummeted and now is starting to rise again. So that has implications of what to do now. Well, that was clearly a sell signal, but notice how the low here, the high here, the low here, which is a little bit higher than there, and a higher high. So we are changing the trend. We are starting to grind higher. So when you get a trend, you want to see peaks and valleys. Remember the swing high and swing low? Swing low, swing high, swing low, slightly higher than the one before it. Swing high, definitely higher than the one before it. So it's showing a proclivity to go higher. So in this scenario, you might go down to the daily chart if you're a swing trader and you look for a buying opportunity, expecting to retest the highs, for example, could be your thesis. There's a pattern there that would have had you thinking that. Before that high, you would have had thinking here at this high at the very least. If you go down to, say, the hourly chart. Now, there are multiple pullbacks, but notice how we just can't get as low as the time before. And this is where day trading becomes difficult because it becomes very volatile, meaning very choppy. And let me go ahead and make this a line just so I can zoom way out. And you can see it's been very strong as of late, right? But again, you go to the daily and then the weekly chart, and we've just kind of been all over the place. So you have to be very cautious. When you change directions like this, it does tend to be very noisy, and therefore day trading becomes much more difficult. Again, you want to find an easy trend like in Bitcoin or Ethereum. Zcash is starting to go that way, but clearly you're going to have messier trading. So always know your trend. Always know your higher time frame trends, be it monthly, weekly, daily. And if you're a swing trader, then you're probably going to trade like off the daily or maybe the 4-hour chart. Now, if you're a day trader, you might do 5, 10, 15-minute charts maybe. Well, if these are all going higher, then you won't be a seller. You'll just look for buying opportunities. And of course, we'll show you the setups down the road. Look for the higher time frames, follow them. More often than not, it will work out in your favor over the longer run. In the next video, we'll take a look at how to trade based upon support and resistance levels, which are the basis of any trading system. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, we'll talk about how to trade based upon support and resistance levels. So the first thing that I would bring up is that the platform I am using is called TradingView, and it is freely available at tradingview.com. It's a favorite of traders around the world. You have the ability to trade a whole plethora of instruments, depending on which broker you have it attached to. And if for no other reason, people use it for analysis just because the analysis is so good, and then they execute the trades on whatever platform they are using through their brokerage. So in front of you, I have the platform itself. You can see I have a line chart of Bitcoin US Tether, USDT, 4 hour. So that means every bar or every candlestick is what happens over the course of 4 hours. The line, it plots the close every time, at the end of 4 hours, it might be there, or it might be there, it might be there, up there, etc. So support and resistance is the first thing you're going to need to be able to identify if you are going to use any type of technical system. Support and resistance is the basis of pretty much everything that you do. So support is exactly what it sounds like. It's where the market is supported. So for example, at a specific price, here on Bitcoin, you can see 30,000. If I see the market test this area, but continue to find buyers and not be able to break through it, that is considered to be support. And as I'm sure you can guess, resistance is the exact opposite. So it tries to break through and it can't, and that becomes resistance. Now, what causes this is a lot of volume, a lot of buy orders in this area, or in this case, sell orders. So much that the buyers can't overcome the selling orders, or the sellers can't overcome the buying orders. Every time they push it down, the buyers come back to pick it up. The platform has a whole host of tools on these submenus here, but on this one, trend line tools, you'll see horizontal line. You click on that, and you just place it on the chart wherever you want. You can see there's a little bubble there in the middle, and you can click and drag that, and you can adjust it to where you want it to be. And just plop it on the chart like that. You can right click, go down to settings. You can change the colors, the thickness, or the type of line. You can add text to it. You can change the price. And then the visibility just means that if you want to show it, like, say, only on the daily charts, but not on the monthly charts, then you can click or unclick that. So pretty straightforward stuff. So what you're looking for support and resistance, the first thing that I would say is, let me go ahead and remove this. So let's go to the daily time frame. So if you look at a chart, you can see that there are a couple of areas where buyers or sellers seem to be very active. So for example, right here, you can see that buyers came in and picked up the market. It tried to fall, it rallied, it tried to fall, it rallied, tried to fall, etc. So when I go to settings and I go to coordinates, if I put in 30,000, this gives you a good baseline for an area where the buyers may be particularly aggressive. Now, why is this important? Well, this is important because you will find that the market remembers these areas for support and resistance, meaning that, like, when we get back there, the buyers came back in. Obviously, there's a lot of trading volume interested in the 3,000 level. So let's go ahead and change over to something else. Let's make it Litecoin. Tether. And you can see it's a little bit more of an active chart. And this sets up right here. This is resistance. You can see that we tried to get above it. But I want you to notice something. And I'll go ahead and set the coordinates to 95. Gives you a nice baseline. I want you to notice something, that we tried to break above there a couple of times. Obviously, there was selling pressure there, but notice how once we finally did break out, when we came back, there was support. there is a saying that once was support becomes resistance and vice versa. I want you to think of it like this. Think of a high rise, and then think of all of the floors and how they are constructed. So if you take the stairs on each of these floors, if you're on the first floor and you take the stairs to the second floor, this ceiling, which was resistance, becomes support now. Do it again, the ceiling, which was resistance, now becomes support. If you drop down, well, your support had been here at the floor of 3 is now the ceiling of 2. It really works like that, and I'll show you. Just take a look at these lines as I lay them out. Okay, so you can plainly see that this was resistance. It was resistance a couple of times, and then it broke through, became support. This became resistance, broke through, became support. This resisted a couple times on this candlestick. We finally broke through, found support here. Broke out to the upside. It did have a little bit of reaction there initially, but then we pulled back to find support. We rallied to find resistance, support, and now it's acting like it may roll over and offer resistance. These are not accidents. These happen for a reason. These happen because these places are where all of the larger order flow is. And it is crucial to trade at these levels instead of trying to basically just trade wherever. And the main reason for that is that you want help along the way. You don't move the market. So, for example, you can see that there's a little bit of support here right around 227. So I'd say probably we could call that 2.25 in Tezos. So notice something. We come down there, the buyers come in. We come down there, the buyers come in. We come down there, the buyers come in, and we bounce just a bit. Notice how the sellers came in there. We did break through it, but the sellers came in there, buyers come in there, sellers come in that area. So it increases the odds that you are trading with the market itself. And by doing so, you increase your odds because you have other people in the marketplace moving right along with you. So if you take a trade here, if you decide, hey, we're rallying right here is where I want to take a trade, notice how you have to go all the way down here to find the buyers before seeing the market turn back in your favor, when you could have just simply waited for a reaction to the same level again. That way you don't have to put up with the losses. It doesn't mean that it works 100% of the time. Clearly it does not, but it works most of the time. You need to think of it in the sense of where the big money is trading. Bigger players than you are trading at these levels. Furthermore, you also need to keep in mind that it is not to the exact penny. So $2.25, it doesn't mean that if it hits $2.24, it's broken through support and it's going to just fall apart. You use this as a guidepost. You look for technical confirmation. Some of the things that we will be talking about in this course and then try to find them happening at these levels. So, for example, one way to think of support and resistance is like a shooting range, an outdoor shooting range. An outdoor shooting range typically has an earthen mound. And why does it have an earthen mound? Because if it is like a piece of metal or even concrete, you might get a ricochet. Well, that's not how this works. It can work like that occasionally, but they will use a target and then they will use the earthen mound. And depending on the caliber of the gun and a whole host of other factors, it may barely penetrate. It may penetrate pretty deeply. So think of it more as a range. You need to see whether or not it breaks through to the other side in order to consider this flipped, your support being flipped to resistance, for example. And really the best way to do that is to wait for the candle or the bar to close. And we will go through using those as well. So, for example, we, on this daily chart, Tezos broke above, what I would consider to be the 320 level on this candlestick. And we've pulled back, and notice how it looks like we are trying to find buyers here again. That's what you're looking to see. And of course, there are multiple ways to go about this. It's almost infinite. But this is going to be the baseline for how you trade. You also would be better served to pay attention to longer term. You can look at a 5-minute chart and try to find support and resistance areas. But they don't mean as much as they would on like a weekly chart. And that makes sense because it takes a lot more time to make weekly trades appear on a chart as far as reactions than it does a 5-minute chart. This can just be simple noise. Doesn't mean it can't be done, but you have to respect the fact that it's not as relevant. A lot of times when you take a trade, on a breakout, and then you see that as resistance and you pull back and you see it as resistance again, well, if you take this trade here, a lot of times that's your target. Or if you take this trade here when it pulls back, then your stop loss is halfway between the two and your target's up here. Or you can also do a type of trading where you recognize this as resistance. So once you break through this, wherever your stop loss is to protect your account, once you break through this, then you lock in some profit. So you're through here. And then if you break through here, maybe you lock in a little bit more. And then once you break through here, you lock in a little bit more. And then finally the market comes back and takes you out. But it's a way of letting the market tell you when it's time to get out of the trade. Again, multiple, just unlimited ways you can use support and resistance, but you need to know where the market's going to go, or in this case, where it's probably not going to go. It's probably not going to break down in this region here. And it didn't. It went higher. Knowing where it's not going can be just as valuable as knowing where it probably wants to go. So in the next video, I'll show you some examples on how to use this support and resistance concept to make profits. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, I'll show you examples about how to trade support and resistance levels. So in front of you, I have the Bitcoin chart, and it's a simple line chart. It just shows you, it adds to the line at the end of every day and draws a line like you have seen in multiple other charts in the world and, far beyond finance. And so the question is, how do we use support resistance to our advantage? Well, the first thing is you click on this horizontal line tool. And if it's not horizontal, then it may look like a trend line. Just drag it down after clicking on the submenu. And we look for a place where the market seems to either fail to get above or fail to get below. And I also like to look for round big numbers. I start there. So instead of 62, whatever that was, 6,000, kind of take a look at it. And you can see that obviously they were struggling to break it below there. Eventually they did, and things got rather ugly for a while. So Bitcoin struggled to get above there. So let's take a look at 4,000. We'll click on that. And then let's take a look at 9,000. And so on. So I will go ahead and mark these at places that I think might be important. Notice how we shot straight up there and then fell. So that would be a resistance. Notice how it was support all the way back here. This is December of 17. This is June of 2019. So you can see 18, 19 months later, the market remembered that area. Now, in that particular case, I suspect that people that bought here saw it rise and then saw it collapse. You know, that's a massive collapse. That's a $10,000 loss per coin. What happens is people hold on to those. They don't want to get rid of them. And then when they get back to that area, they are more than willing to sell to get out at break even. Otherwise they would have to realize massive losses. So notice here, all the way through here, let me go ahead and draw that line here at 7,000. Notice how it affects the market a couple of times. And then we continue to go higher. We break above it. This 9,000 level comes into play again. 13,000 offered a little bit of resistance. We didn't quite get there previously. And then since then have taken off. So this is 20,000. This is 30,000. And this is 40,000. So there's a certain amount of psychology involved in some of these figures as well. There's nothing particularly special about 30,000 other than the fact that it's 30,000. It's a large round figure. But notice how 20,000 matched up with the highs here. That's where it closed. It actually reached towards 20,000 on that daily chart. And if you don't believe me, there's the bar chart. You can see it actually got higher and then pulled back a little bit. And we'll go into bars and candles, or specifically candles later. They tell you the same information. So how do you trade this? Well, it's pretty straightforward, really. You are looking for areas that matter. So again, let's make sure that we are at an area that matters, and then we can place a trade. So, for example, you can see that this was an area that the sellers could not break down below. People were willing to step in and buy here. But I want you to notice how, for starters, the market had been falling for quite some time. And then I want you to notice how this area, 7,000, offered support. They came in a couple of times. But notice this. Notice that every rally, every time they tried to push it higher, they struggled a little bit. And we finally broke through there. And this was your next kind of point of support. And then whammo, right there. That's where you really started to see the market take off. And it had been a grind lower. So that's the first thing you need to keep in mind. When the market behaves like this, you don't want to be a buyer. It tells you that there's something wrong. There's something seriously wrong with the price, and it's going lower. So with that in mind, this was a pretty straightforward trade to take. You short Bitcoin. Where are we going? Well, this is an area that caused some noise previously at 4,000. So that makes a perfect target. Makes perfect sense. with that in mind, you can also take a look. Like 5,000 caused a little bit of a reaction. So what I like to do typically is I like to have a target ahead of time, if at all possible, unless it's a long-term kind of investment. You take the trade once you are below, once you close on the day, in this case, the daily. It doesn't have to be daily, it could be hourly. But on the daily, once you are below 6,000, you sell, you aim for a target. Where's your stop loss? Well, your stop loss generally is going to be where you broke down from. So that would be your initial stop loss. You hit your target, that's a pretty straightforward trade, right? Some time goes by, and you can see that 4,000 continues to offer resistance. And then we break out to the upside. So once you get a strong move to the upside, it's very simple thought process to put your stop loss just under 4,000. In this case, maybe 3,900. And you aim for the area that was previous support. Should be resistance now. And that's exactly where it went. Now, it comes down to the individual trader, but a lot of times what they will do is they will look for support, some type of area in the middle of this move. 5,000 makes sense. It's a large figure. It'll attract a lot of attention. So they will move their stop loss to there, and they will be out of the position if it turns around and falls from 6,000. Now, you have to be willing to accept the fact that you may give back some of the potential gains. In this case, it worked out quite nicely for you. Not only did you hit 6,000, but you hit 7,000, pulled back a little bit, found that to be supportive as well, and then took off. So at this juncture, you could have your stop loss just below 6,000. Now, you have absolutely a free trade at this point, and did here as well. Now you can really let it run. You take your lines. You see that we are breaking higher. You move your stop loss just below this area. You let it run. It breaks above 9. Keep in mind, these are all, until we get to about 13 and 20,000, like after 30 or 20,000, then that's where we have new lines. So these are all lines that you would have been aware of. At 9,000, on a break of that, you could put your stop loss behind the most recent pullback, then put your stop loss here at about 9,000. Your stop loss is at 9,000, and boom, you get taken out here. So that was a trade from 3,900 to 9,000. And, at one point you made even more profit. You could have been a little bit more conservative and move your stop back up when the first pullback occurred, if that's, if you didn't wait for it to break out. But worst case scenario, you're talking 3,900 to 9,000. Now, 7,000 had been important more than once. So as you break above there, your stop loss, you're a buyer, your stop loss 69 or 6,900-ish. You can see we take off, we hit the target, the 9,000 level again. You can move your stop loss above there. It pulls back just a little bit and continues. That's a good sign. Boom, you get taken out. You did run into a little bit of trouble here and you pulled back. That's fine. You still made something like 2,000-ish, maybe 1,900 on that coin. You can also see, you can make an argument for, well, this is probably going to be resistance because that's where we sold off from. But nonetheless, it all works out the same way. So you can see how this is like a roadmap. So the question then becomes, what happens if you take a trade and it turns around and breaks down against you? So let's say you take this and you put your stop loss somewhere around 8,800 and it comes back and it takes you out. Well, what happens is your stop loss works and it protects your account from a big loss. You see the same action, you get involved. This time, your trade works and you go racing higher. And you hit the 13,000 target. And at that point, you're looking at 20,000. You move your stop loss up. You move your stop loss up. 30,000 you suspect could be important for no other reason than, it's 30,000. Like I said, some numbers are just big figures that people pay attention to. And so on. And here we are at 40,000. We'll see how that plays out. Pretty straightforward, really. if you think about it. Ethereum, same situation. You could go through and draw lines, and I will do that right here. There's a lot of interest in this area here. So let me pull up the horizontal line. There we go. So let's call this 275. And you can see support, resistance. So it's certainly a line that the market paid attention to. See what 400 has to say. I like that. That looks good. $600. This is another thing, too, that you will pick up on in some markets. Over time, you'll learn that there might be a pattern. So in Ethereum, as I'm drawing this out, it's becoming obvious that it's about a $200 range between major support and resistance. Now, the one thing that you need to be careful about with support and resistance is to not overdo it. Sooner or later, you're going to come across somebody who suggests, there's daily support and resistance, there's weekly, there's monthly, there's 5 minutes, there's 15 minutes, blah, blah, blah. And that is true. The problem is you'll see some traders go through with the monthly, weekly, daily, 4-hour, half an hour. And by the time they're done, the entire chart is nothing but lines. You do have to kind of focus on the important ones. And I wouldn't be too hung up on 5-minute support and resistance. What makes more sense is to use daily support and resistance on a 5-minute chart. That way you can let the trade run a little further. That's just a little bit of a hint. So in this case, the market had been finding support. You take a trade. You have no idea where we could go except for maybe somewhere up here around 600. But as the trade develops, you notice there's support at 400. So when you take off towards 600, that's where your stop loss is. You break above there, you go to 800. That may or may not meet anything as far as criteria is concerned quite yet. But you notice we pull back, so you would expect some type of resistance there. We come back to the support area. You may or may not still be in the trade, depending on how tight you left your stop loss. Break out above 800. You put your stop loss a little bit below it. Pull back ever so slightly and then break above 1,000. At that point, that's a large psychologically important number, so you figure it's going to act as something, and it does, and you probably get taken out. It's pretty straightforward. We bounce around a bit, we rally. The most recent high is much less, and we break support. So that is a negative sign. So you'd be a seller. Stop loss just above the 1,000 level. You would target this support or resistance level for support. Once you get through there, you probably get taken out. However, you'll notice that when we rallied again, we could not break above 1,000. That's a good place to short, to sell it. Put your stop loss in the same area. You're aiming for this area. You didn't really break through yet, but once you finally do, you put your stop loss in the same area and you break down. Stop loss above there. You break down to this one. Probably not enough to get overly excited about moving the stop loss up too much. The question is, do you want to put it up here? Maybe. Or maybe just above 500, just because it's a large number? Maybe. Either way, you get taken out. Now, something that you may or may not have picked up on is like this trade here. So we'll call this trade 1. Let me redraw this. We'll call this trade 1, this short trade 1. And that was when we broke through support and you aimed for this. And you got below and you got stopped out. Well, back up here, we failed again. So this is trade 2. We came down here. We didn't really break through. Bounced slightly. And then broke down and finally got rid of the 800 support level. That's not that uncommon. you can shoot through support and resistance. You clearly can in one shot. But notice sometimes, more often than not, it takes a couple of attempts, and that's because this is an area that matters. And when you see a couple of attempts and then finally breaks down, you almost always see that when we return there, there's a reaction. So that means there's a lot of order flow going to break this down, and there's a lot of support. There's a lot of buying there. And once it finally gives way, that becomes a nice trending trade. It doesn't always just break through right away. Keep that in mind. A lot of times it takes several attempts, but those several attempts, that's tenacity. That's the market telling you it wants to continue fighting and breaking lower. So pay attention to things like that the market is continuing to attempt something. That generally means that sooner or later it's going to accomplish it. In the next video, we'll take a look at how to trade based upon Fibonacci levels. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, I'm going to talk about how to trade based upon Fibonacci levels. So, one of the most common tools that a technical trader will use is the Fibonacci retracement tool. And you can see that there is a submenu here. It normally looks like this. It's got this little pitchfork tool. You click on the arrow, you go to Fib retracement. So that's the symbol you're looking for. Now, a Fibonacci retracement, I'll go ahead and put it on, and I'll go through this here with you in a minute. You can see it's on TradingView. It's an array of colors, right? And there's levels here with decimal figures. Now, Fibonacci is a mathematical sequence that Fibonacci, a mathematician in 13th century Italy, had come up with a ratio that seems to repeat itself in nature. The curvature of rivers, nautilus, symmetry of the face, crop, as far as crop growth, all kinds of stuff measures a repeatable pattern. And Fibonacci sequence is basically like this. So you take two numbers and you add these two together and you get 2. And then you take the second one and you add it to this one and you get 3. And then you take the second one of these two and you add it together and you get 5. And then 8. And then 13. And so on. 21. So the significance of this is he found symmetry throughout nature, and it helps with pattern recognition. So traders, for a long time, long before Fibonacci sequence came about, used to use the 0.5 rate. This is 50%. So if a market rallied, say, $10, they would pull back. The market would fall, pull back, and about $5 they would try to get involved based upon this impulsive potential uptrend, right? Trying to find a little bit of value. So although 50% or 0.5 or 50 is not a Fibonacci number, it is included in the Fibonacci sequence for that reason only. There's something called the golden ratio, and that is 1.618, or sometimes it's written out as 61.8%, 161.8%. And this is a ratio that shows up time and time again in nature. Really, at the end of the day, what you're looking for is repeatable patterns, right? So let me go ahead and show you how this is used. So we click on the tool and you look for a swing high and a swing low. And if you remember from the first video, I talked about swing high and swing low. The swing low on this chart is down to here, and the swing high, depending on when you were looking at this, but let's just say up till now, is here. So each one of these levels suggests that it might be an area where the market pulls back to. and you may look to go long. You may look to buy it. It's a retracement. You're looking for it to retrace to one of these ratios. The most important one is the golden ratio. That's 61.8, but 50% and 38.2 are very important as well. And in fact, for myself, I don't use 23.6, nor do I use 78.6. Some traders do, some traders don't. It's entirely up to you as to how you choose to do it. You'll notice the 1.618, that is a potential pullback as well, where you wipe out the trade, and if you turn around and you break down and you destroy this uptrend, that is a potential target, and so on. I can go to like the weekly chart, and you can see just how much of a move that would be. So going back to, let's even go to a 30-minute chart. This gives you, some potential support and resistance to work with. But let's say you're trying to use this as the markets move, right? So you're going in, and then you see an uptrend. And here's the thing. You feel that you've missed the move, but you would like to participate. So you look for that swing low and that swing high. So in this case, you click that tool and then drag it up to here, to that level there, and you draw it across. And what you will find more often than not, there is a Fibonacci retracement level that comes into play. And in this case, it is that 61.8 level. That's the basic of it. What you'll do then is you will take the trade on a bounce. It continues to go higher. You put your stop loss behind the Fibonacci level with an eye on the other Fibonacci levels. Most of the time, what people do, though, is they look to recapture the move. So you're capturing 61.8% of the move. Your stop loss goes underneath here, and you just let it rip. Now, there are some pros and cons to using Fibonacci. One of the biggest pros is that so many people use it. It's very common for people to use it. There are people who their entire trading routine is based upon Fibonacci. So that is something to think about, However, the cons are, does it really have any type of natural pattern, or is it more or less just self-fulfilling prophecy? And the answer to that is, it really doesn't matter. It doesn't matter if there's anything magical about the 0.618 ratio in trading, as there is like in determining the way crops grow and such. What matters is a lot of traders out there believe it. So that being said, there's no point in fighting it, right? Now, it works. It's a fractal type of thing, so it works in various time frames. So we tried to rally here, and then we broke down. Again, it rallied after breaking down. You missed the move, and you want to try to capture that. So you look for a logical place to get involved, and you see that the 61.8 level did offer resistance, stop loss above there, and you continue to look for the trade. And this was the same thing. I'm just dragging the swing high down to the swing low. A lot of times you will see these things kind of match up with support and resistance as well. And that is actually a great thing. So this support line here, let's put it at 31.75 for now. Although it might actually be 32. But as I draw this again, notice there's your 61 and there's your former resistance line, now offering resistance again. Something to pay attention to. just as you can see that this resistance area caused the market to pull back to this support area. So let's go ahead and draw these lines again. So that in and of itself would capture your attention as a support and resistance trader. Add a Fibonacci retracement to it, and then you've got a couple of different things. At that point, you're talking about something known as confluence. Confluence is when you have a couple of different reasons to take the trade. Notice how it's right around the 50% Fibonacci retracement level, giving up half that traders finally push to the upside. And this works in pretty much any market, pretty much any time frame. So, like I've got Monero here, and let's go down to the 5-minute chart. Again, these don't mean as much on the 5-minute chart. They are a little bit more easily broken. But let's go ahead and take a look. That support showed up again. That's support and resistance in this area. This is an obvious area where we came back, we tested, we found a little bit of support right here at the 38.2. Now, the thing is, the less you pull back, the more likely you are to have an extended move. And you can see we did extend it. So, for example, if a market pulls back to 61.8, say this pulled back to here, then that is a little bit deeper of a correction, and that means there's a little bit more thought going on to it. However, if it only pulls back to 38.2, then that typically means that there's a lot more excitement to get in. Traders are not waiting as long to start buying, and that should be reflected in the trade. So, as far as the Fibonacci levels, if you wish to adjust them, you draw one on the chart, and then you right click and go to settings. Click on style. You can change the colors. And for simplicity, I am going to remove what I consider to be the lesser levels, and I'm going to extend lines to the right. You can always go apply defaults to get back to the way it was. You can save this as whatever you want to save it. So click OK, and you can see it's changed completely. I've got 61.8, 50%, 38.2. So again, we rally from here to here. We pull back to the 38.2% Fibonacci retracement level, and we take off. So that's a 38.2% fib pullback. I know that typically means you're going to run, so you might want to give it a little bit more time. So in the next video, I'll show you some examples of how to actually use this bit of information. But this was a video I wanted to, familiarize you with Fibonacci retracement levels and, how to kind of go along with, because you will almost certainly, even if you don't use them, you will certainly run into a lot of that in analysis, through your trading career. You need to be aware of the fact that when they line up with support, for example, if you see support here, well, you might say, okay, well, is that a fib level as well? Well, yeah, it is. Basically, it's 38.2. That gives me another reason to think that maybe this is worthwhile to trade. So in the next video, we'll go through a few examples. In this video, we're talking about real-life examples of Fibonacci retracements and extensions. So extensions are a little bit different in the sense that it's not, point A to point B and where do you get in on a pullback. This is more like where can you go as an exit. Uses the same mathematics. You could pull it out of the same menu as the fib retracement. You could do the trend-based fib extension. So, for example, if you saw this move and you wondered, okay, well, where can we go? You could click on this, drag to that move, pull back. And then what happens is 100% of the move shows up, the high point of the move. You pull back and you're like, okay, I want to get involved. So where are some targets? Well, the 1.618 is by far the most common target. You can see that's exactly where we eventually ended up. But there's 2.618, 3.618, 4.23, etc. Now, this is just a simple guide as to where you could go later on down the road. I will say that fib extensions are hardly ever used for anything other than short-term day trading. Some people like them, but they aren't as widely followed. So the problem that you have with it is, how I had discussed previously, there's no real reason to believe that Fibonacci works other than people believe it works. So it's self-fulfilling prophecy. Because there are other types of Fibonacci. There's like Fibonacci cycles, Fibonacci time cycles, and probably 4 or 5 others off the top of my head that I can think of. But the reality is retracement's pretty much what people use. The extensions, like I said, they give you an idea of where you could go. So like on this 30-minute chart of Ethereum, if you missed this trade, well, you can see that we pulled back and we hit 1.61 before pulling back from there. This is, like I said, it's more or less a short-term trader's type of situation, because the reality is by the time you get all the way up here on an extension, on like a weekly chart, the fundamentals can change and the entire attitude of the market can clearly change from there. So take that for what it's worth, but you can see how it would have worked here quite nicely. You got involved perhaps on this pullback here on support, and you're looking at it, you're like, okay, well, I want to see it where can we go longer term? This is a half an hour chart, so it didn't take that long to get there. It was a handful of days, maybe about 2 weeks. Okay, so now that I have explained that, let's take a look at Fibonacci retracements. Like I said, is much more common. So the first thing that I see is, notice how we have rallied significantly in Bitcoin. This is the hourly chart all the way up to 42,000. So a lot of times what people will do is they'll see something like this and they'll say, I want to get involved, but I don't want to pay up. This is like going to the store. If a TV is selling for, say, 500 euros, or $500, whatever your local currency is, if it's suddenly $750, you don't want to run out and buy it. You want to buy it when it's 300. And that's essentially what you're doing here with a Fibonacci retracement. So if you're patient enough, you wait at the very least for the first Fibonacci retracement level. And there is the 23, but again, not as common. 38.2 is much more common. And you can see it did react to that. But the 50 is even more important in the 61.8, of course, is the golden ratio that everybody likes as well. But the 50 is very popular. And you can see, and we'll talk about these later, but this is a double bottom. This means that we had approached an area, tried to break through it twice and failed. Well, it should not be a huge surprise that if they can hold it a couple of times, that we have rallied. It's pretty straightforward stuff there. So let's go ahead and clear that. And let's take a look at a little longer term chart. So this is a 4-hour chart. Now, this last leg up, that's not really the swing low. So you need to really kind of pull back here, and you can see that the 38.2 got hit. Not a surprise that we ran into a little bit of resistance here at the top. That's pretty common. But notice how we reacted pretty quickly. That's a sign that we are going to continue going higher. So in this case, longer term, maybe you do want to look at a Fibonacci extension. So on the daily chart, you can see, this is going to show us the same thing. We could even go further. And it doesn't take a whole lot to imagine that maybe the 23 held there. But let's get rid of that. And let's take a look at the monthly chart. And that's going to be straight up. But you could, at least in theory, based upon the fib extension, pull this out. And then if you go over here, this side of the chart, you can shrink the range by holding and dragging. So here's the thing. Assuming that this is going to be the high, in theory, your target is roughly 60,000 and then 95,000. The problem with that is there are so many different things that could come into play between now and then that it is really difficult to get, that kind of into the market to the point where you are simply going to hold on for that kind of move. It's very rare that you can do that. And with something as volatile as cryptocurrencies, probably not too wise. So again, that's why I would stick to extensions on short-term charts. So one way that a lot of people like using Fibonacci, and I have to concur with this one, is, you've got this move here. And again, there's the 50%, right? That we had just talked about. But what happens if you draw another from this pullback, this impulsive move? And what you'll get is a 61.8 at the same level. So that's what is known as a confluence. You have a couple of different fib levels that people are paying attention to. So there are some people that will look at this in the prism of this was the last impulsive leg higher. So I want to draw a fib there. There are the longer term ones that will look at it, and you can see they all kind of come together there. So that's exactly what you want to see. That gives you double confirmation. Again, there's no 100% guarantee, but it obviously gives you better odds because you have different groups of people looking at the same thing. And that's one of the best ways to trade, right? One thing that I would warn against is trying to use Fibonacci for counter trend moves. So for example, we fell here pretty hard, right? In Bitcoin, and then bounced significantly to the 50, but we didn't really go that far, and just the traders got wiped out. And, they tried that. And the reason being is the entire trend was starting to turn higher. So Fibonacci really only works with the trend. And to be honest with you, that's going to be true with most technical analysis. That's not solely a Fibonacci thing. Now, here on Ethereum, we can use short-term charts as well to look for trades. So let's go back to the fib retracement. You can see this is clearly a swing low. And we rallied here and pulled back. Well, here's another thing that you will want to look for. There's support there anyways. You can see that it had been supported multiple times. So with the 50% or 61.8% Fibonacci retracement level and that support level, it's kind of hard to think that it would have been a bad trade. Even on a 15-minute chart, you can see these things kind of come into play. So, again, this is confluence. We want as much confluence as possible. We want as many reasons to take a trade as humanly possible. There are other indicators that we will go through, and they will also pile onto this. But at the very least, you want to trade with the trend when you're using Fibonacci retracements and extensions, but that goes without saying. You want confluence. So in this case, I showed you an example of where we had two fibs, a 61.8 and a 50 tie together. But you could also use other indicators, and we'll talk about those later. And then, of course, you want to have a plan. You want to have a point where you say, that's it, I'm out. So let's talk about that. Here's a fib pullback to the 50% Fibonacci retracement level. A lot of fib-based traders would just put their stop loss behind the Fibonacci level underneath it, with the thought process of it either holds or it doesn't, right? Now, if you want to use your extensions, you could lay this out and recognize that the market is trying to get to 1861 based upon that. Again, though, a little less reliable than retracements. So the extension, I use that in short-term charts typically, and to kind of complement other fib-based strategies. But when you look at this, you can see it was a nice setup, and you could have just put it on the other side of the fib. Some people will even take it, your stop loss, that is. Some people will take that protection order, and then once we break above and we come back and we test the next fib, they'll put it right here. They'll just move it up right along with it and kind of let the market, we've broken above here, you might put it right here, kind of let the market tell you when it's time to get out. It takes a lot of patience. This was over the course of a couple of weeks. But really, the less you trade, the more money you're going to make anyways. That's generally the case. It's far too easy to overtrade, so I would warn against that as well. So pretty basic stuff. There's not a lot to it. You just have to make sure you're using swing highs and swing lows. Like I said, you just take the swing low in the case of an uptrend to the swing high and click it there, and you can see it'll lay it out for you. And remember, there are other levels, but I broke it down to the three that matter by far the most. Once you start talking about like the 23 and 78, it's a little esoteric. Typically what happens is, so when you get the 61.8 broken to the downside, not always, but typically that's a bad sign. So I'll pull up an hourly chart of Bitcoin, and you can see that we do kind of follow the trend all along. But if you are trying to short this market for whatever reason, there's absolutely no reason to be short of this market. But if you were on the other side of this trade, once you're past the 61.8, you're in trouble. Your first sign of problems were up here, and now you're trying to take off beyond that. So that's why I don't like the 78. Generally, if you're going to give up roughly 2/3 of the move, you're going to give up the entire move. That's just an observation thing. Statistically speaking, once you're beyond half the move and then 61.8, you're closer to the entry, meaning closer to losing money from the entry than you are making it. So it's time to cut your losses and move along. And there are enough Fibonacci traders out there that you will see them behave that way. So here's one here, and it looked really good for a while, but notice how, and over the longer term, it is against the trend, but notice how had you taken this, at first, the 50% held, and it looked like you're going to be okay, but the fact that you couldn't reach the highs again, that was your first sign of trouble. So in a way, Fibonacci, a failed Fibonacci return to the 100% in and of itself is a little bit of an early warning signal. I mean, there was still plenty of time to bail out with a profit on this. You know, this is an hourly chart, so you're talking 2 or 3 weeks, and then you just get blown out. So that's something worth paying attention to as well. You know, again, trading with the trend's really the only way to go. It makes your life so much easier. Even if that means you have to sit around and wait for the trade to set up. That's something that, unfortunately, a lot of traders don't have the ability to do. So in the next video, I'll take a look at an indicator known as the Bollinger Bands. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, we'll talk about how to trade based upon Bollinger Bands. Now, Bollinger Bands are a very common indicator used in various markets around the world. Pretty straightforward. Really, all they do is they measure volatility to give you an idea whether a cryptocurrency or an asset in general is overbought or oversold. It's based upon, if you remember statistics, 2 standard deviations from the mean. So basically the idea is off the top of my head, 97-ish% of all numbers fall within this distribution. And then once you get outside of this range, the idea is much more likely for the market to return closer to the median. So if you remember the bell curve. Pretty straightforward, and it is not a difficult indicator to use. There are multiple different strategies, though. So come up here to the Indicators and Strategies button, and you can see on the built-ins, it's actually right away. You can see Bollinger Bands. You click on that, and you'll notice, let me go ahead and zoom in a little bit. You'll notice that, at least on TradingView, it is filled in. Sometimes it'll just be 3 lines, and you can change it to that if you would like. That's fine. But this is 2 standard deviations, meaning that it is more than twice as far from the middle line, the average, than is typical. This means that you are 2 standard deviations lower than the line as is typical. So this is a reversion to the mean type of scenario. The middle line is the 20 simple moving average. So it's the average price of the last 20 periods, in this case, last 20 hours. Now, when you look at this, there are a few things that you should notice. And I will go ahead and switch over to like a bar chart. So prices actually went this high, but they closed here. And we'll talk about that a little later. But the idea is you can see the price had reached above the top. And the idea is that you are more than 2 standard deviations above, and you should go back towards norm. The same thing can be said here. You are 2 standard deviations below, and you should go back towards the norm. Now, something to pay attention to is the moving average, the norm, as it were. When it's going basically sideways, that means you don't really have a trend. You're just kind of killing time. But when it starts falling like this, you are in a downtrend, just as you are in an uptrend here and here. So in that scenario, the easiest way to trade this is to simply use this as to which direction to go, recognizing that once you get outside of the bands, you are likely to have a pullback. There are a couple of different ways that people will use this. That's the most kind of like just straightforward explanation of it. But sometimes they will use the trend right along with the median to determine what to do next. So for example, we have a downtrend here, and you can see that price falls and falls and gets a little overdone and we bounce. So if the trend is down and we're right here at average pricing, you are looking to sell if you're a little bit more aggressive. Sometimes price might even jump up to here in a downtrend, and you are definitely looking to sell at that point. So that's the simplest way to talk about how to use Bollinger Bands. It just tells you when the market's gotten too far in one direction, especially when it's against the overall prevailing trend. Then you become very interested in it. Notice how the standard deviations are farther away here than they are here, and that's just a sign of volatility, whether the markets are moving. You know, if they're just killing time, it gets slimmer. You can see we shot straight up in the air, and then they expand because the moving average starts to rise, and it starts to be influenced by this outsized trading hour. So notice how you're in an uptrend, you get overdone, you can buy at the moving average in the middle. Also, notice how we break through here, we come up and we test this, and then we fail again. That could be a sign that the trend's about to change, and it did in fact do so. And then there's your other entry. So when I talked about being in a downtrend and selling here, that made perfect sense. Just as collecting profits might once you get outside of the Bollinger Band. But notice how if you took these trades to the upside, you may have lost money there because it didn't return. It just kind of depends on when you get in. But the fact that we failed there is a huge sign that something's changing. And therefore, the trend did exactly that. So that's a way that you can certainly take a look at it, as support and resistance. It's a dynamic support and resistance level. It operates the same way on all time frames. I would postulate that, on the daily charts, it tends to be a little easier than, say, the 5-minute chart. Once we start talking about candlesticks, this is a perfect setup. Got a little overbought. We're definitely in an uptrend. We pull back. We form what is a buy signal on the candlestick a little later in the course and go higher. We break through it, and then we finally make a decision. And once we make a decision, we're in a downtrend. So that is a way to look at it. So let's go ahead and take a look at Ripple. And let's put Bollinger Bands on this. See how wild it can get? That's because the market is wild, and now we have calmed back down. A lot of times that's a news-driven event. So that's something to keep in mind as well. You can trade inside the bands. Okay, so let's take a look at this. Let's drill down to maybe the 15-minute chart. You can buy and sell. So if you are flat, and this is going to be for those who are like day trading, Okay, so notice that we're essentially flat here. You could buy, sell, or sell, buy, sell, buy, sell, buy. A lot of that's going to come down to the spreads that you get and the like, but you get the idea. Might be difficult to do in a penny range here with Ripple specifically, but with a coin like a Litecoin or a Bitcoin or whatever, it would become much simpler. You do have to keep in mind, though, that if you're in a longer term downtrend, for example, your selling positions will probably work out better. And then eventually you'll probably break to the downside. So you might go back and forth and lose one, but you might win 4 is kind of the point. So again, this is back and forth. You can see how well that worked when the bands tighten up and then they start to open up again. and distance, and that tells you that you're in the midst of a move. Let's take a look at Cardano. Put our Bollinger Bands on. And like I said, depending on the platform you use, and we like TradingView, but I recognize that not everybody is going to use TradingView. So you could do the background all the way to 0. And then you'll notice that it's just 3 lines. A lot of platforms actually do this. It's a little easier to see what's going on the inside. But you can see clearly that Cardano started to break above and then kind of drifted because it got a little ahead of itself. Notice this here. This is a Bollinger Band squeeze. And Bollinger Band squeezes a lot of times will precede some type of bigger move. I mean, a market will only sit still for so long, and we actually talk about this later in the course. But, the skinny of it is it starts to lose volatility, and then once it gets moving, you've changed directions. You have formed a trend. Multiple times you could have bought this right along the average price, all the way up until here, where you finally probably got stopped out. For what it's worth, when you see this, and this hasn't completely closed yet. This is an hourly chart, and as I record this, it's got about 15 minutes left. But if it starts to roll over here, that might be the beginning of a short-term downtrend. So that's something worth paying attention to as well. Now, the thing that I would point out, that move that I talked about, is in the presence of a higher time frame uptrend. So again, that's really the way you want to be as well. So Bollinger Bands are like a nice little guideline. They adjust, meaning that we see them widen and shrink. The fact that we are overbought doesn't necessarily mean you need to be shorting it in an uptrend. It just tells you that you may get a pullback or a consolidation in this case going forward. So you can either take profit, do partial profit, and then perhaps wait for another opportunity to get involved like you could have several times here. In the next video, we'll take a look at some examples, how to actually use Bollinger Bands to place some trades with a little bit more clarity. Hello and welcome back to Cryptocurrency Trading Masterclass. In this video, we'll take a look at some examples on how to use Bollinger Bands in real life, as it were. So let's go ahead on this Bitcoin chart, add the Bollinger Band indicator, and you can see that if you remember, there was a time after the big retail collapse that basically the markets did nothing, and for a while, right around, like right here, just above 6,000, you can see the Bollinger Bands get skinny, and then they get wider, and then they get skinny, they get wider, and etc. So remember, that does mean something. And this was a classic signal to go long. And that's because the Bollinger Band started to widen. The moving average, the median in the middle, started to turn higher. And you can see that the price broke out. So this tells you that something's changing. So as you look at this, you have a market that's very quiet, right? Let's go ahead and draw a line at basically 12,500 or so. And you can see that we stumbled here a little bit, and then we kind of fell back, and then we broke higher. Well, there's two different reasons to think that this is a good trade, or at least a good signal to get long. Because we've broken resistance, we've broken the top of the Bollinger Band, and keep in mind, it's based on the last 20 candlesticks, or 20 bars in this case. So the average will take wider or take longer to widen out like it is. So the fact that it's above this after this type of action, not necessarily something that you need to be concerned about in the sense that it's not, oh my God, it's overbought, I need to start selling it, because it's opening up. Now, it takes, when the deviations are this far apart, and if you get like a move all the way to up here, for example, then yes, you have an argument to be made for that. This just shows you that business is picking up. So you could have bought anywhere along this support level. And the nice thing about the Bollinger Band is you can see that it really held up nicely, and it wasn't, and it really comes down to you. Do you want to take profit when it breaks down through the average? Or do you want to wait until it breaks down through the bottom part of the Bollinger Band indicator? That could have been done either way, which would have you all the way up to 30,000 after an entry at about 12.5. So clearly, that could have been an extraordinarily big deal. Now, if you want to look at tighter time frames, like the hourly chart, you're in an uptrend. So, based upon the daily that we had just showed. So that eliminates all selling. I mean, you can trade a counter trend, but it's a great way to lose money. At least until something major breaks in the market. Well, right now, nothing major is broken. And you'll notice that the band continues to tilt higher. The last day or so, as I record this, has drifted a bit lower. But notice something. Resistance, resistance, resistance broken above it. We're kind of dipping a little bit below it here. I'd call that 38,000. So pay close attention. One way you could play this is if we break back above the 20 SMA, the 20 simple moving average, then we're probably going to see another move like this or like this. It'll be a continuation of what's going on. Regardless, you don't have a sell signal right now, even though it drifted lower. Yes, you could say, all right, well, we broke down here, it failed here, maybe I should be selling. Problem is, it's an hourly chart. It's probably a small move at best. You're in an extraordinarily bullish uptrend, as shown on the daily chart. You don't want to try to short this. I mean, really, it could go all the way down to 30,000 and still be well supported. So the odds are just not in your favor. And that's really what trading is. It's, are the odds in your favor? You take the odds in your favor trades, and over the longer term, you make more money. So this, to me, isn't necessarily a sell signal, but the fact that we're right here at potential support, and if we can cross that, then I think that's a good sign. You have seen on the daily chart, I'll go back to the daily here, you have seen where you profited from what is known as the squeeze. We're squeezing and then we're breaking back out. The market trading inside the bands. Now, it's easier to do on the daily chart, but you need some type of lack of trend, and that's just not the case right now. But on the 30-minute chart, you can go back and forth. You can see sell, buy, sell, buy. If you sell it there, you're starting to see it break out of the bands. That tells you that's not the kind of trading you want to be doing anymore. Now you're buying it on the dips. So Ethereum, we'll add the Bollinger Bands to this as well. Notice how wide it has gotten after squeezing. That tells you that volatility is picking up. Now, let's try to find some type of order in all of this. And I would say somewhere right around here, there is going to be support or resistance. So I'm going to mark this as 1500 with the understanding that it probably, based on what we've seen in the past, it's probably more something like this, and this happens, it's probably like a $50 thick support line is the best way to put it. So what I would be waiting for is either a cross above the moving average. Now that we have bounced significantly, this bar is kind of a significant bar. And we'll talk about that. It's something known when you do a candlestick, it's something known as a hammer. So I'm looking for this 1500 level to offer a bit of support. Once you cross the moving average, the median, then you're looking to probably aim towards the other side. And then at that point, you can make a decision to take profit, or you can make a decision to ride it out until we break through the bottom of the Bollinger Band again. So if you really want to day trade back and forth, you can. But again, I would highly recommend that you just stick with the longer term trend if you are going to do that. Depending on where you're trading, crypto can be difficult to day trade because the spreads can be wide. And when I say day trade, I mean in and out in a matter of minutes. It's one thing to hold on to it for 8 hours. It's another thing to hold on to it for 8 minutes. This is just a strong uptrend. I mean, every time it came back to the moving average, the middle part, you could have been a buyer. Pretty straightforward, pretty tight. Here's that squeeze again. And you can see once you start breaking out of the Bollinger Bands, yes, it is a little overdone, but we find support again right at the median, walk it right back up. So again, that's pretty strong. And like I said, most of the time your stop loss is going to be on the other side of the band. So if you break out, your stop loss goes on the other side. And that's okay, because when you get a move like this, although the stop loss might be a little bigger, a little farther distance than you're comfortable with, the reality is when you get a move like this, it typically signifies something bigger. So you're aiming for more. If you put your stop loss on the other side of the indicator, you didn't get stopped out. You got in somewhere around here. Your original stop loss was right in this area. You got stopped out up here. Poked down there, probably took you out. Pretty straightforward. Some people will just go back and forth in the bands nonstop, but over time, you'll learn that following the higher time frame trend is going to be by far your best friend. I mean, yes, you could have made money selling Ethereum at that point, but the reality is that every time it pulls back like that, the move higher is much bigger. So really, you don't need to capture every move. You just need one or two good moves to make a nice return. So I would definitely pound that into your head. In the next video, we'll talk about how to trade with trend-based indicators and how to trade based upon trend-following indicators. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, we're going to talk about how to trade based on trend-following indicators. So, the first indicator that we'll talk about is a moving average. There is a whole list of types of moving averages. The two most common are simple and exponential. The simple moving average is an indicator that plots N. So N might be, say, 20. So it'll plot the average price of the last 20 candlesticks. Normally the close, you can adjust it to open and highs and lows and everything else. But 99% of the time you're talking about the close. So it plots it like like a dot on the chart, and then it connects it so it becomes a line, much like a price chart. This is simply the close of Stellar 30-minute chart. So everywhere you see this market, like it closed there at that 30-minute time frame, there at that 30-minute increment, etc., etc. simple moving average is the same thing. And then if you change it to 200, then it's just the average price of the last 200. There is the exponential moving average, EMA, and that's the same thing. So N equals, say, 20. So that's your variable. It would plot the last 20 closes. But this has a mathematical adjustment in it that puts a little bit more weight on each time period. So like candle, bar, whatever, going forward. So it makes it much more sensitive. It tends to move a little quicker in reaction because it puts more weight, like say maybe on the last 5 than it does on the first 15. It's really the only difference. So setting them up, pretty simple. You go to the indicators and strategies, and you can type in moving average, and you can see there's a ton of them, but we're just going to worry about moving average and moving average exponential. So for shorter time frame trading, you tend to want exponential just because it's a little quicker to move. And you can see over here it listed, and then there are some lines. So I'm going to change the price to bars just so you can see. By default, it'll be 9. So we'll leave that there. But this one will change to 20. Maybe we'll make it like black or something that makes it a little bit easier to see. And you can see the difference. You can see that the 9, the average of the last 9 prices, tends to move quicker than the last 20. That makes sense. There's more. It's a much shorter time frame. There are a multitude of ways to look at this. People use it as a trend signal a lot of times. So you can see with both of these, trend up, trend down, trend up, trend kind of sideways, down, up, sideways, down, etc. That's the most common way to use it. Some people will use a crossover signal. So, for example, you get a lower one, a shorter EMA and a longer EMA. And if the lower one rises above the longer EMA, that suggests that the shorter term momentum is turning to the upside, and you see it kind of fan out over time. That's a good sign. Just as when it crosses to the downside, that suggests a downward trend. Now, some people will even go so far as to use a crossover system. So it crossed here. So on this candlestick, you would be a buyer. And then it crossed here. And on this candlestick, you would either get out or you would start selling. This is one of those things that if you do it, you're going to experience a lot of small losses. And then occasionally you will see a bigger win like that. And this is going to be especially true on longer term setups. So looking at Bitcoin Cash, let's change this to the daily. And again, let's change this to bars just so we can see the indicators a little easier. So in this one, we'll use simple moving averages. So you click on that, you can see that they're there. But I'm going to change the settings to the 50. Let me make that red. And then I'm going to change this one to the 200. I'm going to make this black. Okay, so average of 200 days worth of prices, average of 50 days worth of prices. It's a simple moving average, meaning that it just takes the raw information. Now, that cross formed here, and this is what is known as the golden cross. And you can see when this works, it really works. the short time frame, in this case 50 days, breaks above 200 days, and it just takes off like a rocket in Bitcoin Cash. However, you can see that it produces the occasional whipsaw, and that's the problem with a moving average crossover system. You have to be willing to accept several small losses for a huge, big trend following one. Binance Coin. So I'll go ahead and change this to bars again, just for simplicity. We'll go to the 1 hour. Now let's go back into, you can also type in EMA if you want moving average exponential. It's the first thing it pulls up. And this is the 9. And again, let's go back to the 20. Okay. So you can see that it's a lot of back and forth. So the problem you run into, like I said, is if you just trade just the crosses, you could run into serious trouble. But when they work for a very long time. Otherwise, what traders will do is just simply look at the moving average itself and just use that as your directional bias. Pretty straightforward. No need to overcomplicate it. Let's go to the daily. And let's change this to that 5,200. Now remember, we had the golden cross previously. This is the death cross. This is a very bearish sign long term. That's the golden cross. You can see the golden cross work there. The death cross, I mean, it kind of worked, but not really. The golden cross here definitely did. The problem is, though, if you wait for the cross, that's not until you get to this candlestick. And if you wait for, so really you would have only captured that much of that entire move. So moving average crossover systems, they tend to work better with investments. You have to be willing to ride out that type of back and forth. So those are trend following signals. You can see, or indicators. You can see that this indicates that we are going higher. So let's remove that indicator and let's look at something called the MACD. Moving average convergence divergence. Now, this is whether or not the moving averages are squeezing together or spreading out based upon the 12 and the 26. So it's essentially a moving average system. Some people will put moving averages on top of it. It's probably overkill, but some people prefer that extra boost, if you will. You can do the signal crossover, breaking above just like you would with a moving average. And that would have been an entry. You can also use what they call the zero line cross. So 0, right here where the histogram goes green and red, meaning positive or negative. So every time it turns green, you'd be a buyer. Every time it turns red, you'd be a seller. Some people wait for a signal line to cross to the downside or upside to be a seller. So they might be a seller there. Just as they would be a buyer here, because we crossed over the zero line with a cross shortly before it. And that's one of those confluence things. That makes quite a bit of sense. And then finally, I'll go into stellar lumens here, and I'll remove these indicators, and I'll do the MACD over here. So it's a little early to tell at this point, but it does look like we made a lower high here on the moving averages, while we made a higher high here. This is negative divergence. And what this means is when an oscillator, this is part of a family of indicators called an oscillator, when it fails to make a higher high while price does, that means that it's diverging from the price, and that means we may be running out of momentum. So in theory, that is a sell signal, and it did work, at least so far. We broke the zero line, so we'll see what happens to the seller next. Now, this is on the 30-minute chart, so you can only read so much into it because, again, you like the idea of higher time frames, not lower, for indicators as far as reliability. Notice resistance here, resistance here, resistance here, crossover here, bearish crossover. So certainly the MACD can be very useful. You never want to really use a MACD in a sideways market like this. It'll produce a lot of false signals. But if you get any type of significant swing, it becomes much more interesting. So in the next video, I'll throw out some examples in real life, show you exactly how you could have used this in multiple instances with the moving averages and the MACD. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, I'll talk about trading the EMA and the MACD for more of a real-world perspective. So, if you remember, I had talked about moving average crossovers and some of the downfalls to using them. It's not all bad news, of course. I mean, they do work over the long term. The question is whether or not you are comfortable with the whipsaws that almost certainly will come with them. So there are some things that you can do to perhaps maybe smooth it out, smooth out your returns. So since we're taking a look at moving averages, in this case, exponential moving averages on a shorter term chart, why not add the MACD to it? And you can see that the MACD is added to it. And this essentially has 4 moving averages and shows you the convergence and or divergence of those moving averages. So when you look at this crossover here, which also was preceded slightly by this crossover here, which was negative, a selling opportunity, as it were. One thing that you may want to look into, remember, support and resistance, that's the basis of most trading systems. And you can see that we had to worry about that there. So the question is, was this a viable signal? Not really. I mean, yes, it worked in Bitcoin a little bit, but at the end of the day, it really has a little further to go before it breaks through support. So that might keep you out of that. And quite frankly, a lot of times support and resistance should be the first thing you look at. And it can be a great filler if you pay attention to it. So right here at the 30,000 level, you can see that we had bounced and then bounced again. Well, notice this signal here. From a very low, kind of oversold negative position, we crossed over, and then we got a crossover on the chart. Well, both of those do suggest you should be buying. Then on top of that, when you look at it, I'm zooming way out, but we are in an uptrend. So that is something to pay attention to as well. Traders a lot of times would take a look at this and take a look at this. And then they say, okay, well, it crosses here and it crosses there. So MACD got a little overdone. You could take your profits there or move your stop loss to break even, as it were. If you get in here, you probably put your stop loss behind the most recent price action. At this point, maybe you're to break even, so you have your stop loss there, and then you just let it run. So that's a pretty viable way to trade this market as well. Let's go ahead and go to the daily chart. And, this is basically the same trade here. You can see that we crossed the zero line here just as we were crossing there. So that sets this up for a pretty interesting place to take a breakout trade, which we got. And it ended up being a long-term. I mean, if you got in there, you're sitting pretty. You've quadrupled your money, really, without any leverage whatsoever. So definitely something to pay attention to. Let's take these off and let's take a look, since we're on the daily, let's take a look at a couple of simple moving averages, that 50 and that 200. So I'll make the 50 red. I'll make the 200 black. So you got a golden cross here, but the MACD was going in the opposite direction. And that's going to be one of your biggest problems. This was a great signal to go long. And we got a cross there in the moving averages, so that makes sense. This was very flat for ages. It just really fell asleep. And then as you look here, you got a zero line cross here. You broke back above the 50-day EMA, or SMA, sorry. You also cleared resistance. So once you got to this candlestick, this gave you a heads up as to what was going to happen. And then you just took off. Something else that I would point out is these bigger moving averages, 50 and the 200, which are two of the most common ones, a lot of times attract attention. You can see that there was a little bit of buying there and there. So it's not a huge surprise. Doesn't mean they have to, but when you're in a trend, they do tend to do so. So this is Ethereum daily chart. Let's take a look at the MACD initially. I mean, you can see that we crossed all the way down here and then crossed again. Once you break above the resistance that was formed basically there, $500, we came back, we pulled back to retest it, kind of went sideways for a while, and then you can see the MACD took off. It crossed a couple times and then started to fan out and go higher on the moving averages. The histogram got wider. So that was a signal in and of itself. We can add the couple of moving averages. Let's make the 50 red. You can see the 50 is held quite nicely. The 200, I suspect, isn't going to come into play at all, really. Other than the fact that, you know, from a longer term perspective, it does determine the long-term trend. And once we broke back above that 200 and then the 50-day EMA crossed back here, you can see that the momentum shifted. The MACD does not confirm it, but clearly the 50 is starting to come in and offer support multiple times, 1, 2, 3 times on the way up. So definitely worth paying attention to. Now, it's not just moving averages and the MACD that you use to trade with. And this is especially true with moving averages. Moving averages can be very helpful to determine the trend. You know, you're obviously in an uptrend, potential support. But as we go through this course, we'll talk about patterns and candlesticks that you will use based upon support or resistance, the 50-day EMA, for example, and then a candlestick, or a pattern that suggests that we're going to find buyers there. And then that way you have a confluence of 2 or 3 or 4 things, possibly. So moving averages are important, but they're not the be-all, end-all. And I do not want you to think that you, just because the moving averages has crossed over the other one, that you should just jump right into the market. There's a lot more to it than that. But it is a common technical analysis tool that you should be aware of. In the next video, we'll talk about trading based upon volume. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, we'll talk about how to trade based upon volume. Now, volume is crucial because it shows that there are real buyers behind or sellers behind a move. If there aren't much in the way of buying volumes in the markets, and it's basically less liquid, then a market could jump and give you the false sense of bullishness or bearishness. It could fall based upon the fact that maybe there just weren't that many participants. So one sizable order comes in and knocks it around. So that's why you like volume. Volume tells you that there are a lot of people in that market getting involved. Furthermore, we'll not only talk about volume, but we're going to talk about RSI, which is Relative Strength Index. So as I put this on the chart, you can see that it pulls up another window down here at the bottom. And there is a range between 30 and 70, which is considered to be the normal strength of a trend. However, there are times where you can get extraordinarily overbought. And then as you roll over, that's a sign that perhaps you are struggling. There is also something known as divergence. If you remember in the MACD video, that you had a high, like in this case, a higher high and a lower high on the indicator. And this oscillator, that tells you the same thing as well, that perhaps maybe we may run into some trouble. Doesn't necessarily mean that you have to fall. It just suggests that you could. So let's go ahead and assume that every time you get a turnover here in the overbought condition, the market falls down. Just as if you get into oversold, which we don't have any examples on this particular chart, you could see the sellers run out of momentum. It just suggests that perhaps we had gotten a bit ahead of ourselves. But another thing that we need to take a look at is that volume that I had talked about previously. So if you type in vol or volume, you can click on that and you can see that it does this underlay here. So one of the quickest ways you can use volume is just simple observation. Okay, so the volume has spiked a couple of times and has been for a positive move. So that tells you that there's a lot of interest on these very positive, strong days. Even here, you can see that we spiked on a day that we tried to break higher. So that in and of itself gives you an idea of whether or not something's real. You can also take a look at basic. This is a breakout. This is a breakout above. I mean, I guess you could call it 20. There's a little bit of a range here. But once we broke through here on this type of volume, that tells you there are scores of people willing to get involved. And that means something. And it did continue the trend. So at that point, it's a breakout. You should not be looking to short. You should be looking for value, places to buy, perhaps based upon this previous resistance being support. So over here in Bitcoin Cash, let's put the RSI up. Overbought here, you can see that we rolled over. Oversold here, bottom of this move. Ended up recovering. Let's add the volume back into this chart so we have both going up at the same time. You can do that. Extreme volume, but oversold. As we started to get out of the oversold condition, it suggested that perhaps we could rally a bit. And we did. We went sideways for a very long time, but it was from this level. So it certainly was a rally. You certainly would have made money there. Overbought. Extreme amount of volume started to drift. So you can see that not only does an extreme amount of volume on a breakout confirm the trade, it also can confirm that were overbought and things are a little overdone. You can see it there as well. So if we're overbought and there's a lot of volume, that asks the question, okay, so who's left to buy? So that is something to think about. This is an area that was resistance. It has shown support so far. Volume wasn't anything great, though. You do want to see a significant amount of volume going back into the market. So while this isn't necessarily a signal one way or the other, it does give you a little bit of a heads up as to maybe things aren't as strong as initially thought. So definitely it's a warning. It's a little bit of a thing to put in the back of your head. Definitely overbought in Binance Coin on the daily. Overbought here as well, but notice we didn't break down. We just went sideways. So let's put the volume up and see if there was any clue there as well. So we went overbought. Volume wasn't crazy. So we just kind of drifted sideways. We went overbought here on extreme volume and pulled back. Overbought, a lot of volume, probably too much to maintain. Overbought, a lot of volume, did pull back. Nothing major though. Kind of killed time here. Let's go ahead and draw a horizontal line, an area that should be resistive right here. We finally get the breakout. Nice volume. Not quite overbought yet. Do reach the overbought condition here, but notice how the volume isn't necessarily spiking either. So it's really not until you get up here that the volume spikes. Things get a little ahead of themselves. So now what you would probably do is wait till somewhere in this general vicinity to see if markets pull back and then maybe you get a spike in volume on a bounce. That would be a very healthy sign. Now, obviously, you can put other indicators on here as well. I would suggest that you don't want to put too many on because then you get what is known as paralysis by analysis. Where there's just so many conflicting signals that you never make a trade. So that's not going to do any good. You need to experiment and figure out which indicators you prefer, which ones tend to work the best for you. So notice here, the 50-day EMA, for example, when we did this breakout on volume was underneath, but when we pulled back, we had a nice volume day there on a bounce of the 50 and we kind of went there. So there's a couple different ways you could have played that. We do not have divergence like I had talked about earlier. The RSI is going higher just as price is going higher. So that's not necessarily a negative sign, but what this could be is an overbought sign. So simply step back, let price come back to you and pick it up when it gets cheaper. Volume accompanies most trading systems, and therefore it's something that should be paid close attention to, because if you get a breakout on very little volume, that might just be a very quiet and thin day, so you need to keep that in mind. We'll take a little bit more of a look at volume as we go through the course, and I'll continue to show it to you and show you how it confirms various signals. You don't like breakouts on lack of volume. You don't necessarily mind, like if you're playing, for example, the Bollinger Bands, where you were going back and forth. And if you get up here and the volume's light, that's not necessarily a bad thing for you to short this because there isn't a lot of interest. Volume is important, but in and of itself, like everything else, it's not the primary indicator. The primary indicator, of course, is always going to be price. So that is the first thing you should always look at. In the next video, I'll run through and show you how to identify various overbought and oversold conditions. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, I'm going to show you how to identify several overbought and oversold conditions. So here's Bitcoin, and we'll go ahead and we'll put the indicator relative strength index, or RSI on the chart. That'll be the first thing that we'll do. And you can see that we have gotten overbought in this, and had been for a while as we got parabolic. And as we rolled over, your signal to get out would have been when we broke this low here. You know, we bounced from here, and once you break down below there, that's your signal to get out of your uptrend, right? But being overbought by itself doesn't necessarily guarantee that anything happens. Notice how we're in the overbought zone here, but price is still drifting higher. So it's not, unfortunately, it's just not that simple. You could have put some moving averages. And since this is a daily chart, I'll go ahead and put the 50 and the 200. So there's your 50. And this will be your 200. So clearly you do not want to be a seller this entire time. And why is that? Well, price is above the 200-day EMA. That's your longer term indicator. Doesn't necessarily mean you want to be a buyer. You just don't want to be a seller. Now that we are clearly above there, and we got, ironically, we got in this overbought condition, we pulled back a little bit, and once we were out of that overbought condition, then you can start to think about buying, especially as we drifted closer to the 50-day EMA. So what would have made you think about that? Well, the fact that we were breaking 20,000, it's a large psychologically significant figure that would attract a certain amount of attention. Plus, many, many, many moons ago, that was a high back there. So now that we have broken above there, even though we're overbought, we're actually drifting lower as far as that's concerned. Let's go ahead and type in volume. And as you get this breakout, the volume spiked. So that's good. That's exactly what you want to see. And much like price action, the price on a chart, you can see that swing high, swing low, swing high, swing low, swing high, swing low. So that's when you want to be out. Now, again, doesn't necessarily mean you want to be a seller. What it means is you don't want to be buying right at this juncture. We pulled back here to this 50-day EMA, which is supportive, and we are not overbought or oversold. So it is somewhat interesting. Volume spike. So it's time to think about going long again. Let me go ahead and get rid of this, and let me put in the MACD. Big, massive spike in volume, negative cross on the MACD. We are just now starting to get that buy signal at a much more reasonable rate than being completely overbought up here. We're getting it right here just above the 50-day EMA. The volume spike was right before it. That all kind of lines up quite nicely. Go ahead and go to the 30-minute chart for those of you looking to day trade. Let's do the RSI. You can see that we peaked a little bit here, kept peaking here. Notice though, this is that divergence that I had been talking about previously. That was a sign that maybe we were going to find some trouble, but there should be support right in this area. So now we're kind of trying to figure that out. Definitely worth paying attention to. Do we have volume that tells us anything? So notice here, volume spiked after an overbought condition that it tells you to watch it, but you started to get that divergence, and volume it spiked, but not as much as last time. Spiked not as much as last time there as well. So that tells you that perhaps it's a scenario where not all things are as they appear. Let's go ahead and take a look at the 4-hour chart. Overbought condition, massive volume. Is it going to run out of steam? It does. Not necessarily a selling condition, but it is something to be aware of if you are already long of Bitcoin. So as we slide over to Ethereum, let's do volume first. Massive volume breakout. That's exactly what you want to see. Now the question is, does it have enough momentum to continue going higher? Well, it did pull back. So let's see what our RSI said. And exactly right there, we were overbought. As we got here, we started to drop. That shows you that you are running out of momentum. But once you get out of the overbought condition, then it's possible for the market to think, okay, fine. We're not overbought anymore. It might be safe to get back in. $1,000. Nice, psychologically important number there. You know, it just attracts a lot of headline attention, if you will. Let's see what the 50 looks like here. And you can see the 50 is coming up to meet it, and that should be dynamic support. Let's go ahead and take a look behind the previous times. I'm going to go ahead and put another moving average. And this time I'm going to make it 200. There's a cross there. Volume didn't spike up, but we weren't overbought either, so it was a safe trade to take in that sense. You didn't have to worry about, are we overbought? Is this going to hurt? Let's go ahead and put the MACD on. And as you put the MACD on, you can see that we crossed here right around the 0 line and then picked up again, and we were walking right along the 50-day EMA. Had a quick run up, and you started to see we were getting a little overbought, and once you broke down below this low here, it was time to get out. You did lose the very last part of the move, but it is better to be out of the trade a little too early than a little too late. That's part of what indicators are supposed to do. They're supposed to give you a little bit of a heads up. Overbought condition breaks through the 50-day EMA. You could very well suspect that we're going to go looking towards that 200-day moving average. Not EMA, but moving average. SMA, simple moving average. You can see that down here we started to get a little oversold. Shortly afterwards, we got a bullish cross. Volume was very quiet, so we kind of just drifted. And then a volume peaked here in an overbought condition. And you can see that this was a lot of noise. Well, here's the question. Why was it noise? Well, remember that when it comes to these moving averages and these oscillators, they tend to need some type of trend. And we just kind of lost steam there. We just kind of went sideways. The market was just trying to figure itself out. This is a trend. And you can see that's a cross. We were slightly overbought, came back just a little bit. And then before we took off, we weren't overbought. And once we broke that 200-day EMA, a lot of longer-term traders will look at that as a bullish sign. So there's a lot going on at any time. And you need to be aware of the fact that some things will contradict other things. And that's part of the challenge. That's why you don't want 12 different indicators on your chart. You want to be able to take a trade based upon what the market's telling you in a somewhat clear and concise manner. So, for example, 140 here had been resistance. We broke above it on decent volume, and we continued to go higher. if you throw the MACD in there, you can see that we broke out here. We broke above that 0 line shortly thereafter. It did lag a little bit. That's not that uncommon. Volume is immediate. Most indicators are lags, so you do have to keep that in mind. Notice how we went right up to the 50-day EMA and then pulled back before we broke through it again. So this offers a little bit of dynamic resistance, but when we pulled back, we had this cross and decent volume as we broke through again. Once we broke through, finally broke through. Once we finally broke through, you could even go so far as to, let me go ahead and change this to 200. But you could even, as we broke through, you could say, there's the 200-day EMA, and this level here, right around 175, was resistance. So we had nice volume going into it and a pickup in volume, and the 200-day EMA, the previous resistance that's now support, offering support, 50-day EMA comes in here. It's a nice buying opportunity based upon the candlestick pattern called a hammer that we'll talk about later. And then 50-day EMA continues to go higher. So really, at the end of the day, what you need to be aware of is no matter how perfect the setup is, sometimes they don't work. But if you have a handful of reasons to be in a trade, more often than not, you will make money. And at the end of the day, making money is about psychology. It's about trusting in your system. So you need to test all of this out. But it is also about risk management. And that's the next video we'll talk about, because this is the part of trading that a lot of traders skimp on, and they really pay the price. So next video, we'll start talking about risk management strategies. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, we'll take a look at risk management strategies. So, the very first thing that as a trader you should be thinking about is, what's my risk? Because a lot of professional traders out there will tell you that your job is to manage risk. A lot of this comes down to recognizing when momentum is falling, when participants are interested or not interested in the market, when to take profit, when to place your stop losses. Support and resistance comes into play. You can use Fibonacci levels, multiple different ways to do it. But at the end of the day, you must have a strategy. Because if you don't, then the market will make the results for you, and you don't want that. You want to be in control of your money. Unfortunately, far too many of us get involved in this world and don't understand the true risk. So I would highly recommend that you think about any risk of a trade being taken, and most importantly, you have to understand, when are you wrong? So here's an example of a breakout. And, let's say for whatever reason you decided to sell. Maybe on a short-term chart, when we tried to break above 700 and really couldn't, then you thought, okay, well, I think Ethereum is going to fall from here. It's gotten a bit ahead of itself. I'm willing to sell it. Unfortunately, what happens is a lot of traders will, they'll sell it there and they'll say, okay, it's going against me, so I'll sell a little bit more because I want to get my money back. And maybe it only needs to get to this point for me to get to break even, because this one will be, up $400 while this one is down. And then they'll sell it again. And then the next thing you know, they're in a huge, huge hole. So the first thing that I would say is, when you recognize that you're wrong, get rid of it. You have to be very quick to get rid of your losers. So I'm going to go ahead and go down to the hourly chart on Ethereum. And I'm going to go back to that time. And we're going to pretend like, for whatever reason, we believe Ethereum's going to fall. And there's your reason. This is something called a shooting star. We'll talk about it later, the candlestick formation. But it's bearish, and you can see that, yes, we did fall. But we turned right back around. This was a bullish candlestick for that matter. So as you start to look at various reasons to be in or out, you can put a few indicators on. Let's just do the RSI and volume for now. On this hourly chart, you're overbought, you're overextended, volume has shot straight up. You've shown exhaustion. You couldn't stay above 700. So you figure, okay, I'm going to short. However, if you're basing it on this candle, the market went as high as 720. So your stop loss has to be somewhere in that area, because at this point in time, you're wrong. There's nothing wrong with being wrong. You're protecting your account. Furthermore, you want to limit what your losses might be. So it might be 1% of your total equity that you're risking. Once you lose here, you're down 1%. You still have plenty of your account. But notice, for those who would be particularly stubborn, and they'd say, you know what, it fell, it kind of shot back up, but now it's pulling back a little bit. Volume comes into play. Oh, it's overbought. So I just have to wait, right? And you get back down here, you get roughly close to break even, but you notice that now we can't break below 700, so you definitely need to get out at this point, and unfortunately far too many people don't. The simple solution is whatever candlestick or setup that you have based the whole thesis on, if it gets broken, just let it go. I cannot stress that enough. So this is an example of where the market moves against you, and if you aren't quick enough about it, it's going to move against you quite drastically. And you got all the time in the world to get out, but yet people will stubbornly hang on to it because they don't like being right or wrong. They want to be right, which is an excellent way to lose money in the markets, in any market, not just cryptocurrency. So here's a scenario where you could have gotten in based upon a fib. You pull back to the 50% Fibonacci retracement level, but you never make it back to the top. Well, that's the whole idea of a fib. You're going to continue the trend. That should tell you it's time to start thinking about getting out. Well, if you got in down here, you're in profit. So don't be afraid to take it. We test the 50 again and we bounce, but we don't bounce as high this time. So the market is giving you a second opportunity to get out. Get out. I can't stress that enough. Volume. So we put in volume. Notice this big massive volume spike. That makes sense. But as we rally, the volume isn't picking up. It's just kind of petering out. Lower and lower. So pay attention. If the price is kind of slacking off and so is volume, that tells you there's a lot less interest. Put your stop loss behind the candlestick that you got involved in. I mean, or the 50% Fibonacci retracement level. It doesn't matter. You get taken out eventually. Well, look at this. We try to break down below the 61.8% Fibonacci retracement level a couple of times, only to bounce. So here's the thing. You have to realize this is happening in real time. So yes, in theory, you could have just hung on, but you wouldn't have known that. Furthermore, when you see this setup here where we try to break down below this 61.8 twice and fail, and then we start to rally, that's a completely new trade. This doesn't matter anymore. You shouldn't be worrying about this trade. And in fact, before it was all said and done, you made all that back. Assuming that you did let it hit your stop loss. Again, lower highs, that's a sign of weakness anyways. Listen to what the market's telling you. That's the most important thing that I can tell you. So where to take profit, put stop losses, that type of thing. The most basic and simple way to do that is, okay, so we have what is known as a double bottom here. We rally. Where are we going to run into trouble? Well, I would suspect that we would run into trouble there because you can see we struggle to break above there in Ethereum. We finally break above there. I put my stop loss just underneath there. And in this case, you got taken out. That's fine because you have an opportunity to buy back down here again. Now, I would point out that this area that was previous resistance and then support offered a little bit of resistance here, but it offered support going forward. So you would have recognized this as a potential area. You would have put your stop loss somewhere behind it. And then when we got this big, massive candlestick on strong volume, that tells you that it's time to move your stop loss to break even and see where it can go. Because unlike the other setups, when this was going on, Ethereum was already taking off. So when you don't have a reference as to where to go forward, you could do a Fibonacci extension. That's fine. And I'll go ahead and draw one. But the reality is that you don't know how far it can go when it's in its own world, when it's truly taking off to the upside, when it's reaching all-time highs. The best thing you can do, instead of aiming for one of these fib extensions, is to mark the charts as you go along. So this was your breakout point. That's fine. You can see that there was a lot of action right here, a lot of whippy action. So that's an area that's going to be important. You rally a bit, you go sideways. So there's a lot of interest in the market right there. So as you're drawing these lines, you just plop your stop losses behind them. So you shot higher there and then you got taken out. But you know what? That's okay, because that was based upon a trade that started down here. The market told you it was time to get out. The market also has told you that it could possibly be time to get back in here. Same areas are going to come into play. So you move your stop loss up. You may have gotten taken out. Another entry here based upon a candlestick formation. Put your stop loss underneath the candlestick. Once we break a little higher, then you can move to break even. The thing about trading is we all dream about being on a boat somewhere, pressing a few buttons and making all this money. But unfortunately, it's a little bit more challenging than that. And then people want to sit in front of a computer nonstop. And that wasn't the dream. The dream was to make a lot of money and to let the market work for us. So that's what you need to do. You need to let the market work for you. So let me put volume on. And I'm willing to bet that this candlestick right here, yep, huge volume. We bounced from there. That was a good sign. Candlestick here, huge volume. Candlestick here, huge volume turning around. So that's that volume. You do not want to risk too much in one trade. I've seen far too many people blow up their accounts by risking 10% of their potential capital. Or worse yet, risking maybe 2% or 1% on a trade, but constantly moving your stop losses back or up or down, whatever direction you're going, in order to not take the loss. And you end up turning a 1% loss into a 15% loss. If you lose 10% in your account, you need to make an 11% gain. And it expands from there. It's not linear, it's exponential. So that's something to keep in mind. Plus, you're better off just letting the market tell you when to get out. Sometimes it'll come back and it'll tag you out and then it'll go on without you. But the reality is, sooner or later, you're going to get one of these trades that runs much further than you could have ever anticipated. And over the course of a year, you may find there's a handful of those trades that make up a huge portion of your gains. And there's nothing wrong with that. You definitely need to be cautious about trying to overtrade. Let the market work for you. So let it tell you where it's trying to find support and put your stop loss underneath it if you're long, or resistance if you're short. It sounds simple. It is simple, but unfortunately that's where the psychology comes in. Most traders are so terrified of taking a loss that they don't stick to a mechanical setup. Mechanical setups are the most important things you can do. Look for stop losses behind support or resistance. Look for take profit at areas where we've seen trouble before. You can see, like had you been long here, that would have been an area where you would expect a little bit of resistance or profit taking. Just like if you got long here, you would expect it there again. Eventually we break out, but there's no need to be hoggish about it. So by using a little bit of common sense, support and resistance, look what the market is telling you. In this entire run, the market was telling you, for starters, the market is telling you that it's going higher, that it wants to go higher. It's telling you that it's still, we've pulled back. You shouldn't even be thinking about selling. You should be thinking about buying when it drops. Now, that will change someday, but until the market shows you that it's willing to make a lower low, you should only be buying. And if you trade with the trend, that will make up for a lot of sloppy mistakes, because you will make the occasional mistake. But if you're with the trend, you're more likely to have the market work with you and not against you. That's the most important risk management bit that you can keep. Never trade against the trend. Use reasonable position sizes. Don't go all in on one trade. It's great that perhaps you get 2 or 3 wins in a row and you make an astronomical amount of money, but sooner or later you're going to get a loss and you could wipe out your entire account very quickly. I cannot stress that enough. It has to be small enough risk that you're not concerned about it. You don't fiddle with it and you let the market do the work for you. So in the next video, we'll begin Module 2, Profitable Patterns for Crypto Trading. In that module, we'll start to talk about grouping of candles and the way the market moves, using these patterns as a hint to buy or sell. A little bit of a preview. This is something called an ascending triangle. That is a buy signal. And you can see that it did, in fact, go higher. But there are other patterns, obviously, that we will talk about. We start to get into the meat of various trading strategies. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. We now begin Module 2, Profitable Patterns for Crypto Trading. In this video, how to profit from triangle patterns. So a triangle pattern is simply when a market starts to squeeze. Draw a couple trend lines, and essentially what happens is the market gets tighter and tighter and tighter. The idea is eventually it squeezes in one direction or the other. This is what's known as a symmetrical triangle, because it is symmetrical. This is a descending triangle, and this, of course, is an ascending triangle. So they all feature the same thing, where the buyers and the sellers start to kind of squeeze the market, but the attitude is different. So, for example, in this one, it's a 50-50 shot. What that means is that there is no clear winner. You have both buyers and sellers squeezing the market, and eventually one of them gives way, one of them loses, and the market continues to go either higher or lower. There is the descending, and a descending favors the downside. This is because the sellers are becoming much more aggressive, pushing the market down, but there is a certain support level. So the idea is eventually the support level gives way, the people who were buying give up, and it breaks down. And then there's the ascending triangle. It's the exact opposite of the descending. It's typically bullish, and what happens is the sellers continue to push at the same level, eventually getting broken through, and then they have to cover their shorts, and the buyers overwhelm them. So a couple things that make triangles kind of unique and great trading patterns is the fact that the market, everybody recognizes them. They are very obvious for a lot of different traders to pay attention to. And with that, it's kind of a self-fulfilling prophecy. So with that in mind, on higher time frames, they become even more effective. More people are watching them. It's just simple compression of the market. Eventually, there's a decision made, and you make a move. Another thing to keep in mind is they have a built-in measuring stick, as it were. From the top to the bottom of the triangle pattern, you extrapolate that on the breakout. So let's just say that's $20, a break to the top of it. You're looking for $20 from the breakout point. If this was, $200 on a breakdown, you're expecting it to drop $200 from the bottom of the triangle. And if this was $1,600, regardless of the direction, you'd be looking for $1,600 on a symmetrical triangle. So let's take a look at a couple of examples. And here in the Bitcoin US dollar market, here is a triangle. This is a symmetric triangle. Another thing that you may want to keep in mind is you do not want it to run out of time. So what that means is you don't want it to reach the apex, because if it does, then it's just the market running out of steam. Well, in this case, that clearly wasn't the case. We did not reach the apex and break through it. So you can extrapolate the move here, the height of the triangle, and you can see Bitcoin went right to that level. Ethereum. So this is an ascending triangle on the daily chart. You can see that we had pretty significant resistance there. We broke before we got to the apex. And in general, you want to see, no more than about 80% of the triangle filled. You want to see it break out before then. We did break out over it. And you can see not only did we get the target, but we also really just kind of took off to the upside. You can see that there was a little hesitation there. And then we continued much further. But nonetheless, you did hit your target. And here in Cardano, this is a descending triangle. You can see that here on the 30-minute chart, we formed this triangle. You can see from top to bottom, we did make the measured move. Now, let's talk about a couple of other things that you can kind of throw in to the trading of these patterns. So the first thing is when you get a triangle, and it really doesn't matter the shape. The idea is that you get the breakout. Let's just say the symmetric triangle breaks to the upside. Well, you put the stop loss on the other side of the triangle. You're aiming for the height of the triangle. That's obvious. This is kind of handy because, like in this case in Cardano, you had this amount of, this is roughly 4 cents. Your stop loss would only be about a cent. And you never really ran into trouble. You're on the other side of the triangle. No issues whatsoever, and you continue going lower. So it's kind of a nice little mechanical way to trade this. There are some things that you can do to perhaps try to maybe bring your hit rate a little higher. So this is a 9 moving average. I like using the 9 on the short term. You can see that we had broken through this, and we are following that right along. So it's a 9 period moving average. You could also make an argument that this was previous resistance. So of course it's support here. Support gets broken, should turn into resistance, and it did. Ethereum. This is a nice large round number right around the $600 level. So that in and of itself makes it interesting. You could put another moving average. So let's go ahead and put exponential moving average. This is the daily. So I'm going to use a little bit higher time frame. in this case, go ahead and change this to 20 for starters. You can see that the 20 offered dynamic support. We continued to go higher there. You can also, for that matter, perhaps make an argument for maybe using your Fibonacci tool from the pullback to here. You can see that we did, in fact, on this spot at the high, and we pulled back towards the triangle. That also matches quite nicely with the 38.2% Fibonacci retracement level. And then here on the symmetric triangle, let's go ahead and redraw that. You can see that the Bollinger Band got overbought, got to the bottom of support, hit that middle 20 SMA, and that's where we broke down. Furthermore, you would most certainly want to be taking profits down in this area anyway, which also matched up with that level. So you can see just how many different things you can combine with triangles. But quite frankly, most people just use the triangles themselves because so many other traders use triangles and recognize triangles as a valid trading methodology, that there are some people who literally that's all they use. Higher time frames do tend to be a little bit more noticeable and attract a lot more attention, and that makes sense because like on a weekly chart you would need a lot more order flow in order to build that triangle. So certainly something to think about. In the next video, we'll take a look at trading breakouts with double top and double bottom patterns. Hello and welcome back to Cryptocurrency Trading Masterclass by A Wealthy Education. In this video, we'll talk about how to trade breakouts with double top and bottom patterns. Now, a double top or a double bottom is exactly what it sounds like. The market goes down and it bounces from the same general spot a couple of times. That's a double bottom. If we rally a couple of times and find selling pressure in the same area, that's a double top. Now, there are a lot of things to read into this. Number one, there's a lot of support or resistance when you see this. So there's a whole slew of ways that you can go about trading this. Sometimes a failed pattern is actually a great pattern, and I'll explain that here in a second, because you have to think of it this way. When the market was falling, buyers came in and aggressively pushed the market back up, just as when it was rallying, plenty of sellers came in to push it back down. So typically, like on a double top, you would see something like this, and some people call it an M pattern, just as they would call this a W pattern. And they would look at it like there's a little trigger point down here in the bottom of the M, and they would take the measurement, and let's just say it's $17. And on a breakdown below there, the target is $17. Typically put the stop loss about halfway through the pattern. That can vary depending on, the personal traits of the trader, the risk appetite, that type of thing. But in general, that's how most people trade it. Just as right here, you would measure this pattern. Let's just say it's $100. You turn around, you break above the top of the W pattern in this case. You aim for $100, you risk 50. It's a built-in, risk 1, gain 2 type of scenario. But let me ask you this. What happens if one of these patterns forms and the markets, instead of breaking down, they turn around and break up? Everybody that was shorting in this area is now in trouble, and they're going to have to close. Now, this doesn't necessarily give you a built-in target, but what it does tell you is that the uptrend is now continuing. So that's something that, you may use along with like a moving average system or Fibonacci projection, extension type thing. It just depends on the circumstance. But a lot of people forget that a failed pattern sometimes is a great signal in and of itself. And I have a couple of examples I want you to take a look at. So right here, you have a double bottom, right? And this is a reversal because we had started falling on the Bitcoin hourly chart. We did have this long wick. There's a little bit of artistic license that needs to be put into play here. That's why I picked this one, because it does show, okay, fine, there's a big wick, but it shows a lot of support, right? A lot of support here as well. We broke the top of this pattern. Remember, we're going to measure the top of the W pattern, right? So let's take that measurement, extend it out, and we clearly hit it. We reacted, and in fact, of course, went much further to the upside. Here's something that's interesting, though. So later on, we ended up forming the same pattern, and people are bullish at Bitcoin at this point. And I think this is a great opportunity. We are pulling back. We formed a double bottom in an uptrend. Should be bullish, right? Well, once you break down below that, anybody in this area that's long is now suffering. Again, unfortunately, you don't really have a built-in target like you would measuring, but it does tell you that something's changed. And that in and of itself is pretty valuable information. You know, you can try different things. You can do simple support and resistance. In this case, 3,600 would have been previous resistance, support, and a round figure. That probably would have made some sense. But that's an example of how you can use a busted pattern. So here on this Ethereum chart, this is actually a triple bottom. They do happen. They're not as common as double bottoms, obviously, because it takes so much more to make them happen, but they are even stronger signs. And all that shows is that there are buyers here right around 1200 in Ethereum. You know, clearly we got our move based upon the neckline. You can extrapolate that out. You know, that's about where we stopped initially. And then, of course, kept going. Little bit of a double top there. It's a little slanted for my liking. You know, I tend to play the body of the candlestick, and that is pretty tilted. If it's just a bit, I'm not too worried about it. But when it, you know, it's a stretch to call that a double top. Certainly, it shows you the same thing. It shows you that it's struggling to get above there. But at the end of the day, you don't want to call everything you can a double top or a double bottom, or in this case, a triple bottom, which I think this one's pretty valid. It is slightly tilted up, but not much. This is a classic double top reversal signal here in Chainlink on the hour. And what I like about this one is that it's so clean, it's so obvious. You can take the measured move, and it went there almost immediately. Another thing that I like about this is that it's right at the 25 cent to 26 cents level. You know, that's right where you'd expect from a psychological standpoint to see some resistance. And you can see it was a nice move right back down to about 20. So pretty straightforward. Makes quite a bit of sense. Right now, as I record this, there's a little bit of a double bottom that looks like it might get broken to the downside. So that could really get the market selling off. There are other things you could pay attention to. So, for example, I like the round figures, the 25 cents. But Ethereum, you know, let's put a indicator or two on this, and we'll talk about, you know, how that does possibly set you up for a trade. So here at this triple bottom, you started to see the histogram suddenly explode to the upside on a cross. Now, it was already over the zero line, but it is still a valid signal because of the cross and the histogram exploding. And that was a nice sign on the MACD. You could also put your EMA. It's an hourly EMA. So I like to keep it tight with the 9. You can see it broke above there. That was a signal to get long right at the break, basically. Here on this Bitcoin hourly, there's a couple different things that you can take a look at. So, for example, we're right at the 39,000 level. So that should be support. And the fact that it got broken and then back and retested, pretty significant. Just as this was right at the 30,000 level. So that's pretty significant from a psychological standpoint. You could also take a look at the Bollinger Bands. We pierced it a couple of times here, so we were getting a bit overdone, and we ran higher. And again, it's just a whole plethora of reasons to trade these. These are probably, along with triangles and a few other major patterns, which we'll talk about in this section. There's a handful of patterns that the traders come back to time and time again because they prove to have an edge. They work over the longer term if you take these trades. This is most certainly one of the favorites of traders. In the next video, we'll take a look at trading head and shoulders patterns, ones that traders really like. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, we're taking a look out to trade breakouts with head and shoulders patterns. The first thing that you need to understand is there are two different head and shoulders patterns. There is the typical one, and then there's the inverted. So let me draw out what the pattern looks like for you. It's basically a move that's rising, kind of pulls back a little bit, rallies again as you would expect. Generally, that's what markets do. They just kind of slither the way up. But the third is a lower high. So you have an uptrend, higher high, pullback, higher high, pullback, lower high. So think about what this means. It means that we are seeing momentum die off. Head and shoulders patterns are very commonly followed. So when they happen, a lot of people will jump on them just because they are there. They also feature a couple of really neat additions to the pattern itself. So if you draw a line right across here, that's what is known as the neckline. This is the head, and these are the shoulders. So again, it is a higher high, a pullback, a higher high, a pullback, and then a lower high. It signifies that something may be up. When you break down below what they call the neckline, here where you draw those three together, the measured move, the implied move, is the height of the head to the neckline. So if it's $100 from top of the head to the neckline, then you are expecting a $100 move once you break down below the neckline. Typically, the stop loss is put somewhere towards the top of the shoulder that you're breaking out of. Some traders will change it around a little bit, but that's how they typically play it. And then obviously there's the inverted head and shoulders, which is simply the same thing, only inverted. It's at the bottom of a move lower. You got a lower low, pullback, even lower low, pullback, and a higher low. Again, works the same way, but in reverse. That's your inverted head and shoulders. Once you break above the neckline, you take the measurement, just say it's $75, and then you extrapolate that out, put your stop loss on the other side of the shoulder. Another thing that I would point out is they do not have to be directly up and down. They can be slanted. And then your neckline would be like that. That's perfectly fine, just as long as the last shoulder is below the head. So let me show you a couple of examples. You can see Bitcoin is rallying here on the 1 hour chart. you can also see that the market had rallied, failed to continue rallying. And then there's the neckline. Notice how the neckline right here being supportive, I should say, we broke down and then we tested it and found it to be resistance again, just like you would on any other pattern. Now, the most obvious reason to like this head and shoulders pattern is the fact that it is right at the $40,000 level. It's a major number that will attract a lot of attention. You can take that measured move from the top of the head to the neckline, extrapolate it out from the breakdown, and you can see that we clearly got that move. Stop loss would go up here. It's roughly a 2.5 to 1 trade position, so makes quite a bit of sense. You actually got more, and that's not that uncommon either. But the pattern itself suggests a neckline to the top of the head. You can also adjust it to perhaps try to figure out where the market's likely to stop based upon support and resistance. You can see that's where we did. So once we broke through here, you would have been short somewhere around 38,800, and you would have gotten out at about 35,000, or if you just took the pattern, 36,200 or so. And you can see the Bitcoin does follow this quite nicely. So in this one, this is Tron. You can see that this was a failed rally. So let me draw this out for you. So this was interesting because we had been rallying before we fell. We tried to capture it. And look, it told us that, hey, we don't have enough momentum to go. And it made the move. It's also tilted, like I said it could be. Let's draw a couple lines here. You can see that clearly we have made the move, even more than we had anticipated. This is the 4-hour chart, so let's put a EMA on this. And you can see that the 9 has shown itself to be pretty reliable. As it's the 4-hour chart, we can even go up a little bit. The 20, as you can see, in and out, but it broke that neckline and acted as resistance all the way down. Nice little setup. Right around 3.5 cents, you started to see a little bit of selling pressure based upon the big figure. And then finally, let's take a look at Litecoin. Inverted head and shoulders. So the question is can you see it? Well, I see a couple candidates for example, a small inverted head and shoulders. There's also a bigger one. And I would point out that we broke the neckline. We even came back into it a little bit and then made our move. Your stop loss would have been back here. It would have been close, but it certainly looks as if you would have made it. Kind of depends on where exactly you put your stop loss, but you see the idea. Take that measured move, extrapolate it from here, and you did get there. Took a while, granted, but you did get there. This might have been interesting. Let's go ahead and put Bollinger Bands. You can see that we had broken down through the Bollinger Bands in the middle of it. This may have been used in conjunction with the stop loss placement. That, hey, we broke out of that. So this, if you're trading Bollinger Bands, this in and of itself was a signal. You take a look at this and say, hey, we just broke this head and shoulders pattern. This is yet another reason to get long. And again, like I said, somewhere right around here, you actually hit your target. Could have used other places to get out at, but you can see that it does kind of line up quite nicely there as well. So you can see that head and shoulders patterns are patterns that are very visible. The higher the time frame, the better they tend to behave. Depending on your broker, you may or may not have higher time frames available to you because some of these coins are fairly new. So it's not like the stock market where you might have 50 years worth of data and you can trade purely head and shoulders patterns or inverted head and shoulders patterns based upon the weekly time frame. But nonetheless, the rules apply in any time frame. So with that, it is a pattern worth paying attention to. And then if you can find a couple of reasons to take it beyond the pattern itself, you are really starting to put together a nice little trade. So in the next video, we're going to take a look at how to trade consolidations with rectangle patterns. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, we'll talk about trading consolidations with rectangle patterns. Now, a rectangle is, well, it's a rectangle. It's pretty much what you would expect it to be. It's basically an area of support and resistance that gets tested multiple times, and then eventually you make a move. And it can be in either direction. Typically, consolidation leads to continuation, meaning that if you're in an uptrend, typically this means that you will eventually break to the upside. You cannot bank on it, though. And the best way to trade these things is to look at it after the fact. The great thing about it is that they have a built-in measuring stick. So, say this is $20. It's supposed to move $20 on a break above the high. A lot of times people will wait to see some type of candlestick close outside of it. That's really up to you how you choose to enter. You can be aggressive and do it right away as well, but it's also more risky. You could get a false breakout, meaning that they get through, but not enough to really get things going. Typically, the stop loss is put somewhere right about in the middle of the box, maybe just a little bit under, giving you a built-in 1 risk to 2 reward. Really straightforward. You want to see support and resistance show up a couple of different times to form a rectangle in order to trade it. So here in Ethereum on the daily, you can see that there is an area that the market had been struggling to get out of. You can see we tested it at least 3 times before breaking out. You can see that we tested the bottom 3 times, 4 times. The nice thing about this is it's a continuation. So you would have put your stop loss somewhere in the middle, and you would have aimed for $100, which you got in the very first day on the breakout. Furthermore, you can see that we came back to test this area. That's quite often the case. What was once resistance becomes support and vice versa. So if it was, breaking down, a lot of times they'll come back and test it and continue forward because it literally is just support and resistance. So you can see that you had multiple ways to trade this. You could have taken the breakout and taken your profit. You could have taken the breakout knowing that we had been rallying and this could be continuation and hold it until, whatever your criteria to exit would be. Or you could have entered based upon a retest of this area on this massive candlestick. So you can see clearly areas to, pay quite a bit of attention to due to the fact that we had multiple ways to trade. You can also make an argument for simply taking a look at this as a market that was messing around with 2 major big figures. And then finally, you've got the MACD, you've got moving averages. They all could be telling you the same thing. You can see that we broke the 0 going into it, dipped, and then crossed over right on the breakout, and the MACD took off. So clearly, plenty of reasons to take this trade. So Cardano did an almost identical thing on this daily chart. You can see it was right here. And this is why a lot of traders will actually wait for a close outside of this, a strong close for that matter. Because had you taken it at the very first tick above, you may have gotten stopped out. So that is the difference between being aggressive and being conservative when it comes to these moves. Either way, I mean, it really comes down to your risk to reward type of strategy. But clearly, this is a market that took off hard to the upside. So with that, I think what we're looking at here is the possibility that we could take an indicator such as maybe the RSI, put that on the chart, and you can see that we were overbought, so it's not a surprise that we kind of consolidated here. And once we broke out, we went parabolic, not a huge surprise. You can also, put the good old trusty EMA here. It's a daily chart. You could use the 9. Again, I like using a little bit higher numbers on daily time frame and the like. You can see it's held up quite nicely. Cardano certainly made the projected move and much further. So Zcash, you can see this was a little bit different situation in the sense that it wasn't continuation, it was a reversal. But as I analyze this, you'll see why it wasn't really that big of a surprise. Doesn't mean that you knew right away that this was going to be the case. But take a look at this area here at $77. It had been resistance multiple times. So the fact that we came back up here and then got this nasty candlestick was a good sign that we were going lower. Here on the 4-hour chart in Zcash, take a look at the MACD, and you can see that the MACD right here, that's where we got the zero line cross, and you didn't get out until here if you were using the MACD. Furthermore, you could also take a look at just the round figure itself. You can see that 72 has been an area. 70, of course, is just below it. So the fact that we broke below 70 also means something from a psychological standpoint. You can see that we retested it the next candlestick. So rectangles they're relatively simple. And because of this, traders love trading them. And if you think about it, it's really not hard to understand why. Because a rectangle is simply, it's one of the phases of the markets. Markets are either trending or they're consolidating. And then later on, you might get something like a trend, consolidation, where more people get involved in the trend. But sooner or later, you get what they call distribution. Those who got in early are giving it out they're trying to sell out of their positions, and eventually they do, and the lack of demand sends this thing back down. Same thing works in a downtrend. There is something known as accumulation at the bottom, and what happens is people are in there buying up. In this case, it would be Zcash, maybe at a cheap price because they want it longer term, and then eventually it takes off. And once you break out of that rectangle, the great thing about it is it's a self-fulfilling prophecy. There are stop loss orders just above, like in this one. So if it broke higher, all of these stop loss orders are forced to buy the market. It just pushes it higher. If you break lower, there are buy orders that are down here, and they have to protect them with stop losses. So eventually you get to the point where they get blown out and they have to sell in order to cover their position to get back to zero. So it's a nice self-fulfilling, easily identifiable pattern. And with all patterns, the higher the time frame, the more obvious, the more people are involved. So that, of course, in and of itself, means that you should be looking at higher time frames and then drilling down. In the next video, we'll take a look at trading consolidations with Bollinger Bands. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, we'll talk about trading consolidations with Bollinger Bands. Now, if you remember, the Bollinger Band, basically with its default settings, will talk about or will point out deviations, standard deviations, +2, -2 of the 20 simple moving average. Obviously you can change all of that or whatever. And if you remember, we had talked about something called the Bollinger Band squeeze, where it tightens up real quick and then it explodes. But there's also a way to use these to trade consolidation. Consolidation looks a lot different than a squeeze. It's more like a softening. It's not really a squeeze. It does show volatility dropping. It does show the range decreasing, but there's a subtle difference. It's almost like a rectangle pattern, actually. And you can use this to tell you that, when volatility is picking up or not. So, for example, as I zoom through this, I would consider this to be a consolidation. It's essentially a rectangle, right? And the reason is that although we did collapse from a volatility standpoint, we didn't squeeze the pattern. We just kind of killed time going sideways. And that's really what you're looking for. A squeeze would probably be something more like this, where you see it pinch suddenly and then it breaks back up. So what this is doing is this is telling you that, hey, something's probably going to happen. And if you are patient enough, you should get the signal. So in this case, this is Ethereum. On a daily chart, you see just kind of killing time here, killing time. And then all of a sudden, you see the market break above the top of the Bollinger Band, 2 standard deviations. So what does this tell you? If you think about it logically, that suddenly volatility spiked to the upside. So that means momentum. That's exactly what you're looking at, is momentum. To trade this is very simple. What you're looking for is a return to the 20 SMA, the midline. And if you look at this, you really didn't get that until this candlestick here. So you rode this from somewhere around $250, depending on exactly when you got in. But even if you waited at the end of the day, you're talking $260 to about $400. As far as the stop loss is concerned, you just simply put it on the other side of the Bollinger Band, or if you want to be a little bit more conservative, on the other side of the simple moving average. Pretty straightforward in and of itself. You can look for other indicators to tell you that perhaps, maybe something is going on here. One that a lot of people like to mix is the MACD. You can see that we crossed a couple of times and then suddenly it spread out as we started to break to the upside. So something to consider. Now over here in Tron, same situation. This could have been a squeeze if it kept tightening, but it basically just sat here for a while. You did get a little bit of hint of it widening. So that tells you that we're going from a dead kind of consolidation to, okay, things are picking up a little bit. And then finally we get that close outside of the range and we take off. Again, let's go ahead and add the MACD and see if that told us anything. You can see that once we got there, the line started to spread out. The histogram started to rally and spread out more, which shows you that we really were starting to build up momentum. We came back to this area here. We did not get stopped out. We did not take our profit because we did not break down below the 20 SMA. Close. This certainly was a close one. Whether or not you would have moved your stop up there, that's entirely up to you. That comes down to your risk appetite. Generally, though, you'll get a pullback and take off. Markets don't move in the same direction forever, obviously. We did finally break back through the 20 SMA in Tron right about 33 cents, and you got in at 28. Nice quick move on the 4-hour chart. Certainly shows some strength there. Now, in Bitcoin, now keep in mind, Bitcoin uses bigger numbers a lot of the time. See, this could have been a short squeeze, but it wasn't. It was simply sideways action. This was more of a short or a Bollinger Band squeeze. But really, what I like about this particular setup is the fact that it closed outside of the Bollinger Band. You're in an uptrend anyways. Stop loss on the other side of this. And if you look at it, again, consolidation, you have to think more along the lines of a rectangle with Bitcoin. Now that we've broken above there, you could use that same argument, not until we cross the 20 SMA, which is actually on this candlestick. That's got you to about 31,000 from 20. Nice move. We could put the MACD up, but the simplest way to look at this is we broke the 20,000 level. That in and of itself will attract a certain amount of attention. Looking at Tron again, you can see that it was flattish for a long time. So really, you probably could have just jumped out for the daily and made an argument for consolidation right there. And again, that was the same move you were talking about. Ethereum, you can make an argument for a market that does this from time to time. Ethereum seems to be very one step, two step. So here is consolidation right here. Same situation. You break down, you finally close below it. You ride it out to the 20. Again, it's with the trend. We are seeing resistance right at the $500 level. I like that setup as well. If you look at the MACD, it crossed down here right as we started to break down, like just before we reached the 0 level almost, and then rolled over again after crossing. Yet another reason to sell. The squeezing of the market is a subtle difference, and you need to know the difference between that. That's a squeeze. That's a consolidation. Again, you want to see it stretched out. A lot of this, just as with the squeeze, the consolidation is about letting the market tell you which way to go. Now, the examples I've shown you all suggest that, and history shows us, statistically it shows us, that typically consolidation means continuation of the previous trend. But by letting the market do it first, you can profit without taking unnecessary risks. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, I'm going to talk about how to read and analyze a Japanese candlestick. The candlesticks, that's what you're seeing right here, give you a deeper look at what's going on in the markets to give you an idea of not only where price ended up for a particular trading period, in this case 1 day, but how it got there. So there's 3 main types of charts. The most common and basic one is the line chart. Everybody has seen this. It just shows where price is going. But as you can see, you can see that spot right there, 176.47. Well, we closed there 1 day. But when you put the candle on, now it looks totally different. So why is that? Well, it's giving you 4 pieces of key information. The open, the high, the low, and the close. These are all important pieces of information. So, for example, if you simply only paid attention to the close, keep an eye on this right here, the 12th of September. So, the 12th of September closed at 183.23. However, when we put the candlestick chart up, it's bigger. Now, why is that? Well, that goes back to that open, high, low, close. So a candlestick is built with a body, that's what this big part is, and wicks. that come out from both sides. So, for example, you might have a candlestick that looks like this. They are a variation on the old standard bar charts that might look something more like this. So, what you're doing as you read from left to right is you're finding the opening price and the close price. So, this line here is the total range for the day. So that's what both of these are telling you. So in other words, you opened at this price, you closed at this price. So price rose during, in this case, a day. It could be an hour, 5 minutes. It doesn't really matter. It's whatever time frame you choose. So when you look at this candlestick chart, you can see that it comes in a couple different colors. It can be any color you want. You can change that if you want. But let's focus on the red ones for now. So what the red one tells us, right off the bat, without knowing anything about the price or the type of day, red tells us, or black, in a white and black chart, that price fell during this candlestick, again, which is a day. So you can already discern right away that the range, that's what the wicks are. This is your high, and that's your low. And this is simply the same thing as this. The real body is where we traded most of the day at. So think of it the same way you see these ticks going out on each side. And since it's lower, you know that the open had to be up here and the close had to be down here. Otherwise, it wouldn't be red. Just like if you had a candlestick like this, you know that the close was higher than the open. So in this case, this would be green or white in a black and white chart. And that's basically what the candlestick would look like. You also know that that's your low and that's your high. So price rose over the course of that day. So let's take a look at a couple of these candlesticks. This candlestick here tells you the price fell ever so slightly for the day from the open to the close. But it had a long wick underneath, which means if you were to draw it as a line just this one day, it would open like this, it would drop, and it would close like that. And that's important information. That's information you don't get from a line chart. And the reason that's important is because obviously there's people underneath there pushing price higher. That's why it didn't close all the way down here. And then you turned around and you saw this candlestick here. And you can see that we opened and closed higher. And in fact, as I zoom in like this, you can see that there was no wick. So we opened and just went straight up in the air. We did rally a little bit, go a little higher from here, and then close right there. So this candlestick looks like that on a line chart, or on a bar chart. It looks something like that. There's your entire range. There's the open. There's the close. So it doesn't matter the market that you look at. And I mentioned that they can be white and black. I mean, you can set it to any color scheme you want, but the two most common are red and green and white and black. In this case, black would be the same as red. It would be negative. White would be the same thing as positive. So on this candlestick here, as an example, let's go ahead and draw this one out. You had a little bit of a wick, but you closed higher, and you pulled back just a little bit before you closed. So that's basically how the day went, bullish day. Just as this one here had just a tiny wick above, so it did try to go higher. Then it fell pretty significantly and closed like that. Real body matters. The longer the real body, the more conviction there is behind the move. And that's because they were willing to close higher significantly higher than, say, they would on a candlestick like this. It was pretty quiet. The range is much shorter. Doesn't mean as much. But when you see something like this, a lot of times you'll see follow through. Look at this big, huge candle here in Ethereum against Tether. Rallied significantly, and we continue to go higher. And in fact, this looks very strong because we're seeing these big, long candlesticks. The size of the real body matters simply because in a candlestick like this, or better yet, even this one, we dipped a little bit, shot straight up, and closed almost at the absolute highs of the day. That means people were comfortable not only buying, but holding. Of course, the same thing can be said in a very bearish market. If you see a big sell-off, look at this big red candle here. Tried to rally, broke down, closed towards the bottom. It's no surprise that we continue to get a little bit lower from there. Now, there are a world of candlestick patterns out there that you can pay attention to, and we will go through some of the most important ones in this course from here on. There are literally hundreds of candlesticks and candlesticks patterns, groupings of multiple candlesticks, which is, up to each individual trader. Most traders will find a handful that they really like, and then they'll match it with maybe support or resistance. So, for example, you might like outsized candles on a breakout. Well, that's exactly what you got here. This was obvious resistance. We kept seeing sellers step in right around 250. We broke out. We closed near the top of the day, and that kicked off a pretty big move. That kind of thing is what traders will look for. Some like specific candles like this one. This one shows that the sellers came in, but they turned right back around and bought it back up. It's actually a candlestick that we will talk a little bit more about in a couple of videos. These big red candlesticks, people like those. Just like this big green candlestick that closed at almost the exact top. People like candlesticks that break out of Bollinger Bands. It's pretty much unlimited. This is where back testing comes into play as well. Part of it is psychology. Certain candlesticks, you are much more comfortable trading that pattern than others. But again, we'll take a look at some of the most important ones here in the next handful of videos, and then go from there. Hello, and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, we'll take a look at how to trade the Doji candlestick. Now, the thing about the Doji candlestick, you should think of it more or less as like a family of candlesticks because there are multiple variations. There is the classic Doji, which shows open, high, low, close. So basically unchanged. There is one with a body. Not a huge one, but like a small one. You don't have to open and close at the exact same price. There is the dragonfly, which shows that we fell and then rallied again to close unchanged. So this one shows indecision. This one shows indecision. And this one shows potential bullishness because the sellers have been repelled. This is a gravestone doji, which is potentially bearish. Buyers came in and could not hang on. There is also a long-legged doji, which just shows that it was a much more wild day or hour or whatever, where we had a bigger range. There is the northern doji, so these are just candlesticks. A northern doji would be up here. And it's not technically a northern doji until you roll over like this. You have to have candle, doji, candle. That would be a bearish sign. A southern doji would be the exact opposite. A gapping doji is when you have candlesticks and then you get a big gap in a doji. There are also doji stars, which shows several in a row, showing in an uptrend, for example, that you're running out of momentum. And that's the whole point. You're just running out of momentum. Now, some of them do tend to lean in one direction or another. But for the most part, the main takeaway is that during that hour, that day, that 4-hour candlestick, whatever, momentum had stopped. Now, the problem with dojis that you will run into is you don't necessarily want to trade them by themselves, because some people will trade them. You get a doji, and as soon as price breaks above it, well, it's time to buy, or below it, time to sell. That typically is the problem with the doji is by themselves, they aren't necessarily reliable as a signal. However, you can do little tricks with them, and they can give you a little bit of a heads up. Think of it more or less as a warning signal. That's probably the best way to think about it. So you can see that we formed a doji here, a doji there, kind of a dragonfly doji there. It's actually something called a hammer, which we'll get into in another couple of videos. But you can see that there was support there and resistance there. We couldn't get above or below, and that's denoted by the fact that we had rallied. We had 3 decent candlesticks in a row and just kind of went nowhere, and it shows all of the indecision. Well, once you finally get a decisive candlestick, that's your sell signal. Indecision, then suddenly they make a decision. So if you remember, I mentioned the dragonfly doji, which shows that buyers push the market back up. Well, what happens when we break down below the bottom of that doji? That shows that the buyers have lost strength, right? So if you close below there, that could be a sell signal. The thing is, like I said, you don't use it by itself. So in this scenario, you can see that this was the one I was pointing out. We broke below it. Right here, you would expect a certain amount of support. We actually sliced through it, but that would be part of what might keep you out of shorting that. Remember, support and resistance, very important. And as a matter of fact, that's the most important thing, because almost all systems are built upon it. So, like anything else, the higher the time frame, the more important it's going to be. That's because it takes more work to produce those dojis or candlesticks. So the first thing that I would ask you is, on this daily chart of Ethereum, you can see that, that in the daily candlestick isn't done forming, but let's just, for the sake of argument, suggest that this was the candlestick you end up with. There's 2 different ways to look at this, and there's 2 different outcomes. We could break down below, or we could break higher. Now, here's the thing. If we break higher, what does this doji mean? This doji means that we had a couple of days of really strong bullish pressure in Ethereum. We took a minute to kind of perhaps struggle with the idea of 1700, catch our breath, and then we broke higher, continuing the trend. That's a very bullish sign. You want to be a buyer of Ethereum. But what happens if we pull back? Well, unfortunately, most retail traders try to pick tops and bottoms. So what will happen is they will start shorting this. And it could work. Don't get me wrong. I'm not saying it can't. But there's a much better chance to look for this big, large, round number, right around $1,500, to potentially offer support on a pullback. This pullback would be perfectly healthy because in any trend you get them. You have to have more people coming in. So with the 20-day EMA reaching towards the $1,500 level, I would expect somewhere in this general vicinity that there should be a bounce. And you can use another candlestick or just the fact that the market bounced as a reason to get involved. The 20-day EMA, you can see the market is respecting that quite nicely. So that is something that you definitely want to keep in mind. You can see that we are approaching the oversold condition, for what it's worth in the RSI. But the candlestick alone will tell you that. So Litecoin is like all other crypto at the moment, bullish as I record this. This is a perfect example of the candlestick that I just showed you. You can see that we rallied, formed this almost long-legged doji. It shows that there was a little bit more, range for the day, and we broke down below it. Now, again, some people will sell that right away. Typically, it's going to be better not to fight the overall trend. And this was an impulsive move. You can see that's where we took off from, and that's where we dropped to. So this doji suggested that we could fall, or depending on how you choose to trade, it could tell you, hey, you're about to get a bargain if you are willing to wait for a better price. There is so much more money to be made hanging on to a trend than there is trying to catch each top and bottom. That's actually, I think, where a lot of retail traders run into serious issues. They believe that trading more equals more profits, and that's not necessarily true. And in fact, over time, you will find that actually the less you trade, the better off you'll do, because you tend to pick better trades. And once it starts working, you really let it go. So here's an interesting setup of a bunch of dojis. Notice we have 1, 2, 3, 4, 5 in a row. So a lot of times what I will do is I will draw a line at the top and a line at the bottom and look at it as a signal if we break out. If you remember the rectangles, that's really all I'm doing here. You could extrapolate this down to a lower time frame, like these candlesticks here. That's what that would look like on a line chart on maybe the 1 hour time frame. So really that's all you're doing. You can see there's a lot of sellers here. You can see there's a lot of buyers here. Somebody's going to win. Once they do, then you can take off. This might be a little bit more of a reversal signal than anything like this would be. And why is that? Well, that's because there's a lot more fighting going on. There's a better chance that if it does break down, there's a little bit of exhaustion. This looks a lot like a gravestone doji, but it actually has a little bit of a line underneath it. We could be splitting hairs here, but that could also be what is known as a shooting star. We will talk about that in a couple of videos. Excellent signal most of the time. So the thing about doji candlesticks is, again, it really comes down to where it's placed. So look at this one. This was the pullback that I had just talked about. Well, look at this one here. We pulled back again. It does make sense that we would drift lower there because of the previous resistance. Again, though, it's not as if we were in a downtrend, so you don't necessarily want to sell it, but it is viable to think that it could happen. So as I put this Bollinger Band indicator on, notice how we pierced yet again after all of this and formed this doji. So what does that tell you? That tells you that the market was running out of steam. It got overbought. This is perfect natural behavior. The dojis, of course, can work in both directions. As you can see here, that was negative. Again, though, that's more or less a shooting star. The fact that that's splitting hairs, some people would call this a shooting star. Some people would call it a doji because it was unchanged. really at the end of the day, it's going to tell you the same thing. The biggest thing about candlesticks that you need to keep in mind is that each one is trying to tell you a story. Some are, or like a chapter in a book. Some chapters are more important than others. And you have to take it in the context of the entire story. So not all dojis are going to matter. They can, but they can also just be, the time of day. So, for example, if you find that a market that you trade tends to be more active in Asia than it does in North America, well, if you form dojis on a 1-hour chart during U.S. trading time, I should say, then that may not mean much either, other than the fact that, a lot of the market participants weren't actually working at that moment. So you will find a lot of times they end up being at Fibonacci retracement. This is the 50% Fibonacci ratio. Again, this is like that one that I pointed out earlier that could be called a shooting star. This could be called a hammer or a doji. Really, both are technically true. But notice how we pulled back half of the move and then rallied. Again, with the hammer, we'll go into more depth later on. So I would say that as far as dojis are concerned, the ones that do tend to work out more importantly, the ones that are a little bit more clear, I guess, are the when you get multiple in a row, and then you can draw like a rectangle and use it basically as a rectangle. And again, sometimes they just give you a heads up that, hey, you may get a pullback. Maybe you want to add to it a position, or you want to tighten your stop loss. They're quite often used more or less for trade management. So go through your charts, and it really doesn't matter the market, but go through multiple charts and take a look and identify dojis and see what it was trying to tell you in the bigger context of the entire story. Dojis in a major uptrend, that might mean a pullback. Dojis in a major downtrend, that might mean hesitation or a pullback. It can mean a turnaround, but typically you need to pay attention to support and resistance. After that, see if you clear it to the downside in this case, then okay, fine. But they are very subtle. It takes a little bit of subtle reading into the story to truly grasp what the doji is trying to tell you. It's not one of your more clear-cut patterns, especially when you have something like this. That's not really telling you anything other than the market isn't moving. So always take it in context. Take it with your indicators and your support and resistance, and you can extrapolate what the market's maybe trying to whisper to you at the moment. In the next video, we'll talk about how to trade price action with the hammer and the hanging man candlesticks. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, we're talking about trading price action with hammer and hanging man candlesticks. So the first thing I'll do is explain what they are. They are essentially candlesticks that look like this or some variation of this. It can look like that. It can look like that. It can look even bigger as far as the body is concerned. But the idea is you want to have a short wick on top, a longer wick on bottom. Now, it's known as a hammer, for example, because that's the mallet. There's the handle. So there's the explanation of the name. The only difference is a hammer is at the bottom of a downtrend and a hanging man is at the top of an uptrend. So let's take a look at this and let's think about what's going on during this candlestick. Now, in this case, it's the 4-hour chart, but time frames are relevant. You can see that we opened up, we fell hard, we returned to basically right about where we opened. It's essentially unchanged, and in this case, it truly is. and closed like that. Well, what does that tell you? That tells you that the sellers are running out of steam, that perhaps a reversal is in the works. And a lot of times people will take a buy position on a break above the top of that candlestick after it has formed. Now, in a hanging man, it's exact opposite. We're in a rally. We pull back. We recover a little bit, but we're essentially unchanged. So what happens if the market the next day or hour or whatever breaks down below the bottom of it? That means everybody that bought up in this area is now trapped and they need to get out. In order to get out, they're going to have to sell their position, putting even more downward pressure here. This is called a hanging man, and it's a very ominous sign at the top of a move. Should also be noted that the body color is irrelevant, doesn't matter. There's no real set in stone rule as to how big the body can be, but it's one of these things you kind of know it when you see it. The idea is that the body is small and the bottom wick is long. So with that in mind, let's take a look at some examples. You can see right here there's a nice hammer. Right here there are two hammers. That's a very bullish sign because it shows that, for example, right here in this 4 hours in Bitcoin, you can see that they tried to sell off. They got rejected. They tried to sell off. They got rejected again. So that's a very bullish sign. And the first thing that you should notice about this is that it's right here at a support level, basically 30,000. The markets tried to break through it. They failed previously there, and now we formed a double hammer, as it were. A break above the top of there. Your stop loss on the other side of whichever hammer you take. When it's a double hammer, generally you put it behind the lowest. And then it just takes off. It's the sign of the market shooting higher over the longer term. You can also try something like Bollinger Bands. We did pierce the Bollinger Band at this point, so that's a sign that might be oversold. So that's definitely something worth paying attention to. Notice how it's a red and a green candle. So like I said, the head, body, really, the color doesn't matter. So let's take a look here in Litecoin. And let's look at hammer, 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 hammer. Probably more of a neutral candlestick. Hammer just above. Two hammers here, so that's another dual hammer on this 1 hour chart. Same scenario. You put a buy order in once you break the top of these two candlesticks and you go. And you can think of it this way. This is an hourly chart. So here's the thing. That's actually a 2 hour hammer. If you were to pull up a 2 hour chart, that's essentially what it would look like. So again, kind of the same thing, really. And I would also anticipate that the Bollinger Bands would show a bit of an oversold condition. And you can see oversold right here at this support level. Furthermore, when you pull up the Fibonacci retracement levels, you can see that after this move, it was the 50% Fibonacci retracement level and previous support coming into play. So obviously a nice setup. Probably got out, if you're a Bollinger Band trader, that is, probably got out at the top of it, or you just held on to it. It really comes down to your conviction. And Ethereum. Now, Ethereum has a hanging man right here. You can see that this is an area that formed what, kind of looks like a hammer. But once you break down below the bottom of it, they are both trapped. And then you can see it showed signs of exhaustion. Basically, it's showing that, the trend's trying to continue, but then it runs out of momentum. And that is a great time to look for short sales. What was going on there that could have caused some attention to be paid to it? Well, the 1450 level is a round figure. It's a big figure. It's one that will attract a certain amount of attention. Bollinger Bands, you can see that we had broken above it. had been out of it for a candlestick or two. So once you broke down below the bottom of it, that was an even stronger signal until we got to the other side of the Bollinger Band, formed a hammer. Probably not a perfect hammer, but a hammer nonetheless, and then shot higher. This is a sign that's overdone. That's really what a hanging man means. So it's kind of a perfect example. Stop loss goes on the other side of the candlestick, and you just continue to aim for, whatever you're looking for. You could have been saying, okay, well, we're probably going to come back here to what should be support after it was resistance. And that was okay. That was still a viable trade with a risk to reward that was doable. Or you could have waited until we broke to the other side of the Bollinger Band if you had a little bit more conviction. Hanging man candlesticks don't happen as much as hammers, but they are just as valid. Now, if you break to the upside and you break above it, that's actually a continuation hammer, if you will. Not as potent of a signal, but it does show that the upside is still winning the battle. In the next video, I'll take a look at inverted hammers and shooting star candlesticks. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, we're going to take a look at price action trading with inverted hammer and shooting star candlesticks. So this is like the last video in the sense that it is really only one shape. It just depends on where it shows up. And this is the exact opposite of the candlesticks you learned in the last video. It has the same rules, can be either color in the body, really doesn't matter. Can also be unchanged, that's even better. For the astute of you, you will recognize this as a gravestone doji. Slight difference, there is no peek through. That's what makes the difference between one of these and a gravestone doji. So really, at the end of the day, it tells you the same thing. It tells you the same thing about the psychology, and that's really what you're paying attention to. So what's the difference between the two? Well, shooting star is at the top of an uptrend. It's a falling star out of the sky. It's a sign of negativity. And like the hammer and hanging man, you take the trade on the break of the candlestick, in this case to the downside, and you put a stop loss on the other side. Now, an inverted hammer is just simply this. It is a hammer. I'll go ahead and put a little body here. But it is a hammer at the bottom of a downtrend. On a break above the top of this, you would recognize this as a bullish sign. Now, why? Well, both of these show that the buyers are trying to come in and push the market higher. They fail, and therefore you sell off in the case of a shooting star. In the case of an inverted hammer, you're falling, and then you go here, you try to rally, and the traders fail. And at this point in time, it looks very bearish. But what happens if the next day or hour or whatever, they break the top of it? Well, anybody who's short in this area is in trouble. So it becomes a buy signal. On the other hand, if you continue lower, that actually is a continuation signal. So it kind of serves two purposes. In that case, you'd be looking at a downtrend, an attempt to rally, and then a continuation. So it's like a continuation hammer in the last video. So let's take a look at a couple of examples. I'll walk you through. Our chart of Bitcoin. You can see right here, it's a nice little shooting star. What does this tell us? Well, this tells us that we had been rallying for a while. We reached the previous resistance area, and you will see these most of the time as support and resistance areas. We failed to get above it, and then we pulled back. So once you're underneath the bottom of this candlestick, it's a sell signal. You got your stop loss up here, and then you aim for whatever. Now, in this case, you might have aimed for a support level, however you choose to trade it. Now, with hammers and shooting stars, a lot of times you want to see the Bollinger Band, see what they're doing. Yes, you did get overextended, so it makes quite a bit of sense. Your first target would be the bottom of the Bollinger Band. So at the very least, you're probably looking at about a almost 2-to-1 risk to reward ratio, which is exactly what you want to see. This is an inverted hammer. Now, this is an interesting setup, and I picked this one because we had dual hammers. You may recognize this from the last video. But notice an inverted hammer, the exact opposite. So this becomes a 3-candle signal in the sense that this inverted hammer in and of itself is bullish if you break to the upside. But you also have the support underneath here. So again, you kind of have to look at the what the story is that the market's trying to tell you. Here's an inverted hammer, and so is this one. That just shows that the buyers, in this case, failed. But then the next candle, they pushed it higher, failed a little bit, and then eventually broke above that. That shows real wherewithal and tenacity. That's probably the best way to look at when you get a broken inverted hammer to the upside, or perhaps a hanging man. It shows, in the last video, shows tenacity by the sellers. They are fighting and fighting and fighting. It shows that they are ready to put up a serious fight. The Bollinger Band on, you can see that the hammers did break down below the inverted hammer, which became its own signal, you can see. Breaking above the top of the Bollinger Band in this little bit of a squeeze on the second inverted hammer shows that we are overdone. But look at that force. You're looking for momentum in this case. And then finally here in stellar lumens, you can see that the shooting star formed here and here, showing signs of exhaustion. Now, why is that not a surprise? Well, it shouldn't be a surprise because we had seen so much in the way of selling pressure just above. So there's a couple things going on here that you need to be aware of. Take a look at this. Nice rally higher. Pretty significant pullback. Nice shot higher, but it's a lower high. So that adds more confirmation to a potential selling opportunity. The indicators, you could put this is your cross here. So we dipped down to here, and then we crossed again to go higher. But notice right here, we have crossed yet again to the downside. That confirms it. Again, the resistance is probably the most important thing, quite frankly, but you can look at other indicators, obviously. You can see that we tagged the top here. We almost tagged the top here, so we were getting stretched anyways. So it was already kind of leaning a bit lower. Bollinger Band itself not providing a signal, but does provide a sign that things are getting a bit stretched. Certainly worth paying attention to when you look at it through that kind of prism, if you will. And then finally, you can just throw a moving average. So we'll put an EMA up. And this is a 4-hour chart. So you could do 9. You could also do 20. You can see that not only did we find support here, but as we started to drift lower, it suggests that we are possibly overdone. So going back to the 9, you can see how the shooting star formed, the hammer formed. So in a sense, you've got a shooting star, a neutral candle, a hammer, another shooting star, and then finally the breakdown. So regardless, you can see that there is a lot going there right at a resistance barrier. And I would not get too hung up on the exact pip. You're looking for the attitude in the market. You want to give it a little bit of room to breathe. You don't necessarily put your stop loss, for example, 1 tick or 1 pip just above the top of the candlestick. You want to give it a little bit of room. You weren't really threatened there. But in this case, as you are pressing what should be resistance, you could even put your stop loss as high as that. Well, then you have to look for a target. Well, what's your target? Well, maybe down here where we continue to see reaction in the market. That is still like a 2-to-1 risk to reward ratio. again, there's a fine line between hanging on to every technical and a little bit of artistry. There's a little bit of both going on in trading, and you have to be aware of that. That's why I want to give you a framework, but I don't want to give you cut and dry, if it goes 3 ticks above the top of this candlestick, you have to get out, because that's not the case here, as you can see. So you can see that these candlesticks are very reliable, like the ones that I had showed you with the hammer and the hanging man. They're just the exact opposite, so that would be expected. In the next video, we're going to talk about a triple candlestick pattern called 3 white soldiers and 3 black crows. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, we're going to take a look at a 3 candlestick pattern called 3 white crow, 3 black soldiers. They are 2 different patterns. So you have the white soldiers on the left, and you have the black crows on the right, or green and red. This harkens back to the old black and white charts, like in the newspapers and such. Essentially what happens is, this is basically a stock market pattern. It really doesn't happen in crypto, but there are ways you can modify it. So essentially what happens is, on a daily chart, you get a move to the upside. Then the second day you get a gap lower, which should be very negative, but we blow through that gap and continue to go higher. Then on the third day you get a gap lower and you go higher. So the idea is that the market might do something like this, and the second day comes in on a gap lower, which should send selling, but we wipe all those sellers out. And then we do it again. And that just shows real tenacity. Same thing here with selling. You get a gap higher and the sellers come back in. You get a gap higher and the sellers come back in, right? So it does make sense that it shows real strength or weakness, depending on which direction. So in crypto, what we're doing is we're looking for candlesticks that, instead of doing this, might do something like this, where it dips into the previous candlestick, because we don't really close, and that by itself would make the existence of the 3 white crows or the 3 white soldiers or the 3 black crows completely impossible. But here's an example of what I would consider to be 3 white crows on a 4-hour chart in Ethereum. And that's because we dip into the previous candle and continue to fight higher. Basically, it's a momentum play. That's really all it is. You don't need to overcomplicate it with anything more than that. You get your moving average, the 9 moving average, showing signs of strength. That makes quite a bit of sense. Quite often, you'll see it after a break of either resistance or a psychological level. Well, 800 causes a lot of people to pay attention to the market. So Ethereum makes it a move and then dips underneath. 800 might be too expensive, right? Nope. And we continue to push much higher. Much higher, actually. It was the beginning of a pretty good move. So here's another example in Litecoin. 4-hour time frame as well. You can see nice reversal candle here. Dip back into it. Struggle, fight, dip slightly, struggle, fight. If you remember, that was that double inverted hammer. So yes, it could be thought of as 3 white crows as well. And you'll find that as you learn more about patterns, a lot of times one can kind of be the other. And at the end of the day, they're telling you the same thing. So it's kind of irrelevant what you want to label it. So how do you put your stop loss? Well, the stop loss is pretty simple. It's just on the other side of the pattern. So in this case, if you go long on a break of the third candlestick, your stop loss goes down here. Well, where are you aiming? That will, of course, depend on the market you're in. But in this case, this was an area of resistance previously, so it makes sense that we stalled out there. Let's go ahead and put a couple of moving averages on this one. You can see the 9 supports this quite nicely. Go ahead and put the 20 on that one. And you'll see that they crossed right there. So the 9 crossed over the 20 in a sign of strength. Bitcoin. So this would be 3 black crows or 3 red candles. Now, I actually see multiple examples of this on this chart. You can see right here, we continue to dig into that. You can see right here, although I don't like this one as much because you could have made an argument for a hammer there. You don't really want conflicting signals. But technically that is true. And right here. So they're not as rare as you think, especially on short time frames. A true setup, of course, is only in the stock market or markets that close. So again, we don't get that. Now, a true one in the stock market, you can really see these things take off. So when you look at this one here, it makes sense because that was previous support, right? You can also make an argument for this one here because that was previous support. So clearly we are dropping. You can see that the market tried to rally and then we broke through the Bollinger Band midpoint at this juncture. So that comes into play as well. It suggests that we are going lower. And then beyond that, we can draw a Fibonacci retracement. And you can see that this started at the 50% Fibonacci retracement level, just as this one started at the 38.2 of the move lower. So all of this ties in and nicely. But at the end of the day, really what you're seeing is 3 candlesticks moving in a particular direction. That typically means that there's momentum, that there's conviction. You want to see it fight back a little bit and get repelled. That's essentially what you're looking for. They in this case, they try to push it higher and they fail. They try to push it higher and they fail. They try to push it higher and they fail. And this was actually more like 5 black crows, truthfully, I suppose you could call it. But nonetheless, 3 is more than enough. You were never threatened with losses in any of the setups I showed. It's not to say that it works 100% of the time, but it's got pretty strong accuracy because you were clearly, at least at that point, trading with the short-term trend. Otherwise, the pattern couldn't even exist. So, something to think about. That is the last video of Module 2. Next module will be Module 3, and we'll take a look at real-world examples on how to trade various setups in multiple cryptocurrency pairs. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, we're going to begin Module 3, and that's trading with real-world examples. This is where we start to put things together and show how it works in the real world. So I've got Bitcoin in front of you, and this is the most important cryptocurrency market. I think most of you understand that if Bitcoin is failing, then the rest of them fall right along. For those of you coming over from the Forex world, it's kind of like the US dollar version to crypto. It is the world's reserve currency in the cryptocurrency space. So the first thing I like to do is I like to look for potential big figure areas. So let me go ahead and lay out every 10,000 these lines, because they do tend to kind of cause a certain amount of psychological and support and resistance. People want to take profits. Furthermore, there's also the possibility that, quite frankly, there might be options expiring in the options market. So that has a bit of an effect as well. Go ahead and put 20,000 down. And now you have a bit of a grid laid out. Doesn't mean we can't go above 50,000. That's just the next psychologically important level. So we're on the weekly time frame. We're in an uptrend. I mean, there's no two ways about it. You'd be pretty hard pressed to find somebody to argue that with you. So let's go ahead and drop down to the daily. And we can put some moving averages on here. Let's put 2 moving averages. It's the daily chart. So I tend to prefer the 50 and the 200. So let's make this higher time frame one here, 200, and make it black. And you can see we are well above that. And let's make this one red and make it 50. So the 50-day EMA has a little bit more to say, at least at the moment, than the 200 does, because we are so far away from it. We went back and forth and did nothing until this last shot higher really started to take off. So that would have been your first potential setup. And this is one that I do believe that I pointed out in a previous video. We had this resistance barrier here at 12,000, and we had this massive candlestick. So let's put volume on, because if I do remember correctly, it was a large volume candlestick on a breakout. You like to see that. You like to see that this resistance barrier, this recent high here, had been broken not only significantly, but with real force. So with that being the case, that was your first sign that we were going higher and that this could have actually been important. Notice again right here, I had a breakout above 20,000 on high volume. This was an area that caused some problems for a little bit. That obviously would catch a little bit of attention. Notice how we broke above the top of the Bollinger Band. Remember, I talked about the squeeze in the Bollinger Band. We were slowing down. We were going sideways. So you don't really, I mean, you can go back and forth with this, but you don't really worry about the fact that we broke above the top of the range. That doesn't necessarily mean anything other than we are picking up momentum. So simply put, you had a setup down here and another setup here, and you could have taken your profit as soon as we hit the middle part of the Bollinger Band. You know, that's a pretty big trade here. But notice how we didn't even hit the Bollinger Band until we were here. So you could have put your stop loss below 30,000. So that may have kept you in the trade a little bit longer, at least. Nonetheless, it is obviously a very bullish move. Now, there are going to be all kinds of potential confluence on this chart. So let me go ahead and you can click on this hide button here and it will hide each of these indicators on the chart. And then you just click that again and it shows back up, as you can see. So let's draw a Fibonacci retracement. And let's draw it from the absolute bottom to the initial rally. You can see that we pulled back to the 38.2, which also coincided nicely with 30,000. Then on top of that, the 50-day EMA, probably a little bit lower at that point as we've added more information, but would have shown you that it's very likely that we have a bit of support there. The Bollinger Band, we are piercing the bottom of it in an uptrend. That's normally a sign that you want to think about going long as well. There is an argument to be made for a little bit of a triangle. You could say that this was a triangle. It's not the prettiest triangle, admittedly, but it is a triangle pattern. It got broken to the upside, so that would have you interested as well. I mean, quite frankly, there were multiple reasons to think that we were going to go higher. I would also point out that, you had rectangles. And you'll see this a lot. So, for example, you had a rectangle that we broke down from. That's a bearish sign, right? That's a sign that, hey, maybe we're in trouble. But you previously had a rectangle here. So that offered support, and that's exactly where we bounced from. You see that all the time. You see that type of behavior where we go from one rectangle to the next. Notice the high volume. Another thing that I would point out is when we pulled back to here, to the 50-day EMA, we formed a hammer. We broke higher from there. We formed a hammer from there after the initial breakout. So that tells you that the buyers are still in business, and we did, of course, shoot to the 40,000 level, the next area. Now, as I record this, we don't know how this candlestick plays out, but let's just say it ends up like that. That tells you that you could see a little bit of a pullback towards 40,000. That's not necessarily a sell opportunity. That is an opportunity to pick up a bit of value. Remember, you're paying for this just like you are any other asset or any other thing that you can buy. The analogy would be, do you want to buy this Lexus or BMW or whatever at 40,000, or would you rather pay 47,000 for it? All things being equal, it's the same BMW. Well, you want to pay 40 if you can. So that's the idea of buying a pullback. It's literally finding things on sale. Now, it's hard to imagine a scenario in which you would want to be a seller, but clearly if you break down below 30,000, you will have broken through massive volume, massive support, and then at that point in time, you have to be concerned about the trend. But really nothing on this chart suggests the trend's going to end anytime soon. Notice this hammer here. We pulled back to the 50-day EMA. It wasn't successful right away, but it did work out eventually. Shows you that there's interest, I should say, is probably the best way to put that. Notice that at this resistance level, when we rallied here, we formed this big long-legged doji, broke down the bottom of it, and then came down to fill this area here to go looking towards that previous resistance. That's that whole market memory, support and resistance. These things all matter. These things all come into play. You know, the thing is none of them work 100% of the time, but in general, it will keep you on the right side of the trade, and that is what matters. You have a bit of a double top right here at resistance. We formed a shooting star, and then a hanging man right here. Both of those are valid sell signals. There's that M pattern, if you will. And we filled that target without too many issues. You see this time and time again. I know it seems simple. The trick is recognizing it while we're going through it. Here's a double hammer on a pullback. That suggests that we're going to at least come back and try. And that's where we formed that candlestick there. So as you can see time and time again, you do see patterns and they do give you a bit of a heads up. But you have to trust these things to work. That's the thing. It's a little bit different in the heat of the moment. But you get this breakout here, you have to trust that it works. You have to be willing to put your stop loss like halfway in the rectangle and just let it go. You know, aim for a target. Target 200-day EMA makes a lot of sense. This was an area where we'd seen some consolidation, so we pulled back. That's fine. Markets don't go in one direction forever. Notice how this was a very massive candlestick to the downside, high volume, but the next candlestick was green and it had even more volume. That tells you you've got some issues. There's a hammer here, shooting star there. There's a lot of confusion. Eventually, you break out of this area, and that tells you that you're more than likely going to continue to go higher. These are all things we need to pay attention to on the charts. You can save yourself a lot of headaches if you just listen to what the market is trying to tell you. The market is trying to tell you what it wants if you are there to listen. So here we go. This is the RSI. Right at the 40,000 level, a bit overdone. We broke down to a fresh low, lower low. Well, it's a sign that maybe it was time to get out. down here, we bounce from there. We're not overbought, we're not oversold, so that's a fair signal in the sense that, it's not trying to reach too far. Now that we've done this, we are in the overbought condition, and you have to be a little bit hesitant to pay all the way up here. That goes back to perhaps buying on value on a dip. So, the RSI is telling you, maybe you don't want to be a buyer here. It's not the be-all, end-all signal, but markets do correct. And when they correct, they give you plenty of opportunities. I highly recommend that you go through and find any chart you can. It really doesn't even matter the market, and use these indicators and see, what you could have looked at for a signal to go long or short. Now, in the rest of this module, I'll be talking about various cryptocurrencies, and I'll show you all kinds of examples of how you could have analyzed the chart and got involved. Clearly, once these moving averages spread out and we break out above the previous low, there has been almost no signs whatsoever of weakness, with maybe perhaps the exception of this little bit of consolidation where they had to absorb the gains. In the next video, I'll walk you through Ethereum and show you several setups there as well. Hello and welcome back to Cryptocurrency Master Trading Class by Wealthy Education. In this video, I'll run you through some real-life examples in the Ethereum market and how you could have traded it according to some of the scenarios that we have laid out in this course. So the first thing you do is you look at the higher time frame. I think at this point, it's pretty obvious that Ethereum is in a uptrend. The week forms a huge smile and it's a higher high. So that in and of itself tells you pretty much everything you need to know. And just as in the previous video with Bitcoin, I like to draw some pretty significant and major lines right away. So it looks to me, based upon previous resistance and here, that 1400 matters. I think that's a fair guesstimate. I also recognize that 1800 probably matters. We're approaching it as I record this, so large round number, why not? And you can see where the candlestick closed here for 1 week and then opened here the next week. I'm going to assume that 1600 matters as well. So let's go ahead and lay those out initially. So this is what I see. I see if you draw lines every $200, a pattern starts to emerge. And a lot of times you'll see this in a market. Not always, but sometimes you'll see this in a market where you just look at it and you're like, wow, it seems to be attracted to $200 increments or $10 increments or whatever it is you're talking about. So let's go down to the daily chart. Let's put our moving averages on first. Let's do 200. You can see we're well above that, as you would expect, looking at the chart. We're well above the 50-day EMA also. So here's the thing. Let's say you've missed the move and you're trying to figure out what to do. Where could you get interested in buying? Well, the first thing you can do is you can draw a Fibonacci retracement, and you could swing it up to here, assuming that this is your high, and you start to look for some type of confluence. And you might have 38.2 right around here, around 1200. And it's interesting because you also have the 50-day EMA there coming into play. So while you can't necessarily say that quite yet, you can see that if we turn around, that might be an area to pay attention to. Every $200 seems to be an area to pay attention to for that matter. You got your Bollinger Bands. Now, let's take a look at some potential trades. This is one of those scenarios where the 50-day EMA offered support, and we did squeeze. And as we started to widen out, we were going higher. Higher is important. You're widening out. You're picking up the momentum. You're picking up the volatility. and you're going in a specific direction. Look at the volume on this candlestick. That thing just took off. That's exactly what you want to see. We rallied. We came back to the moving average. You could have just bought there as well. Yeah, it's a stretch to call that a hammer, but it does suggest that there are buyers underneath, obviously. So let's go ahead and get rid of the Bollinger Bands for now. Just hide those. And take a look at this big move and then this pullback. That to me looks like that's probably a nice Fibonacci setup, and it was. Probably come back here to this swing low. As you can see, we reached the 50% fib and then turned around. We ended up forming a double bottom. That, of course, would attract a certain amount of attention by itself. Once we break above the 50-day EMA, it suggests that we are entering a more bullish phase, and then off we go. You can also see a bit of a triangle. That triangle gets broken to the upside. The measured move is for the height of the triangle, as you know. And we clearly got that. You can see we kind of paused for a minute and then took off again. So good stuff there. Let's pull up the MACD. So this was giving you a heads up here that we were perhaps running out of momentum. But notice, just as we crossed above the 50-day EMA, we got this cross here, and then shortly after that went positive with the histogram. That was a good sign. We got an increase in volume here as we were breaking down, and we got a cross there. The histogram starts to go negative. Those are all bad signs if you're wanting to buy, that is. You can see that we were oversold here, a little bit of a volume pickup shortly thereafter. The moving average on the moving averages on the MACD cross, that's a signal to go long. And then once you cross the zero line, that is even more. We cross here, so that is a trade from about here to here based upon the MACD. Notice this perfect little hammer right here on the 200-day EMA and the 50-day EMA. We got that golden cross right at the same time. You can't tell me that people weren't noticing this as it happened. So I certainly think at this point you can see how a confluence of all of these things coming together really comes into your favor if you're willing to wait for a couple of reasons to take a trade. So this entire time here, and really from about this point on, it became pretty obvious that we were in an uptrend and we probably go higher. You do not look for selling opportunities. One of the biggest mistakes that retail traders make is they see this and they go, hey, it's gone too far. I'm going to start selling it. Well, markets can remain irrational much longer than you can remain solvent. That's an old expression. And that's because they can do crazy things. You know, this is a little bit more manageable move than the Bitcoin move has been. But both have just been on an absolute tear. So with that in mind, you look at areas like this. This was previous resistance. It could be support. If we pull back there, we get a hammer, something like that. That is a potential buying opportunity. Notice this shooting star-like candlestick. That's technically a sell signal. But look at how bullish we were. You don't want to try to fight all of this. That just tells you, hey, maybe take profits. Maybe move your stop loss up. You know, if you had taken any of these hammers here, you could have moved your stop loss up to this area here when it showed that we were going to struggle. Nonetheless, it just showed you that you were probably going to get a pullback. And a pullback is perfectly normal and healthy. You can't fight that. The entire time you should be checking Bitcoin. Bitcoin's rallying as well. So it gives you the all clear with crypto, so to speak. Plenty of potential trades. Here is what ended up being a little bit of a counter trend trade. Again, not a big fan of counter trend trading. It can be done once you have some experience, but that was a triangle that broke to the downside. This was a nice ascending triangle. Remember, the buyers are becoming more aggressive. We finally break to the upside, and we clearly got, the measured move from that as well. I mean, there's no doubt about it. So, with that being said, once you pick a direction, meaning that you have a trend, then it's your job to let the market tell you when it's time to follow that trade. You don't buy up here just because you're in an uptrend. You want to find some value, or you want to see it break resistance. We're not really at resistance. 1800 probably will be, but that's a guess, and we don't trade on guesses. We are extended. There will be a pullback. It's inevitable. But at that pullback, you need to be thinking, has something changed in the markets? Are we going to start selling off cryptocurrency, or are we simply taking a break? As long as we stay above the 50-day EMA, a lot of traders won't short anyways. They don't really care what's going on. That's something to keep in mind as well. So you can see that Ethereum trades very much the same way as you would expect the Bitcoin markets to trade. In the next video, I'll take a look at several examples in Litecoin and show you how you could have approached several different setups in this market. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, I'll walk through some setups on the Litecoin chart. Now, you can see I have the weekly chart, and I'm going to go ahead and start placing some levels based upon previous action. So let's go ahead and make this 175. Let's see where we're at here, 2.25. And right here at 275. And let's go a little lower, say 125. Okay, so you can see that there seems to be some symmetry in the market. You'd like to see that because it gives you an idea of what other people are looking at. As far as the trend is concerned, we have been rounding. This is essentially what is known as a rounding bottom. This means that there's a gradual gain in strength. So I would call this an uptrend with issues above, obviously. So when we look at this structure on the daily, let's go ahead and put in our moving averages. This is the 200. We'll make this black. You can see we are well above it. And this is your red 50-day EMA. And you can see it's actually right below the most recent action. So this is very interesting. We can see right away where that comes into play. Let's take a look at the fib retracement tool. And so notice we had a massive pullback here on this particular day. And in fact, I'm going to go ahead and put volume up because I have a sneaking suspicion that there's massive volume here. So when you see a huge bar or candlestick like that, and it has massive volume, and then you see a little bit of a turnaround, quite often that will be a sign that maybe the market is running a little ahead of itself. It's running out of steam. The 50-day EMA causes a lot of interest, so does the 50% Fibonacci retracement level. And you can see that we bounced quite nicely, came back to the 125 level, and the 50% fib, or just a little bit above it, the 50-day EMA, all that kind of comes into play here. Now notice, structurally speaking, we are currently making a higher high. So it looks like the market is doing everything it can to reassert the uptrend. So let's go ahead and get rid of the fib for now. Now, when you look at this, you can see that I'm going to go ahead and hide these as well. Here is a rectangle. Notice that we break out of this rectangle. This is one of those very straightforward, put your stop loss in the middle of the rectangle, aim for the width of the rectangle. Or, if you remember, I had mentioned that a lot of times we will hit the target or somewhere close to it, pull back to retest this area for support. 2 hammers in a row right here just above the $50 level. Furthermore, you can see the 50-day EMA sits there, so that's a nice setup, and we're starting to pick up volume. All of that is definitely something that you can pay attention to, and then you can see that we're right in the middle of the Bollinger Band after breaking out. I mean, there are so many signals here just screaming to buy this. Nice Bollinger Band squeeze. We broke out of it, rallied rather significantly, formed a little bit of a hammer right here. Why is that level important? Well, that level is important because there was resistance there previously. So we found support. As far as selling is concerned, you can see that we broke significantly below the Bollinger Band. Whether it's a sell signal or not, completely different question, but it does show that at the very least, you need to be out of the position until you get that signal over here. There was a pretty significant sell signal here in the sense that we fell, rallied, made this lower high, so that's worth paying attention to. Let's put the MACD up. We got the MACD here. Notice how we crossed right here. That was your first sign of trouble. And then when we could not make the same level or higher, it shows that we're running out of momentum and off to the races we were. And in fact, you didn't get an exit signal based upon the MACD until you were down here. So, you could see that there's a plethora of signals, and really you don't want to use all of these indicators at all times, but it's not a bad idea that if you have a potential setup to take a look at least a handful of them, because you have to think that not everybody trades Bollinger Bands, not everybody pays attention to moving averages, not everybody does Fibonacci or RSI. But if you have a couple of those moving in the same direction, you're going to get enough people out there that are thinking the same thing. And at the end of the day, that's really all it takes. I mean, look at this. This is just beautiful. This entire time, basically between the 15th of January 2019 to July 9th, that we just held right here on the 50-day EMA. You did get that golden cross here, and it worked quite nicely. There are multiple ways of playing the golden cross. Some people would wait until here to get out when it had the death cross. But really, that is essentially a break-even trade, so that doesn't make any sense. Some people will wait until you get a fairly extreme move, breaking below the 50-day EMA, and that would have you out here. That makes quite a bit more sense. So it comes down to how you choose to use that particular tool. Notice how we had swung this way, made this high here. We came back, and remember, earlier I had told you the 50-day EMA is a place a lot of people look. That makes sense for a potential buying opportunity. But remember I told you that if we only make it back to the 38.2% Fibonacci retracement level, quite often it ends up being a sign that we are going to see an extended move, and that most certainly is exactly what we got. nice strong candlestick closed almost to the top of the range. That suggests that there's some follow through. You originally had this breakout on huge high volume. So, for that matter, you could, and some people will do this, you will look for, is there an extension after this? Where could we go? So let me go ahead and get that. So your extension, 1.618. So once you do get in, that's where you're aiming for. And you can see you got that rather quickly. There are simple little bits and pieces here where you have, this was a resistance. It became support. A couple of hammers. We shot higher. Just like this repeated itself later to be important. We formed a shooting star. This shooting star was a negative sign, and so was that one. And then you started to see the market fall. Quite frankly, there are so many different signals on any chart that your job as a trader really should be to take a look at potential setups, and you just walk through them. Let's even go to the 30-minute chart. And now that we're on the 30-minute chart, let's change moving average, and let's do exponential. And we'll do the 9 and the 20. Okay, so we could go to the crossover system if you want, right there. Now, what I think's probably going to be more important is something like this. So you can see that we have been consolidating for a little while there. Let's go ahead and see if, did we get some type of volume expansion? And clearly we did. Spread on the moving averages spread apart, and we're just off to the races. There's nothing here that looks remotely bearish or like the market's going to be in trouble. Just as you can see that we had been consolidating here, and this may have caught a lot of people on the wrong side. We shot higher on this volume, but we never had the follow through. And notice we got this crossover here. It's technically not a death cross. It's a bearish cross, because a death cross is specifically the 50-day and the 200-day. But looking at this, you can see we clearly broke some type of support. So with your relative strength, you can take a look and you can see that while we did not get into an oversold condition, notice how the strength is dropping and the price is essentially going sideways. That's not a signal in and of itself, but it does give you an idea that perhaps not all things are quite right. You can go to the MACD, and at this point, there is a cross right in the middle of this. This led this. The histogram started to go negative. That tells you that perhaps there's trouble. You can see that this area here was resistance and support. So it does make sense that once you break down and you retest it, that you're probably going to that area. Notice the shooting star right here at the 9 and the 20-day EMA and the bottom of this area. And then the target down here at 150 forming a hammer. That not only is a perfect target, but it also suggests that the buyers may step in, and they did. They didn't push the market much higher in the short term, but clearly that hammer told you that there was a bounce coming. So as you can see, there are plenty of opportunities and plenty of signs of where the market's going over time. I cannot stress enough at how important it is to do exactly what I'm doing here. Notice this big massive breakout from here. Let's check the volume. And again, you can see volume exploded to the upside. That suggests that we are going higher. It's just, think of it as each candlestick is a chapter in a book, and the story kind of builds up. There are some chapters that are filler, and there are some that actually mean something. All of these things in a market occur time and time again. They repeat themselves. So it's worth going through and marking up your charts and seeing exactly what happened. So in the next video, I'm going to explore Ripple, and I'm going to show you several setups in that market that you could use to trade. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, I'll walk through some potential trades in Ripple. So you can see I have the weekly chart out again. And we'll start by doing the same thing that we do in all markets. We look for potential support and resistance. So we'll just mark here at 1.0. And then we will look at various areas. Somewhere right here at about 50-ish cents. I'm going to mark it 50 for now. We can adjust it if need be. I would venture to say that somewhere underneath, somewhere around 25, and the reason I say 25 cents is because we launched from just underneath it. So there you go. You have the outlook of the market. We look at the structure in general. Big, massive basing. Seen a little bit of volatility as of late. One would assume if it follows the rest of cryptocurrencies, which currently Bitcoin and Ethereum and some of the bigger ones are rallying. So that's something worth paying attention to. That should, in theory, drive up prices in most cryptocurrencies. Now, when I look at this, and I drill down to the daily chart, we begin to see a little bit clearer picture as of late. You can see clearly that the 50-cent-ish, this might be more of a zone. Think of this as like a thick line of maybe a cent or two, continues to cause issues. Let's go ahead and see if we can learn anything by looking at volume to begin with. And you can see that some of these big, huge candles have massive volume spikes in a market that, quite frankly, is pretty quiet most of the time. Big, massive red candle, big, massive red spike of volume. You see a big spike of volume here, but very little in the way of price movement. Very interesting. Hammer here. We break above the top of the hammer, and we continue to go higher. We go looking for this previous support, which is now resistance. We most certainly get it on a strong candlestick. We break above it and then break right back down it on high volume. So not a big surprise to see that we kind of whipsawed a little bit there. So let's go ahead and put Bollinger Bands on this. And as you would expect, this broke the Bollinger Band. This broke the Bollinger Band, and this. You know, we had this Bollinger Band squeeze, so we can look at this breaking outside and closing outside of the Bollinger Band as a potential breakout. I would clearly think that would be the case. Looking at it. So here you can see the MACD starting to shift attitude a little bit. And then right about here is where we start to see the histogram grow and the moving averages spread out. So that gives you more confluence. Notice how we run into a little bit of a cross right here as we hit this 20 SMA. Now, remember, on these squeeze and breakouts, we want to buy it and then let the market tell us when it's time to get out. So you can either get out here. This is based solely upon the Bollinger Band, or down here when we break below it. Or you could use the MACD moving average confluence here as, you know, a sign that maybe you want to, at the very least, move your stop losses up. your stop loss on the way out there, just simply on the other side of the squeeze. So when I roll back, you can see there was a MACD cross here, right? Notice how price was rising. The moving averages on the MACD were falling. That's that divergence that we had talked about previously, giving you a little bit of a heads up as to some trouble. You could also take a look at that and the divergence as a sign of maybe shorting. Granted, the safest way to short would have been to wait for a bounce back, below the moving average, a bounce back to the moving average, and a failure. Not necessarily the easiest trade to take, but certainly a valid trade. As you zip back, you begin to see patterns of squeeze, break, squeeze, breakout, squeeze, breakout. Pretty wild right now as I record this. Probably will change again rather soon. We go to the 1 hour chart, and you can see in this scenario here, we had a nice squeeze, we had a cross, and we definitely had a squeeze and a fanning out here. Again, you could have used the moving average, or you could have used the crossover right here to get out. Nice volume here as well, so that tells you there's something going on that's worth paying attention to. When I zoom back, here is an example of a Fibonacci retracement trade. So you pull back to the 50% Fibonacci and you go back to the highs, but you fail there. And, you don't continue like you hope. And you get a MACD crossover shortly there afterwards. So what this can tell you is that we're not going to have continuation. And it really comes down to how you play fib. Some people will simply try to take profit there. Other people want to see it continue going higher. Truthfully, there's more money in it made going higher and taking the chance. But obviously, you don't want it to go against you completely. Once you got this cross, it's time to get out, and you're out. Pretty straightforward. A cryptocurrency like Ripple is going to be a little bit different in the sense that it has micro movements. It has a lot of micro movements. So let's do a couple of moving averages. Exponential. Let's make this black for the 20. And then you can go into that cross system. We crossed here. You ride it all the way up to here. Sideways. Nice downward cross. Nice fanning out. It's a sell, close the trade type of situation. That could work in those scenarios. Your risk is relatively limited, mainly due to the fact that it only moves a few cents at a time. So that is one way to play the markets. You can also look at the RSI. You can look for overbought and oversold conditions. It was oversold here. The crossover shortly thereafter told you to buy. You most certainly had to wait to get paid, but you did eventually. Right up here, you got overbought a couple of times. Eventually, you have to get out. When you see this overbought scenario, but at the same time, you see the moving average is still fading or fanning out, I should say. At this point, then you start to look maybe at the candlesticks themselves and see if the market's trying to tell you anything. So, for example, it's a doji there. That's a shooting star, both of which suggest exhaustion. So there's multiple reasons that maybe you should be taking profit there. Either way, Ripple is a little bit different in the sense that it moves in such small increments. at a time. So the best thing about this crypto is you can get involved rather cheap. You can add to a position. You can take a position out of the market pretty quickly. It's not quite like the core holding that a lot of people have, like in a Bitcoin type of situation. And one could make the argument that for a long time there has been a lot of accumulation here, although, whether or not it's actually accumulation, that might be a bit of a stretch because the volume was so quiet. But now it looks like we're starting to wake up a little bit as I record this. So clearly, with a big, massive shooting star like this, that's a bearish sign. But if you were to break above that, that shows real conviction. If you remember me talking about that candlestick pattern. And then at that point, could really open up the floodgates for Ripple to go much higher. In the next video, we'll talk about Tezos and talk about multiple setups in that market. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, I'll go through several setups in Tezos and explain how you could have traded this market from a technical analysis standpoint. So as per usual, let's mark off our levels that make sense from a longer term standpoint. So you can see the 250 level has been supportive. $5 level has been resisted. We have cut back and forth between here and 250, between 2 and 3.5 as well. So we may have a little bit of adjustment down the road, but as things stand right now, I think this looks relatively good. Let's go ahead and let's make that $4. And let's make this one 1 even. Okay, so pretty straightforward. You can see that the market shot straight up in the air and then gave back the gains, and now looks like it's trying to go to the upside. It clearly has shown itself to try to rally. You could even make an argument that we have formed higher lows, 2 higher lows and 2 higher highs. So that is an uptrend in and of itself. So let's go ahead and flip over to the daily chart. Again, this to me looks like a market that is trying to rally. Let's put some Bollinger Bands on this to try to get a grasp on the volatility and the overbought, oversold conditions. Notice how in the latest trading, it has definitely respected not only the 20 SMA, but it's also respected the Bollinger Bands when we get a little too overdone. Especially underneath here, we broke down and it turned around as well. A couple of shooting stars. That's the first really kind of dead giveaway for me that we could be running a little bit of trouble. We break above an area that's been resisted. We form 2 shooting stars in a row. That being outside of the Bollinger Band, I think that all lines up for a potential sell. Once you get below that level, we come back, we even retest it and fail again. So at that point, there isn't a whole lot more to ask. Out of the market, you just put your stop loss on the other side of these candlesticks. You probably aim for, I'd say, support here at 180. You do hit it eventually. It was a little bit of a bumpy ride down there, but clearly that would have worked. Let's do some moving averages. So we'll do the 50 and the 200. Notice that we broke above the 200 very shortly, or very suddenly turned around to fall apart and the moving average here. Let's see, this is the 9. So there we go. Let's make that the 50. Let's make this red. There we go. So you can see the 50 kind of going sideways, but notice how, let me hide the Bollinger Band. Notice how the 200-day EMA was respected. Now, as we have broken higher, we have just done the golden cross, so that might be something worth paying attention to. Nonetheless, on the breakdown here, another thing that you would add to that trade is at the 38.2 Fibonacci retracement level that we failed from the move lower. So that is yet another reason to think, maybe it's time to sell. It certainly worked out quite nicely. Let's take a look at volume. So you can see volume is stronger here. That's what you want to see. This is kind of a nice little example of accumulation. You want to see volume rallying, prices falling, volume stays very consistent. We chop around, and then eventually we break out on this high volume candle here above 180, which was obvious resistance. You could put your stop loss under the last swing low here. And what would you aim for? Well, you would aim for this previous support, which should now be resistance. It was, at least that day, we did break above there. But that was a nice, tidy little target. The volume was strong on both of these days, so really nothing to be overly concerned about. When you look at this chart, you can also see, well, here's an example of an ascending triangle right there that we broke out of on high volume. So that's exactly what you want to see. That was your target, and we hit that almost immediately. So nice little move, stop loss on the other side of the triangle, and you're ready to go. We hide these moving averages. And I'll even hide the volume here for a second so we can just look at pure price patterns. Little bit of asymmetric triangle here as well. What's your target? Well, you measure from the high to the low. That's basically that. And you can see we got that pretty quickly. So that's pretty straightforward. Notice how we just fell off of a shelf here. Some people even call it that. There's just kind of like this support area. Everything's going quiet, 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 and then you just break down. That is a sign to sell. Put a stop loss on the other side as far as a target is concerned. At that point, in all honesty, you really didn't have a whole lot to work with back here on this chart. So at that point, you begin to look for candlestick patterns that tell you that maybe you're in trouble as far as, will it go lower? This hammer right here is the ultimate sign, but you can see hammer there, hammer there, hammer there. So you had plenty of signs that, hey, maybe they're going to fight here. Nice little trade, about 87-ish cents that you could get on it. And as you can see, Tezos is very erratic. So you have to be willing to put up with a lot of volatility. That's another thing I probably should point out here is that know the crypto that you're dealing with, because some crypto is much more volatile than others. Tezos, for example, is much more volatile than Ripple. Bitcoin, it's not even necessarily that it's so much more volatile than some of the other ones. It's the fact that it's so expensive. As I record this, Bitcoin's $46,000-ish. So a 1% move there is going to be much more expensive than a 1% move if you own an entire coin here, obviously. So that's something to keep in mind as well. Obviously, you need to position your size for that particular trade. At this point, if you were to get long of this market, so here is, it's not really a candlestick formation or anything that we had talked about previously, but these are the type of things you need to look for. Well, notice that we have failed on the daily chart to break above these 2 wicks. And if you extrapolate it out, you can see that there was a little bit of resistance there previously and there. So what happens if you get a candlestick that closes above there? Well, then it's a buy signal, and you start to look for each one of these areas over here as potential targets. Then you have to ask yourself, well, where do I put the stop loss? Really, at this point, I probably would have to drill down to a shorter time frame, because if you put your stop loss on the other side of the candle, your risk to reward just isn't there. You might be risking, in this case, something like 50 cents to pick up 10. Well, that doesn't make any sense. You want to make a bigger move. So then you drill down to maybe something like a half an hour chart. Well, at this point, there's your high. So if you can break above there and you can put your stop loss here at 320, get in at 341, then you can start talking about 360, 380. It becomes much more palatable. Just something to keep in mind. Now, having said that, this is not a marketplace that's very easy to trade short term because it does chop around so much. So make sure you keep in mind that, what's its average move like? Something like Bitcoin's a little easier to trade because it may move $1,000 in an hour. This has such a micro movement and a lot of wicks. So it kind of tends to make itself more of a swing trade, which is when you're buying the swing high or the swing low, you're selling, up here, buying down here kind of thing, hanging on a little longer. Even though it might only be 7 or 8 cents, it tends to lend itself a little bit more towards that type of trading. So certainly you want to be aware of the attitude of the market you're dealing with. So with that in mind, the next video is going to feature Tron, and I'll show you several different scenarios to trade in that market. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, we'll take a look at the Tron marketplace, and we'll talk about some potential trades that could have been taken in this market. Now, unfortunately, we do not have a long history like with something like the stock market. And that is one thing that you will run into with crypto from time to time, but you make do with what you've got. You can place your lines like you would any other time. So, for example, 4 cents, I think, makes quite a bit of sense because we have seen a lot of wicks here. And here would be like 5 cents, roughly. Let's go ahead and just mark it as 5. And I suspect, generally there's some type of symmetry to a lot of these lines, support and resistance areas. So here's 3. And I'm going to guess that probably 2 comes into play. And even 1 would come into play. So it looks like we've got a grid of about every cent something happens. And, you can even see that the high was basically 10 cents. And, did we have a reaction at 9? So these are the things you need to look at on a chart initially. Now, the most obvious thing on this chart is that we had broken to the upside and broken towards 10 cents almost immediately, first couple of weeks, and then formed this massive shooting star. This is a huge shooting star. It's over 2 cents. And in this particular market, 2 cents matters. It's quite a bit. So Now that I'm laying all these out, you'll see that this is a grid that I think holds pretty true over time, and we'll demonstrate this occasionally. So we have all of these spots on the chart. You can see this massive shooting star. Put your stop loss on the other side. You break through the bottom of it, and maybe wait for a break below the 8 cents level. Turns out to be roughly the same thing. And you can see the very first candlestick broke down massively, broke down to 5.5 cents before rallying and saving itself for another hammer. So people were thinking, okay, maybe we're getting back into a bullish mode, form this doji, and then finally it gave way. So there was a clear smash and grab type of trade. And if you look, this is an area that I would suspect probably could also be marked maybe at 5.5 cents for support and resistance. Looking at the weekly chart further, let's go ahead and put some volume on here. That's another thing, is that volume wasn't that high at this move. So that shows you that perhaps there weren't as many people interested in Tron at the moment. So looking at this, here's a candlestick that shows a massive input, but a massive rejection. You can see that it took months to actually get back up there. Again, a massive push to the upside at 5 cents. We pulled back. Well, here at this point, it's clear that we are trying to form something like this. That is a little bit of an outlier. And this is where we need to talk about liquidity. Liquidity is simply, is there enough order flow? Are there enough buyers and sellers? I suspect that somebody pretty big got into the market here. And that's why you get these nasty wicks like this, because, you know, if you come in and I'm just using basic numbers here, but let's say you want to buy 100 units of something, but down in this area, there's only like 20 units available. So then the thing is, you have to, when you put your order in, you have to find the next 100 and the market will fill you. Maybe it takes all the way up there to get that 100. And then that concludes with the wick falling back down where you find more demand. In these smaller cryptos, you are going to run into this problem. So if you're trading on the weekly chart, you're probably hanging on for the longer term anyway, I guess is the point. You can see volume is picking up, so that helps with liquidity. Let's go ahead and drop down to the daily. Now, notice, and we don't know how this is going to play out, but as I record this, the 5 cent level mattered, and it looks like we're trying to form a shooting star. Well, where would you expect the shooting star to go? I think somewhere around 4 cents, maybe just a little bit under. So that is a potential setup going on right now. You could take a look at, this is kind of the perfect setup here. Get a nice push higher and a pullback to this hammer. You break above the top of it and you eventually grind, especially once you get this very bullish candlestick there. So simple candlestick trade. We can put our Bollinger Bands on and we can say, okay, well, does this thing tell us anything? And this was clearly more than 2 standard deviations higher. So it shouldn't be a huge surprise that we had to pull back. We had the squeeze, and we got that candlestick with the volume that we like to see. So where are we going? Well, you have to look at the next major area. We're right here at the end of this day. We can put our stop loss on the other side, like any other time. We're probably going to make a move towards 4 based upon the bodies. In these thin markets, you want to pay more attention to the bodies. Not that you want to ignore the wicks, just that they carry much more weight. And typically that's true with most markets, but it's especially true with these very thinly traded new crypto markets. Notice that we're in a nice trend leading up to this sell-off and then continuation. That is something that you need to take into account as well. So let me get rid of the Bollinger Band. So now I will let the 200 and the 50-day EMA show up again. Got a cross here. This is the golden cross, and it's spread out nicely. And in fact, you can see that it hasn't really come close to shutting down. And crossing back over for a death cross. And this is one of those scenarios where it can keep you out of trouble. You didn't necessarily have to mess with it. If you were a longer term believer in Tron, you bought and you'll just trade when it tells you to trade. In the meantime, though, even if you are that longer term trader, you look at a candlestick like this and you know that, hey, we're probably going to get a pullback. That's perfectly healthy. But if you know that ahead of time, it's much easier to deal with. Let's go ahead and take a look at the RSI. There we go. Overbought condition, not a huge surprise. Look at that volume spike that we pulled back. Not a huge surprise that we're getting overbought here as well. You would expect that. So you would expect the market to pull back to kind of fall into this area. Same thing here, pull back. Here, pull back. And it looks to me like Tron is very sensitive with the RSI. And it makes sense because, again, it's a small market. It's not a huge market. Take a look at this perfect setup. Volume, hammer, 1 cent, RSI oversold. That screams a reversal, and that's exactly what you got. It is a bit difficult at times with a market like this to read too much into anything, but like this double top here, while it wasn't overbought, notice how the relative strength index was dropping. That tells you that maybe we don't have the strength that it looks like we have. Got that double top M pattern. So if you break down below there, you can see that we fell. Formed a hammer, bounced to retest, formed a shooting star, formed another shooting star, broke back down, and continued the move lower. These thinner markets are a little bit difficult to trade on short-term charts. They can be done, but you need to be a little bit more quicker and a little bit more sensitive. So, for example, down here, oversold, you buy that, you aim for the next major area. That's 0.3 of a cent. Overbought at 3.2 cents. You're looking for probably a move to 3. This is completely overbought. This gives you a little bit more of an opportunity for a move. But again, very difficult to trade this type of market in these short time frames. And that's why I think most people that are in a cryptocurrency like Tron are, what you would consider to be true believers. They truly believe in this specific crypto and what it's going to do for the world, as it were. Regardless, the one thing that you should be paying attention to is we're in an uptrend. So you're looking for buying opportunities. You're not looking for selling anytime soon. You break to a fresh new high and take out that 5 cent level. Then you begin to look for a place to place your stop, maybe about halfway between these levels that matter in the market. Or if we continue to drift lower, then you start to look at this 4 cent level. There's no point in fighting the market. It's a great way to lose money. You never do it. Again, though, you need to give yourself a lot of room in these types of markets in general. So that's why you're almost always better off either trading, at the very least daily, if not weekly. And you have to truly believe in the market that you're dealing with. As we are overbought, but we have broken above this resistance barrier now, one has to think that there will be buyers underneath looking to get involved somewhere right around, this 4 cent level. It's been important in the past. It should continue to be important. So I would expect a lot of buying pressure in here, but we are overbought. So that breather actually offers an opportunity. You have to think of it as going to buy a television or whatever. You want to pay $500 for it, or are you much more interested in it at $400? It's the exact same thing. the target on a breakout from here. There's really not a lot on the way up here that you can base a whole lot on. So you can either do an attempt to get back to the highs, or you can do an extension, fib extension. 1.618 is closer to the 8 cents level. It's not quite to the highs, but that is another route that you could take a look at. But in general, if you're trading in the weekly chart, you're looking for bigger, longer term moves. So a little bit different in that scenario. In the next video, we're going to take a look at Cardano, a cryptocurrency that seems to be moving up the charts as far as popularity is concerned. And we will find several setups we're taking in that market. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, I'll walk through Cardano and see if we can find some decent setups here. Now you'll notice this market doesn't have a ton of long-term history, and it's also in the midst of being a runaway market. So this will be very interesting to see if there were signs that we could have gotten involved in what has recently been a 600% gain in this marketplace. Well, the first thing you do is you look for any support or resistance, and you can see that we did try to rally at that point, but struggled to get above the 40 cents level. And, we broke through it, we rallied, and then we just spent a good 2 years just kind of hanging about. The 5 cents to 10 cents area really looked like it was going to go nowhere, but those were pretty tough times for most crypto traders. They were, the smart ones were just simply building up their portfolio, and you can see it's paid off quite nicely. So the very first thing that I would point out is that there is a certain lack of clarity, but you can see lots of wicks here. So one would expect that if we revisit this area, there might be a little bit of noise. And it's 25 cents, so I suppose there's a certain amount of psychology involved in it. And you can see that we pulled back to there to find support. It wasn't like it offered a ton of resistance on the weekly chart, but clearly it respected it on the way back down. So, you can leave that line there, I suppose. You can also put a line right here at 10 cents. I say that because of this area here. You can see that it was attracted to there as well. Okay, so you can see volume was almost nothing before 2019, has been picking up as of late. Let's drop down to the daily chart. Things become a little bit more manageable here. So the first question most of you are probably going to have is, how could I have made this move? Well, or been involved in this move? There's a couple different things I see here. First thing I see is there was a triangle there that broke to the upside. Broke pretty significantly, once you got through these couple of candlesticks. Another thing that I would point out is that we had been going sideways and doing nothing for a while, and then started to see the volume take off. And I'm willing to bet that the Bollinger Bands will show a familiar setup. And you can see we did, in fact, get a break above there. We got a little bit of a pullback, but if you put your stop loss on the other side of the squeeze, you were never anywhere near being in trouble. And then you got the same setup again, volume picked up, and you've really been off to the races since. You broke through the 25 level on increasing volume, pulled back, formed this hammer, which then in turn ended up being part of a larger triangle, and we've taken off. Another potential setup that I see Go ahead and hide the Bollinger Band. It's based upon this candlestick here. So we have broken above the 40 cents level. Now remember, 40 cents mattered because that was that attempt there to recapture the market when we first started. So now that we have taken out 40 cents, notice this candlestick. It's a doji. If you break the top of it, it means something. It means that we are going to continue to push higher. And it's just been taken off since then. Now, the problem that you have, and this is maybe a lesson in what not to do, if you get into the trade down here, like for example, you take the break of this, you put the stop loss on the other side of this doji, and that's fine. You're fine. Nothing to worry about. But unfortunately, far too many traders, and this seems to be especially true with crypto traders, they see something like this and they want to buy. But what's going to happen is sooner or later you run out of momentum and you fall. Markets can't do this forever, not even crypto. So if you're not involved at this point, you're looking for a pullback. You're looking for a place that makes sense to perhaps look. Remember, the market likes big figures. There's a certain amount of psychology to it. So 50 cents might be an area where you might be interested in. You could also take a look at this most recent move. And you could say, okay, well, I want to buy it if it gets somewhere around half. So that's 55 cents. 61.8, 50 cents. So it's another reason to think that the 50 cents level might be important. Let's put some exponential moving averages. Well, let's just put some regular moving averages. I guess this is the daily. So let me go ahead and make this red and make it 50. And we'll make this 200. Make it black. Okay, so the 200's not even in play. We did get a cross and a spreading of the moving averages, so that was the beginning of your trade. Kind of a moot point now, but clearly you are seeing that the longer-term traders had been involved. So the question is, what kind of action do we get? Do we go a little higher and then maybe drift lower with the 50-day EMA trying to come in at the 50 cent level? I think it makes quite a bit of sense. Do I know it's going to happen? No, of course not. Another thing you need to be aware of is this could go to $2. You just don't know. But what I can tell you is if you buy it up here after this type of move, odds are, and that's all you're doing is you're playing the odds, that you're going to get, you're going to find trouble. Doesn't mean you won't be fine a few months down the road or whatever, but there's no need to tie your trading capital up. You can see that we have been outside of the Bollinger Band. We're starting to fade back into it. That's another sign that maybe we're going to roll over. So here's that Bollinger Band squeeze. And there's that familiar breakout we take off, like I had said. Here's another example. And then there's this hammer. So that brings up the 25 cent level. We break this resistance barrier, and then we come back, we form this hammer right off the middle of the Bollinger Band. Break the top of that candlestick, you put your stop loss on the other side of it. You never find any trouble whatsoever. This is interesting because the 200-day EMA has held a couple of times. And what's even more interesting to me is that there was a hammer right here and then right here at the bottom of the Bollinger Band. So in a lot of ways, Cardano was screaming that it wanted to go higher over the longer term. You can see that we had the golden cross here, and we never crossed back over. So technically, if you're a moving average crossover system trader, you've never gotten out. You're in at roughly 5 cents and you're hanging on to 75. Again, that's going to be more of a longer term believer type of situation. But clearly, you can see how that worked out for them. Here is a pattern that I find interesting, and that's because it's actually a failure. Remember I had mentioned at one point that sometimes a failed pattern is worth paying attention to. So look at this ascending triangle. This tells you, hey, we should be going higher. But notice this massive shooting star at the 10-cent level. We broke back into the triangle. Now, typically when you get a breakout of a pattern and you go back into it, that'll negate the whole thing. And quite frankly, a lot of times you see the exact opposite happen. So if the buyers have been pushing and pushing and pushing, and then they finally get broken through, well, what do you think happens? What happens is everybody in this area of the trade and this area up here are all gradually losing money. So it was a nice setup. And then you can see that down here, we did find a little bit of support. Makes sense. That was an area where the market had bounced from. So that is a trade from a failed signal. You do get those occasionally. Nonetheless, this is a market that offers plenty of opportunity down the road. But again, you don't want to pay 75 cents for Cardano when exhaustive moves like this almost always pull back. And a lot of times they pull back rather quickly. So let's say you can get in at 52. Well, that's a lot better. It gives you a lot more runway to pick up profits than paying all the way up there. So with that in mind, you can see how that was traded and how we could even use a failed pattern to place what ultimately would actually end up being a counter trend trade. Although that's not necessarily, what we were trying to accomplish. But clearly, it looked like the market was ready to take off and then it failed. In the next video, I'll talk about trading Stellar. And of course, we'll look for several particular setups that you could have used in that market. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, I'll run through some examples on Stellar. This is the weekly chart where I always start, and I'm going to lay out some obvious support and resistance levels. See, 20 cents I think makes sense right there. $0.30 I think makes sense there. 10 cents makes sense just because it's the next 10-cent increment. A lot of times you can lay that out and you'll see that pattern play out. It's 10 cents. We'll try another 10 cents, see what happens. And then up here, let's make this 40 cents. So the first thing that I would point out is that there was a setup on the weekly chart right away. We broke through this support level here. This was a rectangle that measured 10 cents. So breaking down below the bottom of it, your target would be 10 cents from the breakout. And actually, really, the support extended down to 9 cents. So you could have aimed for 9 cents, but I think 10 cents was good enough. Your stop loss would have gone right here, halfway through the rectangle, like we have spoken about previously. Now let's go to the daily chart. Notice this stair-stepping pattern. Now remember, 20 cents was an area of previous support. So when we did break out, it makes sense that that would have been the initial target. Now let's see if we can find the setup. Let's go ahead and put volume on. So the breakout here was on high volume. That should have got your attention. Notice how the volume was picking up along the way. I'm willing to bet that this Bollinger Band breakout squeeze trade showed up, and there it is right there. That candlestick breaking above 10 cents meant something. Volume picked up that day, and then it just took off. Made sense that 20 cents was where we ended up. We were outside the Bollinger Band. We formed a shooting star. If you are a trader who's willing to take a lot of risk, that's a sell signal. If you are a little bit more conservative, that's not a sell signal. That's just a signal to either take profit or move your stop loss up. For myself, Probably would have taken profit. Then you had this massive, it's the exact same trade, but a much bigger candlestick. And that tells you need to be thinking long again. Shooting star, that's a negative turn of events. Hammer, that showed positivity. And on a hammer, you put a stop loss on the bottom of the candlestick when you break the top of it. You probably sweated this out for a while, but you never came anywhere near your stop loss. You would have had to have a 9-cent stop loss. And at one point, you were down roughly 6 cents. So, it might have been uncomfortable for a minute, but when you set up on this, that's your target, and you ended up hitting that. So, as we go down into the past here is an interesting setup. Massive volume breaks through the Bollinger Band, and then we form this big red candlestick, wiping this candlestick out, essentially turning it into a hanging man. That's not the perfect hanging man, but tells you the same story. You sell on a breakdown below there. You see some support there. If you are conservative, remember I talked about flipping at the Bollinger Band, you could break down below and then look for a sell signal there, like a failure. That certainly took off. So if you were a little bit more conservative, you could put a stop loss on the other side of this and then watched it rip. So let me get rid of the Bollinger Band, and I will put exponential moving averages. Well, no, I'll put simple moving averages for now. And let's make this a red 50. This probably, I don't know that we have enough history on this chart, quite frankly, to make this as useful, the 200-day. You can see that there was a golden cross and then a death cross. So it was kind of whippy, but the death cross certainly worked out. Notice how the market on volume broke above the 50-day EMA, kind of danced along there, and then on volume rose again. Once you break back above the 200-day EMA, that is a sign that momentum is starting to pick up. I mean, once you break above the 50-day EMA, that is as well. That's shorter term, but that's longer term momentum coming into play. Notice this hammer-like candlestick right here, right at previous support at 6 cents and the 200-day EMA. Furthermore, I'd also point out that the pullback right there with the 200-day EMA, previous support, hammer-shaped candlestick, 50% Fibonacci retracement level, 200-day hammer, 50% fib with an uptrend, previous support. That's at least 4 reasons to go long. You put your stop loss on the other side of the candlestick, maybe a couple cents down. So where's your target? Well, your target minimum is going to be up here to capture the Fibonacci retracement move. So that's your minimum target. And eyeballing this without measuring it, it looks like it's about a 3.5 to 1 target. As long as you have good risk to reward ratios, over the longer term, you should do quite well. It is when you don't, when you take these where you're risking 5 cents to pick up 3, you do that enough, you'll end up losing money. But if you are diligent about your risk to reward, you certainly have a much better chance of making money longer term. That's why you wait for a move like this. You wait for it to pull back, because if you buy it up here, you're just now back in the green, as it were. Your stop loss would have to be here on a break above this candlestick. And it's not that you can't do it. It's just that you better be prepared to sit on it for months. So that's why we don't trade like that. Plenty of other things to look at on this chart as I glance through it. So there is a triangle So the question is, we did pull back. So did we get our measured move? And yes, right to the penny almost. So that's definitely worth paying attention to. Now, you would have had your stop loss here. Would you have moved to break even on the hope of it going farther? Maybe. You may have got stopped out of break even, but clearly the signal was there. Stellar moves, it does trend nicely, but it's another one of these kind of thin markets. So like on the hourly chart, for example, you are going to struggle sometimes to find setups that are as clean. I mean, I do see one here. That's a massive symmetric triangle. And now that we have broken higher, and in fact, we just tagged that a few hours before at 44 cents. So nice setup, really. You can also change this is exponent. That's a simple. So let's do the moving average exponential. There we go. So let's make this 20. Let's make this black. Okay, so yeah, I mean, looking at this triangle, you did have the moving averages kind of twist here and there, and then we opened back up on volume on a breakout. So you could have even taken your time getting in there. The point on this is that these technical analysis bits and pieces here do work, but like on a shorter time frame on these thinner markets, these smaller cryptos, you typically need to give it a little bit more room. Now, on a daily chart, it's not too bad, but like on an hourly chart or, even if you go down to like 15-minute chart, the setups aren't as clean because you see all of this choppy jaggedness. There's a lot of back and forth here. So do keep that in mind. It's a little harder to day trade some of these smaller cryptos, but you can see that those setups all did pay off. The one exception might be that triangle I showed that may have taken you out at break even. Once you hit the target, it just comes down to whether or not you claimed your profits right away or took half off, however you wanted to manage that. In the next video, I'll take a look at potential setups in Zcash. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, we'll take a look at Zcash. So you can see I have the weekly chart up as usual, and again, we will look for areas of support and resistance on the longer term charts. I'll clean these up as we go along. So 150, I would suspect, probably be about where that is. This is going to be, let's call this 300. And let's call this 500. And I assume that you by now recognize that as resistance. That has resistance and support. Support and resistance. Let's go ahead and make another one down here. There's obviously a certain amount of support in this area. I'll make this 50. And we'll take it from there. So, first thing that you need to pay attention to is what the trend is. And right now, the trend is going higher. It looks as if we are trying to complete this rounding bottom. It's basically just what it sounds like. It's just the market trying to pick back up after a significant breakdown. It's a long kind of grind, and tends to be a little bit more reliable if we do break out. So the first thing that you need to see on this chart is if we break this 150 level, that's going to be a big deal that we will then probably continue to go much higher. So let's go ahead and drill down to the daily chart. And you will notice multiple reactions to this level here, for example, the $50 level. And one of the things that I see is the head and shoulders pattern right here. So you can see that we did this. And so what's your measured move? Well, your measured move's from 75 to 50, so that's $25 on a breakdown below the neckline. And you did get $25 and then turned right back around, which I suspect, and I will add the Bollinger Band. But yes, I was going to say, I suspect that we broke down, got below the Bollinger Band, formed this hammer. You put in a trade above that hammer, and then you continue to ride it out to the upside. Stop loss down here. Probably have a target right here, as that was previous support, should now be resistance. A couple different things that we can add here. So the first thing that I would think of is volume. And we have another one of these common breakouts above the Bollinger Band on volume. That typically means you're going to get a move higher. You can see that we broke above there and then broke back down below the 20 SMA. That might have been your signal to get out, depending on how aggressive you were or were not. This is another one of those sudden shots higher. Not really a squeeze, but definitely an expansion. Volume picks up. That's a good sign. This is basically dead for those who trade the Bollinger Band system. It's just crushing, and then eventually you do get this move here on higher volume. That should send you going to the upside. If you put stop loss on the other side of the Bollinger Bands, you got nowhere near running into trouble. And in fact, you even if you wrote it, not that you would, but even if you wrote it all the way down to here, you still never hit your stop loss, and then you took off to the upside. This is a very interesting setup because we had been going sideways. We definitely broke down, but notice how we fell, got a little bit underneath this Bollinger Band, the -2 standard deviations, and then we formed this massive shooting star that touched the 20 SMA, and then we broke back down. Pretty straightforward setup there. Risk to reward probably left a little bit to be desired. You put a stop loss on the other side of the candle, you short just underneath it. The only real reference you have at this point would be this low, maybe the $50 if you go on the psychological importance of $50. But, you know, at that point in time, you probably didn't know that. But it does show a reasonable setup, other than you didn't really have a target on the bottom that you could name right away. So let's get rid of the Bollinger Band. And let's take a look at this on the hourly chart. So the thing about when you drill down in time frames like this, you get micro support and resistance. And what I mean by that is just like little areas that might not show up on the higher time frames, but certainly this has offered support. So if you were to break down below there, that obviously would mean something, just as this has offered resistance. And this is just a simple breakout. Now notice how this shooting star suggests that we're going lower, but then we turn around and broke above it. Well, that's a pretty powerful signal. That is a failure to break down. So the sellers have been wiped out. You can see that you break the top of that candlestick, and then at that point you can put a stop loss on the other side of it. Once you break it here, 2 candlesticks later, 2 hours later, you rally and you take off. this was resistance, becomes support. We break down through support. We go on, find a little bit of a hammer here at 90 and then bounce again. So there are all these little micro setups as well. It really comes down to the market that you are trading. Something like Zcash you can trade on the lower time frames. This I find interesting. Just by glancing at it, I saw this. And you'll begin to see these setups all the time once your eyes adjust to the markets. So we had a pretty big leg lower. We rallied, formed a shooting star right here at an area that had been resistance previously. And then, of course, the 50% Fibonacci retracement level. The bottom of the candlestick right here was tested. We didn't break through it, but if you were just aiming for a return, then you got it. So the Fibonacci setup there, pretty nice, really. So let's go ahead and put a couple exponential moving averages. We'll do 9 and 20. Nice fanning out and a crossover type trade. Nice angle to it, so that of course makes you interested. Crossover here, and then the angle starts to fan out. You didn't even have to get out until down here, so that was a nice setup. That being said, it looks like this market does tend to trend quite nicely when it does get moving, and quite frankly, that shouldn't be a surprise because you're dealing with larger numbers. So with that being the case, it's a little bit easier than like a Ripple to day trade. Let's go ahead and remove all of the indicators. Let's put the RSI on and see if we can spot any setups. Oh, so here we go. The Fibonacci trade, if you remember, I just showed this to you, and the 50%, that even is more present due to the fact that we have the RSI in overbought territory, so that's yet another reason to consider taking that trade. So that is very interesting, and you'll see that's that confluence that I had talked about previously, where you want to see confluence if you can find it, meaning that you want multiple reasons. So this is interesting. This was overbought, did pull back to fall in this area, and it found this area here, 75, that had been resistive. Notice how none of the rest of this was overbought, so certainly worth paying attention to. When you look at this chart, again, you can see that there are nice runs higher and lower. And the biggest problem that you run into with RSI is it's not the be-all, end-all. So, for example, this was overbought, but we ended up pulling back into the normal range to the previous resistance, which should now be support. So you need to pay attention to, is it overbought, and then does it have some room to run to the downside? And in this case, it didn't, so you probably would have stayed out of that particular trade. So in the next video, we'll take a look at Chainlink and see what kind of setups we can find there. Hello and welcome back to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, we'll take a look at Chainlink and potential trades that you could have taken. Now, the first thing that you should notice, obviously, is the trend, and it's pretty straightforward here. It's straight up in the air. So, going to have some trouble finding levels on weekly charts that are truly going to matter for the most part. I mean, they'll matter every time they get near them, but obviously, we have blown through quite a few potential areas of concern and or importance. And time will tell whether or not they end up being important down the road. As a general rule, they should, assuming that we even get back there. So let's take a look at these areas. Obvious resistance, support. I'm going to make that $15. 9 here being support and resistance, and 4.5 being resistance multiple times. Let's go ahead and make this. This looks like it's going to be roughly $20. So there it is. Okay, so here's the thing. In a situation like this, it's a new market. It's a relatively new market, so it's difficult to get overly excited about too many of the longer term setups, obviously, unless you're an investor and you're willing to hold on to it. Obviously, you've done quite well. But let's take a look at this candlestick here. Notice how the volume picked up again as we broke above this 450 cleanly. So if you're more of a longer term investor, that's a signal to start buying. You could put your stop loss maybe at 440 or so. There's no way that you could have known, hey, in the next few weeks, we're going to get all the way to $20. You do have a little bit of action here at 9, though, that was resistance, and it should be support. And you can see we formed this hammer here, which was a buy signal, just like this one was. When a market, and remove these candlesticks, but when a market does this, it's in an uptrend, so you shouldn't even be looking at selling. It's either you are long or you are on the sidelines, long meaning buying. So let's go down to the daily. So look at this big, huge, bullish candlestick that broke above the $9 level. This was part of that hammer on the weekly chart. Nice volume. Certainly shows that there is buying interest. You just put the stop loss on the back of it. You had a couple rough weeks, and then eventually it took off. Let's put our Bollinger Band indicator. Notice how this same area, we had broken down below the Bollinger Band. So that was a sign that we were probably going to at least revert to the mean. But with it being significant support, it's not overly surprising to see that the market pulled back. This would be against the grain here, against the trend, but this shooting star is a negative sign, and we did reach the other side of the Bollinger Band, bounce up, and then broke down back to this major support level. So that's worth paying attention to. I'm going to drop down to the hour rather quickly in this video, just simply because, or you know what, I'll even do 4 hours instead. Just simply because we don't have enough history to really delve into it without looking more on the shorter time frames. It's hard to get a feel for a market when you only have a year's worth of data, unless you're looking at short term. There's a hammer there breaking through the Bollinger Band. Nice bit of volume there. Touches this area here, which was previous resistance at 18, and then rallied. So that's a nice setup. Same thing here. You formed a hammer breaking through the bottom of this Bollinger Band setup. Not as impressive volume-wise, though. So, it's the right idea. It's the right trade in the sense that we're in an uptrend, but it's not as big of a possible setup as some of the previous ones were. So this is an interesting setup because this hammer formed right here where we had seen support, and we were way overdone. We ended up rallying quite nicely for a nice recovery. Longer term, that trend did reassert itself, but you clearly had an opportunity to make some money. Notice how the recovery, once we broke out of the Bollinger Band, if you remember where it was in the last little bit I did, it was at the 61.8 where we formed. I struggle to call this a hammer because the real body is a little too big, but breaking down below it does show a change in attitude, and you can see clearly you got back down to the bottom. So certainly something worth paying attention to. So here is a setup based upon Fibonacci. Reached down towards the 50 and then took off to the upside on a hammer. Nice little setup. I also see a bit of a descending triangle here, which actually went profitable for a while, but then failed. We went back up to the upside. So probably would have either gotten taken out for a small loss, or perhaps you move your stop loss to break even once it retests that area. I mean, clearly you had an opportunity to make some profit. Would you have taken the profit there? Maybe, maybe not. But I wanted to show you that not every setup works. And that's something that you do need to understand. While you can find a lot of profitable setups, sometimes things happen in the market. They just happen. It might be news flow. It might be just a random event. Maybe it's just a big player coming in to remove their positions, and it moves the market against you. It just is what it is. But that's what your stop loss and your money management regimen is for, on the occasion that something doesn't work out. So here's a symmetric triangle. We break out, we come back and we test it for support. We rally, we almost get the target. I mean, that's pretty close. We come back, we test this area again, nice hammer, and it goes back up, and you finally fulfill, without any doubt whatsoever, that setup. So let's put the MACD on. Notice how we got up here at $15, formed a couple of shooting stars in a row, had this MACD cross. I don't know if you would have shorted this, but clearly if you were long, that would have given you plenty of opportunity to get out, because you would have gotten bearish or at least warning signals. Just like this MACD crossover here, right here at support, take this trade up until it crosses again. Pretty straightforward. This is interesting. There was a little bit of a divergence. And that did lead to a breakdown to here, where we formed a hammer and then eventually crossed to take off to the upside. So, I hope that you've seen plenty of examples that make you realize that this is the type of analysis you need to do. Quite frankly, you can do this with any market. But I would definitely encourage you to go out and look at all the crypto charts on various time frames that you can. Start on the weekly time frame and work your way down. It builds confidence. It builds that muscle memory of identifying setups. And then it also, it shows you how trading works in the real world. You want to see a couple of reasons to be involved. You don't fight the trend. Is it with the trend? Is it at support or resistance? Those are your first two questions. Do you have another indicator, maybe a Fibonacci level or an RSI reading that gives you more confidence? Maybe you have a triangle forming, at least three things, and then you can start to put your money to work. So with all of that being said, that is the end of Module 3. Hello and welcome to Cryptocurrency Trading by Wealthy Education. What you'll learn in this course, you'll learn how to trade cryptocurrencies profitably using technical analysis. Teach you the understanding of trends using technical analysis, how to use technical analysis to reduce your risks, and how to identify bullish and bearish sentiment using technical analysis. You'll learn the most effective technical indicators to use, how to trade support and resistance, as well as Fibonacci, how to trade candlestick and chart patterns. Risk management and trading psychology will be touched on as well. And as always, at Wealthy Education, you'll learn with real-world examples. So go ahead, sign up for the course. Let's get started. In this video, we're going to take a look at trends. It's going to explain how to trade different types of market trends, or at least how you should be thinking. Now, the first thing you need to understand is there are 3 ways to describe the market as far as trends are concerned. And that is uptrend, meaning prices are rising over time. That is downtrend. And then there is such thing as a sideways market, sometimes called consolidation, where price simply goes back and forth, where buyers and sellers are consolidating the market, trying to figure out their next move. So uptrend, self-explanatory, prices rising over time. Downtrend, self-explanatory, and sideways. So those are the 3 states the market will be in. It can only be in one of those 3 states. Now, the biggest problem that most new traders have is that they do not know what time frame dictates what. Well, the reality is this. You go out into the forums, you go out into the websites, and they will talk about the uptrend, the downtrend. We're in an uptrend on the daily, but a downtrend on the weekly, a downtrend on the 4-hour chart, but an uptrend on the 15-minute chart. Generally speaking, the best way to go about finding the trend is to actually start with a high time frame, like daily or even weekly. Well, notice how there's a lot less information on this chart, and it's much easier to determine which direction the market is heading. Sellers are much more in control of Litecoin on the weekly chart. Yes, we had a bounce, but at the end of the day, you can see it was slight compared to what we had been seeing. We started at $150, dropped to $35, bounced to 84-ish, 85-ish, which sounded nice, but then rolled over again to continue this. So that is one way to look at it. And if you go back to the daily, it does tell you the same information. It's just with a lot more candlesticks. So pay attention to what price is doing over the longer term. You are looking to trade with the longer term trend. Yes, you can make a few bucks here and there. In Litecoin here, certainly you could have made money buying. But the reality is you were fighting the overall trend. So what typically is advisable is find out what the longer time frame is. And, this is even more obvious over here. Yes, there were times where we did rise a little bit, but look, it gained that much, but it lost that much to get there. So using a little common sense, you should be looking to sell. That doesn't necessarily mean you sell every time, but you have the weight of the market with you. And typically that means it gives you a little bit more room for error. Now, how do we define trend lines? Again, higher time frame, but one way you can look at it is trend lines. So you can go over here to the line submenu, and it's called trend line. And it is a line that shows where price was being supported or the buyers came in. And you can extend it out. So, for example, Litecoin this entire time was going higher. This trend line shows where buyers were willing to get involved. And even when we did finally break down through it, notice how we broke through it and bounced back above it, broke through it again, and then came back and it had a reaction. That is a trend line. That is the essence of defining the trend. There are other ways, but this is the simplest. Sometimes people like to trade channels, and you can click on parallel channel and you can draw, the same trend line, and then you drag it up And what you're doing is you're looking for, in this case, you can see where we hit that, actually broke above it, hit it again, and gained back. So there was a little bit of a parallel channel here. Typically, it's not advisable to trade a parallel channel just simply because why are you trying to fight the overall trend? When you see a move like this, yes, it's overextended, but you have to know that there are people underneath that are willing to buy this. You can see that they never even broke down below the bottom of it, and parallel channel can work in either direction. You can have something like this, drag it up. You can make an argument for a little bit of a parallel channel, maybe not all the way back there, but starting right around here. Again, if you're going to use the parallel channel, you want to use this. You want to use the top. You don't want to use the bottom. The only time you use the bottom of the channel in a downtrend or the top of a channel in an uptrend is possibly taking profits and looking to sell either in the middle if you're aggressive or the top again. Again, though, parallel channels are pretty subjective. It's pretty rare you get a perfect one. So, but it is something that you will see on a lot of charts. Let's take a look at Bitcoin. Now, Bitcoin has basically been falling since the peak in late 17. Now, we've had a nice, huge rally in June of 19, but we have clearly fallen since then. So one of the easiest ways to look at this is just change it to like an area chart. You can see clearly we got a nice rally and then we continued the downtrend. So Bitcoin has been in a downtrend since the bubble peak right around 20,000. Now, obviously, there have been time frames or time periods, I should say, where things looked quite a bit better. And you certainly need to keep that in mind. But all things being equal, this is a pretty negative looking chart since the highs. So where have you made the most money? You've made the most money shorting. Unfortunately, a lot of retail traders make the mistake of thinking they need to catch every tick one way or the other. And that is a great way to lose your account because it's very easy to look at this chart. And I can show you an example right here. This is the Bitcoin weekly chart, very negative. And you look at the daily chart and you think, okay, well, it's a little better here. But what happens if you are somebody trying to scalp this chart on the 15-minute? It looks very neutral, right? You think, okay, well, I could have made all this money. But if you were just patient enough and wait for the longer term trend, it starts to look a lot different. And in fact, it looks as if it's trying to roll over here, even as positive as it looked when I first pulled it up. Hourly chart. See how negative this looks. This comes down to following longer term trends. I cannot stress that enough. Find out what the weekly trend is. You follow right along with it. Now, there are some ways to determine whether the trend is changing, and we'll look into that. We have a video coming up a few down the road that talks about exponential moving average. Quite often that's used to determine trend. And you just want to follow the longer term. You want to wait. If this is a downtrend, Bitcoin gets a little expensive, the sellers come back in. You need to be patient. Cannot stress that enough. In the next video, we'll talk about support and resistance levels. In this video, we'll take a look at one of the most basic aspects of trading, and that is going to be support and resistance. So support and resistance is exactly what it sounds like. It is support for price or resistance to price. So for example, a place where price won't drop below. So that is support there as the market continues to find buyers in this general vicinity, just as this was resistance as the markets kept trying to break above there, but could not actually accomplish that. Now, support and resistance tends to form at large round figures, and as a result, you can use that to your advantage. In order to do this on TradingView, you click on the line tool, the horizontal line tool, and you just place it right on the chart. You can drag from the oval here, and this brings up something a bit interesting. So as you can see, I can right click this and go down to the settings, the coordinates. I can make it 240 even. And most of the time you will find that price tends to respect these round numbers, like I said. Now, there is an area that has been supportive, a little bit of a range here, just below 240. And as we broke higher in Ethereum on the daily chart, we finally plunged through it and it offered resistance. You quite often see that. It's market memory. So what I use to illustrate this a lot of times will be the idea of a high rise. So say you've got 4 floors here. Floor 1, floor 2, floor 3, floor 4. And if you take the stairs or the elevator up to the second floor, what was once the ceiling now becomes your floor. Just as if you drop from the 4th floor to the 3rd floor, what was once your floor becomes the ceiling. It's kind of the same thing in technical analysis. Let me go ahead and draw a couple of other lines, and you will see that as I draw these out, it becomes apparent that this market, Ethereum, seems to like these levels right around every $40 or so. You can make an argument for these are areas you should be trading from. Now, quite often what people will do is they'll look for support or resistance in the marketplace on higher time frames and then perhaps drill down to a lower time frame to see how it behaves. That's getting a little ahead of where we're at now, but what this does suggest to you is that markets, in fact, are not random, and they do have little roadmap, kind of like posts and signs. You can think of it as opening up a map, seeing that there are directions, there are turns and twists in the road, very similar here. By simply drawing these 4 lines, you can see how different the market suddenly looks. So, like I said, a lot of times they will tend to appear near a large round number. So you can click on a horizontal tool, a horizontal line tool, and you can drag this bubble until you find several places where price either does or doesn't go above or doesn't go below. So, for example, you can see right here there's obviously some trouble right around the $43 level, and you can see that as price kept trying to get there, it kept running into a lot of issues. You can also make an argument for right around here. This would be basically $85. Again, that's a big figure. You can quite often go into these markets, and like I said, you start to see a pattern. So, for example, let's see what 75 has to say here and Litecoin. You can see 75 was somewhat important. You can see several times where buyers and sellers came in. There was resistance there. There was support there. There was resistance there, etc., etc. You can begin to, as you trade markets, you can begin to kind of get a feel for what they tend to like. Okay, so Litecoin here, you can see 70 has had an effect on price. So I'm going to take a wild guess and say that we're probably looking at about $15 intervals or so. So let's try 55. And again, it won't be perfect necessarily. It never really is, but you can start to see that there is a pattern to this. And if you really split hairs, you can talk about, for example, maybe are we going to be seeing, $5 increments? Well, there's probably a reaction on a short enough time frame. So you don't want to go crazy. What you want to see is something rather obvious. and then you kind of put it around the round number typically. So, for example, this is an area for me that I think shows support several times, resistance several times. It's basically $65. I could also make an argument about the $50 level. You can see certainly there are several reactions. In the next video, we're going to talk about another type of support and resistance based upon Fibonacci. In this video, how to trade Fibonacci retracements and extensions. And the first thing that you need to know is that it is based upon a mathematical sequence discovered in the 12th century by Leonardo Fibonacci. And basically, it is a scenario that looks something like this. You have coinciding numbers where you add the first two, you get the answer to the third one. You add the second and third one, you get the fourth. So it's this plus this equals this, this plus this equals this, this plus this equals this. And without going into deep mathematical conversations, they are all based upon 61.8% or 0.618 is the golden ratio. And there are nautilus, rivers, mountains, peaks, everything that you can think of seems to have this number involved in it as far as measuring it. Now, you can study as much as you want about Fibonacci, but know that as far as finance is concerned, it is something that is widely followed. The idea is that there should be some type of action around a Fibonacci retracement level and or an extension level, and traders look for setups at these areas. Now, there are a lot of debates out there as to whether or not there's any efficacy to this, and the reality is that there are enough people that believe in it that there is something to it. Whether or not there's any mathematical nature to it in markets, that's completely up for debate. The idea is with a retracement that you take a swing low and a swing high, and when it pulls back, you expect it to be at one of these ratios. For example, this might be 61.8% on this, and then you buy. So let's take a look at it in real life. Let's see really how we could have looked at this. So we are looking for swing lows and swing highs. It works in both directions. Again, though, it is somewhat subjective because you have to have everybody agree on what the swing low and the swing high is. You can see this is the Fibonacci retracement tool. So this was a swing low. This was a swing low. So let's take this one and drag it up to the swing high, and then you look. And you can see the price basically went down to the 61.8% Fibonacci retracement level. The catch with Fibonacci, though, is it really can't be used by itself. There are some people that simply buy a 50% pullback, which ironically actually isn't a Fibonacci number. It's just that for years, traders have always bought the 50% pullback, so they include it in the tool. It should also be noted that there are multitude of other numbers that you can have. I only have the important ones, the 50, the 61.8, the 38.2%. There are other ones like the 78.6, et cetera, et cetera. But really, those aren't used anywhere near as much. It's these three levels, 38.2, 61.8, and the 50%, that tend to attract the most attention. So you can see that we have a swing low, swing high. We pulled back to just about the 61.8. And in fact, we closed above the 50. So you could say that offered support, I suppose. Here's the thing, though. The reason this works isn't necessarily just because of that. there was obvious resistance there previously. So you can make an argument, did fib work, or was it the previous resistance that's now acting as support? The reality is this is a good setup because it's a hammer, which is a very bullish candlestick, and you'll learn about those later, right at the 50% Fibonacci retracement level and the previous resistance level. So you can make an argument either way. That being said, that is one way that you can look at it. What's the difference between Fibonacci and horizontal support and resistance? The reality is you better hope there's none, because you need one or the other. You can see that the 61.8 held on this bounce back, just to show you that it does cause some attention in both directions. You can see that we had fallen, bounced right up to the 38.2 before going lower in the euro yen. Again, though, you can't just pick a level and say, okay, I'm going to start buying or selling there. There's a cluster here, there's a shooting star here, bearish candlestick, and you short it. Again, that's something that you'll learn in the candlestick section, but this all kind of ties together nicely. And even, a big hot mess like Uber, which has been all over the place, you can start to see some semblance of pattern here. You can see right around the 50% Fibonacci retracement level of this big move lower, we did, in fact, see some resistance. Fibonacci is also used for the extension tool, and it's in the same menu. You just choose trend-based fib extension. So if you remember, this Monero one, the original one, went from there to there. So you click on both of those levels, and then you pull back to the beginning. And what you get is the 50% fib retrace. But notice that beyond the highs, there is the 100%, and then there's a 1.61 extension. And that is an area that a lot of people will aim for. Again, though, I would draw your attention up here. Makes sense that there would be a little bit of profit taking in that region. The higher you go up the chain, though, the less likely it is to hit. So like the 2.618 level is a very long-term type of move. And to be honest with you, if you're day trading, you're very rarely going to hit 161. But it is something to look at if you're already involved in this move. So say you're here and you've seen a pullback at a nice move. You want to know where the market may be able to go. You can go back to the last swing low and use it. So it's a way to enter kind of late, actually. Fibonacci is not something that you can ignore, because it is something that catches the attention of so many traders. But like I said, you have to kind of take it for what it is. It's just a guideline to where things could happen. You could very easily say, well, swing high to swing low, and look, we're right here at the 50% Fibonacci retracement level in Ripple. But what would be even more impressive is if we were at an area that had been resistance and possibly even support in the past. There's a gap there. Resistance, 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 and resistance. And the 50% Fibonacci retracement level with a very bearish candlestick and an overextended move. You could probably put on other indicators that we'll be looking at in the next few videos to give you yet another reason to short Ripple at that level. So again, don't get too hung up on Fibonacci, but do realize that it gives you an opportunity to look for places where people are going to be trading. And that's really all it is. In the next video, we'll take a look at how to trade exponential moving averages. In this video, I'm taking a look at how to trade exponential moving averages. So a moving average is one of the most common indicators that you will see in technical analysis. And a moving average looks basically like this. It's a squiggly line that goes up and down. And what it is is a mathematical equation that's being figured out for you. It's plotting every time there's a candlestick formed, and then it connects it all so it just looks like a line. And the idea is it gives you the trend. It shows you if perhaps momentum's picking up, that type of thing. So in order to do this, you need to click on Indicators and Strategies, and you can type in EMA, which moving average exponential. I'm going to put 4 on the chart for the purposes of this video. I'm going to go ahead and click these eyeballs, and on this one, on the EMA, exponential moving average, 9 period based upon the close, I'm going to change the color to blue. And okay, and you can see that the moving average does in fact go up and down with the average price of the close of the candlestick. Obviously prices are rising here, so you would expect the 9 EMA to rise right along with it. You can also put other moving averages on. So for example, let's go to this next one. Click Settings. Change the color to red, make it a little bit more easy to see. Inputs will change to 20. So this would measure the last 20 candlesticks. It's a little slower, and therefore it gives you a little bit of a longer term outlook. Now, there are a multitude of ways to use moving averages. So, for example, notice that the 20 seems to be offering selling pressure, and then once the market breaks above it, it seems to be offering support. That's known as dynamic support and resistance, and you'll see it time and time again. The 20-day, in this case, moving average is one that a lot of people pay attention to. There's also a crossover system, and this is probably one of the oldest trading systems out there. And what happens is one of these moving averages will cross over the other. Obviously the 9, the faster moving one of the two, does the crossing. It drops below the 20, and that's a sell signal. And what that tells you is that momentum for the short term is starting to accelerate to the downside, and the longer term kind of goes right along with it. The idea is that if the faster moving of the two moving averages breaks down below the longer term one, then it is a sell signal, just as this would be a buy signal. Now, it's entirely up to you whether or not you do it in the old classic sense, where people would literally sell, buy, and then if it crosses again, sell. They were always in the market. There are some ways that you can filter some of the noise. So, for example, this cross here, some traders wouldn't have taken that until the two moving averages spread further apart. That shows a divergence, if you will, of speed. Because the moving averages are relatively flat there, that shows that the market is not really going anywhere. But once it did accelerate to the upside, you can see that the moving averages spread out apart. There are a couple of special moving average crossovers, and I'll go ahead and show you those now. In order to see these, we will need the 50-day EMA. I'll go ahead and paint that orange. Let's go ahead and put that on. And then this one will need to be the 200. I'll make this black. So this is 200 days. So they have something known as the golden cross and the death cross. The death cross is very bearish. Golden cross, as you would expect, would be bullish. And that is a moving average crossover when the 50 crosses over the 200 daily moving average. Specifically, it's just this time frame and just these numbers. Just as the death cross is 50 crossing below the 200. So if you hear those terms, those are exactly what they mean. It doesn't happen on the hourly, it doesn't happen on the weekly, it only happens on the daily. The problem with this, of course, is that it is such a high time frame. They are such large numbers that, as you can see, you may get whipped around in this case. But when it does work, it tends to work for a very long period of time. You would have gotten in back here, and you wouldn't have gotten the exit signal until here. So a pretty long amount of time to get involved. Quite often what people will do is they'll use something like this to confirm, maybe like a breakout or something in this case, some type of candlestick formation, which of course we'll cover those later, to validate that type of setup from a longer term perspective. There are a multitude of different ways you can use this. So let's go ahead and put a couple on this Litecoin chart. So this is a daily chart. So let's use a little higher time frame one. Let's go with 50. We'll make that red. Let's go with black on the 200 on the daily. And this sets up an obvious up and down trend type of situation. You can see that we got a death cross there. And certainly that was a selling opportunity. Again, though, not a big fan of these, just simply because for the most part, they don't work, to be honest with you. You get massive gains or you get stopped out with a loss. It's kind of nowhere in between. That being said, though, when you look at this, you can see that the 200-day EMA did offer a certain amount of resistance and then support. A lot of traders will simply only buy or sell depending on which side of the 200-day EMA price is. Or in this case, we've had the golden cross. So that tells you that the 50-day EMA is letting you know that shorter term momentum is to the upside. So then you start to look for buying opportunities. An example might be to use, like a Fibonacci retracement. We've broken to the upside. We've come back to the 50-day EMA. Let's go ahead and put a fib there, and you can see it's right at the 50%. It's between the two moving averages. Price has been caught, and it extends its way higher. We break significantly below the 50-day EMA on this particular day. Could give you a little bit of a heads up as to time to get out. In the next video, we'll take a look at how to trade something called MACD, or Moving Average Convergence Divergence. In this video, we'll take a look at the Moving Average Convergence Divergence, or MACD indicator. The first thing we'll do is we'll put that on the chart. So let's go ahead and click on Indicators, type in MACD, and it'll come up. Make sure you click MACD and not MACD Strategy. And you can see it opens up a separate window underneath, and there's a histogram and a couple moving averages. The histogram measures the spread between the moving averages and whether or not the moving averages are rising and falling. So two moving averages, if you plotted them on the chart, and the parameters that are the standard parameters, they would look exactly the same. It's just basically a way of measuring momentum in its own little window. So how do we use this? Well, there are a multitude of ways that people use MACD. The first is the zero signal line cross here. So you can see there's a measurement from 1,000 to 1,000. Now this will adjust depending on the range of the instrument, but in this case in Bitcoin it's 1,000 to -1,000. And every time it crosses the zero line, traders will either be buyers or sellers. That's probably the most straightforward and easiest way to trade MACD. Some people will use crossovers as a signal to get involved. You can see that the moving averages do crossover occasionally. So like a moving average crossover system. The problem you have with this, and it's going to be the same with an actual moving average crossover system, is that in a flat market, you get a lot of false signals. So like this market was going sideways and you got chopped up. You eventually did get some profits. but you took a couple of unnecessary losses in that meantime. So a way to filter that out is typically to aim for high or low crossovers. Ignore these ones, but try to find the ones that are much higher. And then some people will use it as divergence. So oscillators, and this is one of the family of indicators in oscillator. Sometimes what you'll see is prices moving higher, but yet the indicators on the oscillator are not. And what that tells you is that perhaps the underlying momentum is waning, and that is a sign of internal weakness. People will sometimes use the moving averages. Sometimes they'll use the histogram. It really comes down to, how quickly you want it to happen. More often than not, though, you will see the histogram used. So I've got 3 assets. I've got Bitcoin, Canadian dollar, Japanese yen, currency pair, and US steel. Let's go ahead and walk through these and see if there are some, ways we could have used MACD to help us. The most obvious place on this chart is right around here. We had seen a moving average crossover at an extremely high level. And this, of course, was the highs of Bitcoin. So not a huge surprise to see that it failed at that level. It gotten way overextended. Up to about 14,000, and we have rolled over a bit since then. You can see there was another crossover here. There was a bullish crossover here, but notice how the market itself was relatively flat. So probably not the greatest signal. You can see here, same thing, a bullish crossover. We started swinging up, but the market was drifting a little bit lower. It was just kind of lackluster. Part of the filter can also be how wide the histogram is. You want to see a wider histogram. It makes more sense that it may give you, because it shows a greater diverging of the two moving averages, that there's more strength, if you will, in whichever direction. The zero line crossover right here would have been an excellent buying signal, for example, as well. But with Litecoin, let's take a look at the 4-hour chart, and you can see it works on smaller time frames as well. There's your moving average crossover, and we did in fact drop. It wasn't a huge move, but it did move. Moving average crossover right here led to the market picking up quite a bit until, probably right about here where you would have got a cross signal. So that, of course, set up quite nicely for a potential run. And as a result, it looks as if this has been steady along the way. In the next video, I'll take a look at understanding stop placements and signs of momentum loss. In this video, we'll talk about stop placements and signs of momentum loss. So if you're in a trade, you need to know where it is you want to get out, where things could prove you wrong, or for that matter, where the market is moving against you, even when you are in profit. So let's take a couple really simple ways to look at the market. Let's go ahead and put the volume indicator on. That will give us an idea of momentum. Like this candlestick here, for example, huge volume shot to the upside. So clearly, if you're going to take a trade based upon that, right here at the bottom of this candlestick is a good stop loss. We rallied quite a bit. You can see that there is some support there. That could be your next stop loss. So once the trade moves in your way, and if it breaks back down, then you got out with a small gain. Some traders will do something very simple. Once the trade moves in their way or in their direction, you see this high here, that stop loss. Once we break that high, then you move your stop loss closer to that, and so on. Or on the downside, if you're short up here, maybe based upon this very bearish candlestick. We fell, we pulled back, and then as we cleared this low, confirming a switch in trend, they'll put their stop there. We pulled back, they put their stop there after we broke down. That's a very common way. Of course, you need a trend for that to happen. But there are some other things to pay attention to that are quite obvious. So on the way down, this massive candlestick here in Monero that broke the whole thing down. So if you were short, maybe you were short because of this trend line break there. That was another reason to sell. Well, if you're short and you see this massive candlestick on massive volume, well, you know that if it gets broken to the upside, something's changed materially in the market. So there hasn't been a whole lot to do over the last couple of weeks in this Monero US dollar pair, because there really hasn't been a huge volume spike, if you will, or anything that's changed the attitude of the market. Yes, it's drifted higher, but on pretty weak and low volume. So that's one way you could look at it. There are also other ways people will do it, like with Fibonacci retracement. Notice how the 38.2 is basically the same thing as the top of that candlestick. So that's one thing to keep in mind. You can also use moving averages. So an indicator that you could put in there, see an EMA. Now this is a daily. So let's go ahead and make this, at the very least, you don't want it to be a 20. And realistically, you probably want it to be a 50. So it puts your stop right around the same place. And you'll find that sometimes. It all kind of lines up at the same area. So I have a Ripple chart pulled up. And there are quite a few different ways to look at volume and the trend. So, for example, if you are already long of Ripple at this point, remember our trend line. This was a nice run from the 16th of March all the way to the 10th of April on the 30-minute chart. So quite frankly, there was no reason to be short of Ripple any time during this. Now, that doesn't necessarily mean that you want to be long the entire time if you're day trading. If you're investing, totally different story. But notice every time we pulled back, and especially when we pulled back close to the trend line, there's where your stops need to be placed. You need to find a place that the market has to do serious work to take you out. You don't put stop losses based upon your account size, meaning like, I'm only going to risk X amount of dollars, but I'm going to put a big position on. That's not how it works. You need to do some money management, figure out your maximum loss to start with, and then you move your stops accordingly to what the market tells you. In the next video, I'll take a look at a couple of very useful and thankfully obvious patterns, because it gets other people involved. The double top and the double bottom. In this video, we're going to talk about double tops and double bottoms. And these are simple yet effective ways to look at the marketplace in order to find a potential reversal. These are also known as W and M patterns, and I'll show you why here in a moment. A double top is simply what it sounds like when price tries to rally to the same place twice and it ends up forming a top. This is also called an M pattern for obvious reasons. A double bottom is just simply the opposite, which can be thought of sometimes as a W pattern. Markets fall to a specific level, bounce a bit, come back down, find buyers again, and then turns around. Now, it should be noted that it doesn't have to be the exact same price. you're looking for something close. There's no real rule, as it were, like in Forex, you wouldn't say it has to be within 3 pips. Basically, you're just looking for a general double top or double bottom. So let's take a look at a couple of examples. You'll see them all the time. It's very common. But in Bitcoin here on the half-hour chart, you can see that we made a top here. We pulled back, we made a top here, and then we fell. So that is a double top. Now, how do you use this information for your trading? Well, there's a couple different ways you can do that. You can put a sell order at the bottom. That's typically how it's used. And then put a stop loss on the other side. You can do that, or if you want to tighten it up, put your stop loss about halfway through the pattern. You're looking to at least capture the same distance from the top to the bottom, much like a head and shoulders pattern. But a lot of people will even go 2 times, so 2 times the height, especially if it's with the longer term trend. You can see clearly that happened. In Monero, I have an example of a double bottom. And what's particularly telling about this is that it is at an area that had been important previously. It had been in an uptrend, and then we pulled back. So this is even more important because this is a continuation sign. In general, you want to trade with the trend if you can. But these are also important signals that perhaps we're going to get a trend change depending on what's going on. Obviously, you can look at a chart here. You can see how it worked out. But trading in the moment is an entirely different situation. So, for example, at this point, we would have been in an uptrend. So it makes sense that more often than not, this double bottom pattern is going to hold and send the market higher. Just simple observation. On the 4-hour chart. As you can see, these double tops and double bottoms offer nice signals. They offer a nice measuring stick. In this video, I've shown a couple of nice little signals here, and there was a nice measuring stick built in, and that's one of the beauties of these patterns. Beyond that, they're very obvious. We have a continuation of the uptrend. If you remember that was the one that we were looking at. Let's go ahead and show. So here's the 20 EMA. Notice how once we filled this out, we had formed this W pattern. We also had broken above the 20 and then used it as support on the move higher. So these are all things that could come into play. Furthermore, there was some recent support there as well at a round number in the form of $80. None of this happens in a vacuum. You can see that I have taken a very basic shape and then I've added a few other things to it. Very basic stuff. This isn't magic. This isn't something that takes a ton of thought or calculation. You just notice that, hey, somebody that is trading support and the 20 EMA both got a signal, and we got this W pattern. So there's at least 3 groups of traders that are willing to be involved. Plus, it was already with the trend in this case, so longer-term trend traders would have been paying attention. In the next video, I'll take a look at rectangle tops and bottoms. In this video, I'll be talking about rectangle tops and bottoms. So a rectangle top or bottom is a pattern that, as I'm sure you can guess, is shaped like a rectangle. And what happens is that support and resistance comes into play at the same 2 levels, and then you eventually get a break out of it. And the idea is that in the case of a rectangle top, you're rallying into it, and then you break down. It's a reversal. It becomes a rectangle shaped top to the market. If you are falling and you get a rectangle consolidation area and you break out of it to the upside, it is a rectangle bottom. Pretty straightforward, and they happen on all time frames. So you see them quite a bit. It's just simply consolidation that doesn't lead to continuation, rather a reversal. So let's go ahead and draw a rectangle here in the Litecoin market. Now, how you will trade this is one of 2 ways most of the time. You will either take a measurement, and most people do it this way. You'll take a measurement and you'll aim for the exact same height. So from $80 to $76 is where you're looking at here. Well, 80 minus 76 is $4. So once you break out of 76, you're looking for a move down to 72, something that you clearly hit. However, some traders, with their stop loss behind here, adjust this. Now, this is the way you're typically taught, but a lot of traders will, if they have to risk this for this, well, that's a 1-to-1 trade. They don't want that. They want more. So they aim for double. And in this case, clearly you've gotten it. Because remember, you want to risk 1 to gain 2 minimum, preferably 3 or 4. But as this breaks down, they will move their stop loss to break even once you get that 1-to-1, and then they'll let it run. Or they'll just let it run like that. An alternative is to set a stop loss at half the height and then aim for the $4 here, the height of this trade. And that gets you back to 1 risk for $2. Ethereum, you can see that there was a couple of rectangles here on the hourly chart, and you will get them more frequently, obviously, on shorter time frames, but there should be no doubt that those were both profitable trades, because you're only looking for twice the move, or twice the height of the rectangle for the move. Clearly that was not an issue. You can see that the support breaks. The reverse of the recent trend tends to be pretty brutal, and again, you should be able to get twice. In a continuation move, there are already a lot of people on the side of the move, in this case going higher into this, so that would be one reason to think that maybe the momentum isn't going to be as quick. You'll probably be more apt to get the occasional pullback. And now keep in mind, this is on the hourly chart, so you need to look for quicker moving indicators. You can see we got a crossover here, signal crossover in the MACD on both times. And then by the time we broke down, we were starting to scream towards the 0 line. So that would have been something that would have caught your attention. Furthermore, on the second one, this would have been an area where we had seen resistance recently. So you can see how using some of these indicators can give you an idea as to, okay, not only is the pattern setting up, not only have we, in this case, broken through support or broken through resistance on a rectangle bottom, but now you have people who pay attention to MACD, paying attention to it, etc., etc. In the next video, I'll be talking about head and shoulders, one of the trading community's favorite patterns. In this video, I'll take a look at the head and shoulders pattern. The head and shoulders pattern is one that is recognized by most traders. It's very commonly traded, so of course you want to know about it. A head and shoulders and an inverse head and shoulders, because there's two directions that you can trade it, looks something like this in the case of a head and shoulders, and an uptrend. So what happens is you get a continuation of the uptrend. You get the pullback like you get, in any uptrend, and then you continue to go higher. You make a higher high. That's part of an uptrend as well. You pull back a bit, and then this hump over here doesn't make a new high. So this is a shoulder, that's a shoulder, and that's your head, hence the name. You can draw a line from these little dips between the head and shoulders, between each shoulder and the head, I should probably phrase it as. And that's your neckline. And your neckline is a signal to either buy or sell. In this case, sell in a head and shoulders. So think about it. What's happened is we've rallied, we continued, and then this time we just ran out of momentum. The great thing about head and shoulders, it's got a built-in measuring stick here where the top of the head to the neckline, if you measure that, and let's just say it's $200. Well, a breakdown at the neckline, you're aiming for at least $200. A lot of times the stop gets put on the other side of the shoulder. And quite often that automatically gives you at least a positive risk to reward ratio, sometimes 2, sometimes 3 to 1 automatically. Another thing that you'll notice over time is a lot of times these patterns, especially in currencies for whatever reason, they'll fulfill that move, grind for a bit, and continue going even further. So that's the head and shoulders. The inverse head and shoulders, as I'm sure you have guessed, is simply the bullish version of this. In a downtrend, you'll see something like that. You've got your neckline, you've got the measurement, you got your target. Should be noted, it can be angled like this. It does not have to be straight up and down 90 degrees, so sometimes, they'll actually look more like this, and then you draw your line like that. Same thing with the inverted head and shoulders. So let's take a look at these in the wild, and you can see exactly what I'm looking for here. And there's your neckline. So you can see that the pattern does play out, right? So here is your neckline, and here is the height of the head to neckline. And you'll notice that we clearly hit the target without too many issues. And in fact, hit that area a couple of times. Not a huge surprise because a lot of times these areas get visited more than once. And finally, over here in Tron, this is a 4-hour chart. You can see that we had been rallying. We got a nice rally there, a bigger rally, and then kind of ran out of steam. Let's go ahead and draw our neckline. You can see that you could have put your stop loss here. Your measured move was 6 cents. So from 21, you're looking for a move down to 15. And you did, in fact, get it. Wasn't right away, but it did happen. Never threatened your stop loss. You will find that head and shoulders patterns are followed by quite a few traders, mainly because they're obvious. They catch a lot of people's attention. Higher time frames are much more reliable than shorter time frames, as is the case with all technical analysis patterns. Let's take a look at MACD. And you can see that we had a crossover at an extremely high level right here at the top. And then by the time we got down here, we were well below the zero. So that, of course, would have caught the attention of somebody who was a MACD trader. The 20 EMA and a 4-hour chart, you can see sloped nicely, crashed through it, found resistance, and then broke down. That would have been a signal for somebody using the EMA. There are quite a few different ways to do this, but you'll notice that the pattern, the great thing about this pattern is that when you step into it and you get the breakdown, for example, in this case, you knew exactly what you were looking for to begin with. You also had a place to get out because patterns do fail. They're not 100%. But the nice thing about these patterns is so many people pay attention to them that they give you a little higher percentage probability. In the next video, I'll take a look at something called a doji candlestick and the myriad of different types. In this video, I'll take a look at how to trade something known as a doji. And a doji is essentially a neutral candle, although there are various flavors of it. But really what you're looking at is an opening and a close price that is either the same or very close to being the same. This is one of those things where it is a little bit of an art form, because some people will say that it needs to be an exact open and close being the same. Some people will say that, if there's like a tick or two difference, that's fine too. So really, at the end of the day, though, you should assume that these two mean the same thing, because essentially what they do mean is that the market is undecided during that time period. In this case, it would be Litecoin on the daily chart. There are a few other ones. There's a gravestone doji. which means that the market rallied and then broke back down during the day. That's a pretty bearish sign. There is a dragonfly doji, which is somewhat bullish in the sense that it is unchanged, but we did initially try to break down, but the sellers were repudiated. There's the long-legged doji, which just simply is a longer version of a doji. They all mean the same thing, though. They mean indecision. So, really, they are a bit difficult to trade in the sense that they are probably not one of your more reliable candlestick patterns. So you have to add a filter to it. You know, some people will come in and just say, well, buy or sell dojis. And that's not really the way it works in the real world. For example, what you're looking for is multiple dojis. So I'm going to go down to a 4-hour chart here. And this is an example here. There's 3 dojis in a row. There's something that isn't quite a doji, but it's similar. There's something that isn't quite a doji, but it's similar. But what you're looking for in a scenario like this is you're looking for some type of change in attitude. So as you can see, when I draw these 2 lines, the dojis kind of spell out the indecision area. So for about 16 hours or so, the market was trading in this little area. So what you want to see is a close below the support or resistance. And in this case, it was the support. And we did, in fact, break down from there. So where do you go looking towards? One of the most obvious places would be previous, in this case, previous support. Had we broke higher, it'd be previous resistance, assuming that you had it. We're not at an all-time high or something. So that's a quick and dirty way to look at this. You can put indicators on to go right along with it. So I'm going to go ahead and put this indicator on. This is the 9 EMA, and you can see that it did break lower on a close lower of this little range. So it makes sense that you continue to go downward. In a sense, this is almost the same as trading a rectangle, but in this case, it isn't a top or a bottom. And essentially that really is what it is. It's the market kind of not really knowing where to go and then eventually making its decision. So let me go ahead and get rid of this and see if I can find some others. They do happen quite a bit. It's not that rare. You could even go so far as to say that it is probably one of the more common setups. Again, though, like I said, it isn't necessarily the most reliable setup. So really, you want to see multiple dojis form. So you can see that the dojis were bouncing off of this area here. This one was probably the most dojiest of doji candles, if you will. And you can see that there was obvious resistance just above. And it's also shown by these wicks. Once we broke out, we went straight to the next potential resistance area and then pulled back. Not a huge move, but it does double this area, much like a rectangle. That would be your minimum, obviously. These do happen time and time again, and you'll notice that once we broke out of this area, the big green candle got support from the 9 EMA. Now, you can trade just a single doji, and some traders do, but the more you get in a row, the more success you'll have as a general rule. Now, again, that's not always going to be the case. You'll notice that we were in a downtrend here in Bitcoin. We rallied a bit. We formed a doji right here where we had seen previous resistance, right at about $7,100. You put a stop loss on the other side. You sell once you break down below it, and you can see it ends up being a nice trade. I'm going to go ahead and put an EMA here, and I'm going to, although you could use a 9, I'm going to use a 20. just because I like the way it behaves on a daily or on a intraday time frame. And you'll notice that there is a doji right here. You know, the market had been rallying a bit, and then it's just kind of hanging here at this moving average. You could also make an argument for a certain amount of support here at, just call it 6,600, just to give it a round figure here. It's actually a little bit lower than that. But you can see that the market had been hanging on to this area. The fact that the 20 EMA has come into play formed a little bit of a supportive candlestick here known as a hammer, which will be in our next video. But you can see that we kind of stalled here, and then we broke the top of it and then shot straight up. So all things being equal, you're with the trend over the last several hours, and the fact that we broke the top of the doji suggests that perhaps that indecision has gone away. Another thing that I would point out is that in this particular run, you can see that there is a gravestone doji there, which in theory is very negative. However, it can also be said that once you break above the top of that, that's a certain amount of resistance overcome. So when you look at it, and then here, and the 20 EMA all kind of coming in together at the same time, that does suggest that perhaps there's a little bit more to go here in Bitcoin. In the next video, I'll take a look at two of the most powerful candlesticks out there, the hammer and the hanging man. In this video, we're going to take a look at the hammer and the hanging man patterns. These candlesticks look the same. Basically, they look like this, or they can look like this with a small body, but the commonality is short top wick, longer bottom wick. Looks like a mallet on a handle, so therefore it's called a hammer. It's called a hanging man because they say that when that forms, it is a very grave sign. So the difference between the two is where they're placed. A hammer is at the bottom of a downtrend. A hanging man is at the top of an uptrend. The inner workings of what's going on is what's important. You'll notice that the sellers gain a lot of strength during the day or the hour or whatever you're trading, but then the buyers come in and support the market. This shows that the sellers are running out of strength. And this could be a bullish sign at the bottom of a downtrend. However, at the top of an uptrend, there's a few special rules. So let's take a look, and I'll kind of show you what I'm thinking here. This is a hammer. This is a downtrend. And you can see that they tried to push lower, but failed. So when you break above the top of the hammer, think about all of the sellers during that hour. Now that price has gotten above it. Well, they're all losing money, and they need to buy the market to flatten their position out. So essentially, in this case, in Litecoin, you're taking a look at where are all the traders positioned and what are the wrong ones doing? Well, the wrong ones are covering their buying, so price went higher. Notice how this one formed, but it didn't get broken above, and therefore it wasn't a signal. But also notice how the hammer here that got broken above ended up being retested, and then we rallied towards this area. So that's classic behavior. So this is the hammer in question for the Litecoin market. Remember, this one had formed, but it didn't get broken to the upside, so it never really kicked the signal off, so to speak. So the first thing you look for 99.99% of the time is, does it make sense that this candlestick pattern has occurred where it has? I'll move this down to the mid-century mark, 3650, and you can see that there was an explosive move to the upside there. So obviously there are going to be a lot of orders there. So that makes sense. You can also see that there was a lot of volume here as well, but we could not break down. So that makes sense that we might be running out of momentum. Let's go ahead and put our MACD on. And you can see that at this hammer, we had reached extremes, and shortly thereafter, we got the cross, which kicked off the trade. You can also, in this particular instance, look at a set of EMAs, for example, and you can see that the candlesticks had been spreading, right? But notice how the moving averages had been spreading. But notice how we slammed right into this moving average. Now that could have been your initial target. The reality is, though, and this is important to note about moving averages, support and resistance matters much more. So as we pulled back there and then we formed this other hammer, that shows you that the market is okay with testing this. So that would have given you a little bit more confidence going forward. Again, this is a pretty significant candlestick at a pretty significant level. And as I zoom out even further, you can see just how significant it was. So in those cases, you have to be a little bit flexible on how you use these indicators. But without a doubt, the support and resistance, by far the biggest thing. So here, a hanging man is right here. Now, those of you who are particularly astute may go, well, that looks like a dragonfly doji. Well, they're really kind of the same thing. There really isn't a huge difference. It is traded the same way here in the sense that we're in an uptrend, we pull back, we rally, and then we break down. And that is the first sign of support breaking, and we went much lower. You can also make an argument for that being a hanging man. After a quick bounce, we broke down below the bottom of it. The buyers lost momentum again. Stop loss goes on the other side of the candlesticks. Pretty straightforward. This is like right in an area that's caused some resistance in the past. We pulled back and then we ended up forming that hourly hanging man. You can also take a look at the MACD. This looks like something that would have suggested that there's probably some momentum problems here. Yeah, you can see we crossed right there and then rolled over. Pretty straightforward. And if that didn't convince you, then obviously the very bearish candlestick that was next certainly should have at that point. So in the next video, we're going to take a look at a pattern called 3 white soldiers and 3 black crows. In this video, we're going to take a look at a pattern called 3 white soldiers and 3 black crows. Now, the reason they're called white soldiers and black crows goes back, it harkens back to the old black and white charts. In modern trading, most charts are red and green, so it would be, something to the effect of, I guess you could say, 3 green soldiers, 3 red crows. Doesn't make as much sense from a visual standpoint, but that's basically what you're looking at. So really, this is the pattern. It's that simple. Now, the purest pattern will have gaps lower and then they'll rally, a gap lower and then they'll rally. Now, this is an extraordinarily difficult pattern to achieve in most markets. With perhaps the exception being the stock market. So we actually use a variation of this. All we ask is that you dig into the candlestick from the previous candlestick. So, for example, you get a white candlestick and or a green candlestick, and then maybe you continue to go higher, but in the interim, you pull back into it, right? So maybe it looks something like that. And then the next one would be something like this. Now, this basically tells you the same thing. And what it tells you is that buyers are becoming aggressive. 3 candles in a row, the 3 white soldiers pattern, or 3 green soldiers, very bullish, suggesting that you're going to see a pretty big move higher. Typically what you'll do is you'll put your stop loss behind the middle candlestick and you'll buy on the top. Some people will put their stop all the way down the bottom. It really kind of comes down to what you're comfortable with. But for the most part, if you're going to retrace that much of the move, you're going to have a losing trade, so you might as well save some of your cash, right? So with the 3 black crows, as I'm sure you probably have already figured out, it is basically 3 black negative candlesticks, traded the exact same way. You're looking at a scenario where you really are starting to see momentum accelerate to the downside. So let's take a look at this in the real world. Here in Bitcoin, the hourly chart, you can see that we rallied, and then we pulled back, and then we rallied for that hour, and then we pulled back into this hour and then rallied again. So once we broke the top of this, it showed extreme continuation. You could put your stop right there and you can see it just took off. I mean, it was a straight shot higher. So that's a 3 white soldiers or 3 green soldiers setup. And in Litecoin, you get 1, 2, 3 candlesticks in a row. These are black crows. You can break down below the bottom of the candlestick pattern and you can see stop here, stop there, doesn't really matter. It goes all the way down to the $41 level. Now, again, this is a bit of a adjustment for day trading, but if you think about it, it makes perfect sense. If you get expanding volume or expanding range, 3 candlesticks in a row, well, that means something. So that's how, as a day trader, we use this pattern. You can see we had broken through support right here at $45, basically. So that was your first clue. You also could have traded with, perhaps Bollinger Bands, because what you're going to see here is we had broken down that line and started to walk the line. So that's a very strong side to the downside. And you can see that the 20 SMA, simple moving average, was right there. So you know that the 20 exponential is going to be probably just below it. So you were already underneath that to begin with. As you can see, when you zoom way out, there's an argument to be made for this as well, which would be a major symmetrical triangle being broken down. And you did, in fact, get that move all the way down to here. So a lot of different factors setting up in this trade. And with these trades with the indicators, your job is to, when you see the pattern form at support and resistance, you need to find a couple of other reasons to get involved. This is why you should have your support and resistance levels drawn on your chart to begin with, and then the pattern, and then the indicators. And then when you lay all that together, you have confluence. Confluence leads to profits. Thank you so much for taking Cryptocurrency Trading Masterclass from Wealthy Education. We hope you found this informative as well as entertaining. We encourage you to revisit this course occasionally to keep your skills fresh. Again, thank you so much.